simple view is that their right to pause at this point has been a big increase, 500 basis points or so. Take a pause, but I do think it's possible they're going to have to raise a little bit more. That inflation is kind of stickier. I think people are coming around to that, which means rates may have to go up a little more. People should be a little prepared for that. Just as a matter of managing your own business, be a little prepared for that. Whether you're a financial company or a real estate company, et cetera. I think the other thing I'd be a little prepared for is the volatility that might very well be created by quantitative tightening. We've never really had quantitative easing, which we've had now for the better part of 15 years, and now you're going to see quantitative tightening, and I think the effects may be a little harsher than people expect, but hopefully we'll get through all of that and I'll be okay.
You're pretty much well established on the mainland, which was your goal. But the things have changed. China's not necessarily the be-all, end-all anymore. We've had simultaneous crackdowns domestically on the platform economy, on property, on online gaming, on online education, not to mention COVID-0. You have a crackdown on consultancies. There's lots of pressure. I mean, are you recalculating your growth projection and the capability of that growth in China?
You went through a long list there, which I wouldn't agree with all of it. But I think when we do business in a country, and we do business in 100 countries around the world, we are there for the citizens of the country. And we're there, hopefully, through good times and bad times. We tend not to leave other than there's war or civil war. And so we're not predicting any of that here. Obviously, it's become a far more complex situation. Some for good reason, some not for good reason. And, there's risk. There's always going to be risk. And I think you'll see companies react to different things for different reasons. Some is their own resiliency. Some is obviously national security, will trump all other things. So, our government tells us to do A, B, and C. We're going to do A, B, and C and support it. And I think there's a risk in China itself that, if I've met with several people here, if you have more uncertainty, some of it caused by the Chinese government, well, of course, it's going to not just change foreign direct investment, which has gone up a little surprisingly, and I don't think they should assume that's going to continue, but it's going to change the people here, their own confidence, their own ability to invest and do things. China is obviously going to do what they think is good for itself, and business might be a positive attribute, but national security will trump all other issues.
Now, I was just at G7 where we heard a lot of that rhetoric where they're de-risking, not decoupling. But again, the Chinese say it's one and the same. It's America trying to limit China's rise. And you've seen that bifurcation. There's more jargon, not to overemphasize all this jargon that's going out there. But again, do you see de-risking being different from decoupling?
Totally. So if you ask me, over time, yeah, there'll be less trade. It'll take years for these things to take place, but it won't be a decoupling. And the world will go on. I think, like I said, I think far more important is what's happening in Ukraine right now. And so hopefully this will sort out, and it'll never sort out if people don't talk. So I urge people, have some real deep conversation, get to know each other a little bit, each other's concerns about some of these issues, and things would be better if we had that.
That was Bloomberg's Stephen Engel speaking to JP Morgan's chief executive, Jamie Dimon, exclusively. Coming up, EU and U.S. officials meet in Sweden today to talk key issues, including China and security. We discuss what else to expect. That's next, and this is Bloomberg.
Like Soros Fund Management CIO Dawn Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman sisters rather than Lehman brothers, the world might well look a lot different today.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Welcome back to the Open, everyone. 42 minutes into the European trading day, and this is a picture across the board. The DAX and the CAC actually losing less than they were 15 minutes ago. They're still down 0.5%. The focus firmly on China economic data and a lot of questions about what that means for the rest of the world. Now, top officials from the EU and US are meeting in Sweden today for the Trade and Technology Council. They look to strengthen their cooperation on key issues from China to economic security. Let's get more now from our Europe correspondent, Maria Tadeo, in Brussels. Maria, good morning. So what's top of the agenda?
Yes, Francine, and it's a busy agenda for the TTC, the Trade and Technology Council. Remember, this is a bilateral platform that brings together a U.S. delegation that is led by the U.S. Secretary of State, Antony Blinken, and the European Union with a number of commissioners, essentially range from everything from trade to the internal market. Now, a lot of this is about strengthening the cooperation between the EU and the U.S., but this year the conversation really is about China. And I was struck by that interview that you played at the start of the show from Jamie Dimon, again, repeating this idea of China and how to do business with China. That was a question that Mr. Blinken reported to and asked yesterday, was asked by reporters in Sweden, and this is what he had to say. Let's take a look.
Both the United States and Europe, I think, believe that, again, this relationship is an important one, one that we seek to sustain, but with our eyes wide open. And so both the United States and Europe are not in favor of decoupling, but we are in favor of de-risking. And you've heard that from the leadership on both sides of the Atlantic.
Blinken, again, repeating, Francine, what is the buzz sentence that we hear repeatedly, the terms of no to de-risking, well, and focus on de-risking, no to decouple. The issue for a lot of countries is that even the idea of de-risking, it sounds good, it has a nice ring to it, but what does it actually mean? And that is a debate that will be going on today between these two delegations. What we understand, and there's two things to watch out for, is in terms of the statement and the final conclusions, the Europeans do believe that this is not the format to go after China, that instead they should focus on the positive aspects of this cooperation between the US and the European Union. The United States, however, wants something similar to the G7 statement. Remember, that was a page that contained 20 references about China and really stressed issues like political and economic coercion. Both need to agree, but again, you see this Chinese question is front and center, but how to calibrate even the term de-risking, it's very complicated.
It is very complicated. We've also seen AI dominate the news flow and move stocks. How is this playing into discussions, Maria?
Yes, and look, this is the talk of town. Everyone is focused on artificial intelligence. We've talked about the NVIDIA story, the $1 trillion story, and this will also be a part of the debate here. Remember, the G7 already said they wanted to work towards, quote, trustworthy artificial intelligence that would protect intellectual property, but also focus on disinformation. And Francine, we are being told, by the way, that today, Margaret Vestager, remember, she has been, for some U.S. companies, a real nightmare. She would say she has been the protector of European interests on her part, but she will have a conversation virtually with Sam Altman, who is the CEO, obviously, of OpenAI. Remember, he was on a European tour very recently, met with the French president, and there's also rumors and speculation that he wants a new headquarters in Europe. He didn't stop in Brussels. Well, today he gets to speak with Margaret Vestager, so to be a fly on the wall in that meeting.
Yeah, that would be pretty cool. I know you'll make the calls, Maria, to know what they're talking about. Maria Tadeo, they're our Europe correspondent in Brussels. Now let's also get to the Bloomberg First Word News. And let's start with the U.S. House Speaker Kevin McCarthy dismissing threats from Republican hardliners to remove him from his job. The debt limit deal, as he agreed with President Joe Biden, is heading for a vote in the House later this evening. Now, despite GOP objections, the bill cleared a crucial hurdle on yesterday when the powerful House Rules Committee voted 7-6 to advance the bill. Now, North Korea has confirmed that an effort to launch a military spy satellite into orbit failed earlier today. The official news agency reported a rocket crashed into the Yellow Sea after losing propulsion in the second stage of the ascent. Now, the launch initially prompted missile alerts in both Japan and South Korea. Pyongyang says it will attempt another launch very soon. Elon Musk has told China's foreign minister in Beijing that the interests of China and the U.S. are intertwined, echoing recent remarks from the bosses of Apple and Mercedes-Benz. Now, the Tesla chief met Ying Yang on his first post-COVID visit to China. Musk is expected to tour Tesla's Shanghai factory later today. And Theranos founder Elizabeth Holmes has reported to prison to start her 11-year sentence for defrauding investors over the company's unreliable blood testing technology. A federal court convicted Holmes of wire fraud and conspiracy last year, with her final appeal failing last month. Now, the 39-year-old is being held in a minimum security prison near Houston. And that's your Bloomberg First Word News. Coming up, the Italian Prime Minister Giorgia Meloni has 5 months to pick a successor at the Bank of Italy. What should we expect? We discuss that next. This is Bloomberg. So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
We've owned NVIDIA since inception. Some of our funds still own it. We are looking to the software providers who are actually right now where NVIDIA was when we first bought it. So NVIDIA was in the $5 to $10 billion range. Now it's $1 trillion, as you said. We are really happy that, investors who own benchmarks like the NASDAQ and QQQ still own NVIDIA. They own it in some of our portfolios, but we're on to the next thing. NVIDIA is a hardware stock, and sure, it has some software, but the history of hardware and software is the bigger beneficiary over time is going to be software.
That's the ARK Invest Chief Executive Officer and Chief Investment Officer, Cathie Wood there. Now, time is running out for the Italian Prime Minister, Giorgia Meloni, to pick a new Bank of Italy chief. The appointment may be one of the most significant that the PM gets to make. Now, the current governor gives his final annual speech today, leaving Meloni 5 months to replace him. Well, Chiara Albanese, our Italy government reporter, joins us now with the very latest. Chiara, as always, great to speak to you. So what kind of decision can we expect from Giorgia Meloni?
Hi, Francine. Yes, for Giorgia Meloni, this decision that is coming up is probably the biggest she has to make yet. The Bank of Italy governor is not only a very powerful figure in Italian and European politics, but also it is a sort of ultimate state control over the troubled finances and the billions of debt on which Italy is sitting on. So picking a name that is reassuring to investors, but also in line with the government, that can speak freely to Meloni and the current leaders in Italy and advise them on what are the best moves to make, will be crucial to keep the spread and the confidence that the current government is enjoying.
So, Chiara, how significant will her decision be for the future path of Italy?
It will be a crucial decision because the new name will probably last longer than the government itself, but also because it will involve also a contribution of all the main institutions in Italy. The cumbersome and complicated process to appoint new governor also involves the parliament and President Sergio Mattarella. So it will be a test for Meloni of showing that she has also a grip on other institutions as well, and not only on her government and her party.
So, Chiara, the current governor of Banca d'Italia, Ignazio Visco, is delivering his last speech today. What are you looking out for?
Visco is speaking today in Rome. He is having a bold address. He has been so far not a shy figure. He is being quite bold in showing the current trend. So he is expected to indicate and suggest that the new pick, so his successor, will have to be, as much as him, a very delicate and balancing figure rather than a person that might rattle feathers.
All right, Chiara, thank you so much. Chiara Albanese, there are Italy government reporter. I do think the government is staying on a bit longer, certainly until October, so we'll see whether he'll make more speeches from now until then. Now, let's also take a look at some of the things that markets are watching out for today. We get a host of inflation data from across Europe today, including a provisional reading of Italian CPI for May at 10 a.m. UK time. At 1 p.m., then we get a provisional reading for German CPI for the month of May. 3 p.m. U.S. job opening data is released for April. 7 p.m. UK time, the Fed publishes its latest beige book, giving insight into the economic conditions across the U.S. So let's also look at some of the other movers that is happening in the markets right now. Let's start with Heineken. Of course, Joe Easton was looking at Heineken as one of the biggest movers, down 2%. This is after a Mexico Coke bottler, FEMSA, has actually sold about 3.3 billion euros of its shares in the Heineken Group, divesting its stake in the Dutch brewer as it plans to focus on its main business. So that's putting a bit of pressure of Heineken, down 2.2%. The other story we're watching out for is Glencore. Now, Glencore, one of not really biggest movers, but certainly one of the biggest stocks where there's news around. So Glencore is set to ready a sweetened tech bid to try and break the deadlock. There's a couple of big M&A bids that some companies are looking after in Glencore in the middle of this battle. Now, overall, this is what we're seeing across the board. If you look at some of the sectors, but also some of the cross-asset, a lot of the focus is on treasuries in the U.S. ahead of that debt deal. And then a couple of the other things that we're watching, of course, is that China PMI figure really putting a little bit of a dampener because of these economic worries and, of course, these troubles in China's economy reverberating beyond the country's domestic markets today. That's it for the European Market Open. Surveillance Early Edition is up next. We'll also look at copper extending its worst monthly loss in almost a year. Iron ore falling further below $100 a ton. Again, this is on China's slowing manufacturing, and that's raising concern about demand from the top metals consuming economy. We'll have plenty more throughout the day. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. The top names at the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg. Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. China's manufacturing slump deepens in May, further denting the nation's recovery. Global stocks and commodities sell off. French inflation slows more than expected in May on lower energy and food costs. A boost for dovish voices at the ECB. The first German state to report also shows a drop. Plus, the U.S. House plan to vote today on the debt ceiling bill after clearing a key procedural hurdle. JP Morgan Chief Executive Jamie Dimon tells Bloomberg he's hopeful it will pass.
So I wish that one day we get rid of the whole debt ceiling thing, but I understand when, it's a democracy, people have different opinions about what we should be doing, and it's just one tool for one party to, get the other party to the table. So I'm quite optimistic there, and I really do applaud the fact that they all sat down and spoke, got something done.
Well, first things first, let's check on the markets. The ECB saying there are vulnerabilities in the financial system revealed by rate hikes. We're also getting quite a lot of data. So first of all, we have Italy final first quarter GDP rising 0.6%, a little bit better than the preliminary 0.5%. And then I hope you all studied geography, German geography at school, because we have CPI by the various states. So you have Hesse, Bavaria, Brandenburg. I don't know why I need or I feel the need to actually pronounce it in a German accent, which I'm very bad at. But for the month of May, if you look at Hesse year on year, it's 5.9%. It does seem to be pretty much in line with expectations. Baden-Württemberg actually gaining 6.6%. So they're gaining, but they're not gaining as much as expected, or certainly there's a little bit of a slowdown, is what we heard also from French CPI, but also some of the Spanish CPI that we saw. So the difference in terms of the maps, when you look at the CAC 40 and elsewhere, for example, the FTSE down some 0.3%, the CAC 40 is down 0.6%. The focus firmly on Chinese data that disappointed in terms of PMI. So that gives us a little bit of pause for reflection, how much consumption they'll do of some, for example, of the sectors, including some of the metals, which is why we're seeing a bit of focus on oil, iron ore, and copper. Those are down, and those are some of the biggest sectors that are losing. Now, China's manufacturing activity, as we were saying, contracted for a second straight month in May. It's more evidence that the post-COVID recovery has slowed in the world's second largest economy. Now, global stocks and commodities are lower, as well as the offshore yuan. So let's stay with China. And JP Morgan's chief executive says the bank will be in the country for both good and bad times. He remains committed to doing business there despite geopolitical tensions.
When we do business in a country, and we do business in 100 countries around the world, we are there for the citizens of the country. And we're there, hopefully, through good times and bad times. We tend not to leave other than there's war or civil war. And so we're not predicting any of that here. Obviously, it's become a far more complex situation. For some for good reason, some not for good reason. And, there's risk. There's always going to be risk. And I think you'll see companies react to different things for different reasons. Some is their own resiliency. Some is obviously national security, will trump all other things. So, when, our government tells us to do A, B, and C, we're going to do A, B, and C and support it. And I think there's a risk in China itself that, I've met with several people here. If you have more uncertainty, some of it caused by the Chinese government, well, of course, it's going to not just change foreign direct investment, which has gone up a little surprisingly, and I don't think they should assume that's going to continue, but it's going to change the people here, their own confidence, their own ability to invest and do things. China's obviously going to do what they think is good for itself, and business might be a positive attribute, but national security will trump all other issues.
Now, I was just at G7 where we heard a lot of that rhetoric where they're de-risking, not decoupling. But again, the Chinese say it's one and the same. It's America trying to limit China's rise. And you've seen that bifurcation. There's more jargon, not to overemphasize all this jargon that's going out there. But again, do you see de-risking being different from decoupling?
Totally. So if you ask me, over time, yeah, there'll be less trade. It'll take years for these things to take place, but it won't be a decoupling. And the world will go on. I think, like I said, I think far more important is what's happening in Ukraine right now. And so hopefully this will sort out, and it'll never sort out if people don't talk. So I urge people, have some real deep conversation, get to know each other a little bit, each other's concerns about some of these issues, and things would be better if we had that.
Me too. Well, that was Bloomberg's Stephen Engel speaking to JP Morgan's Chief Executive Officer, Jamie Dimon. I was distracted because I was speaking to Paul Donovan, Chief Economist at UBS Global Wealth Management. It wasn't high-level stuff. We were trying to remember how you pronounce a lot of the German cities, actually, because we both studied German. Comes in handy when you look at CPI from Germany. Paul.
Absolutely, yes, because it's coming out from all of the regions. But there's a fairly consistent picture actually that we've had with the Eurozone CPI numbers over the course of yesterday and today, which is it is coming down.
Yep.
And this whole idea of price stickiness, the inflation is going to be sticking around, is really being blown out of the water by these numbers. So the Spanish data, of course, came in very low. There's no stickiness there. And actually, interestingly, we're also getting this confirmed in the regional data in the United States. So, you know, New York, Los Angeles have seen big declines in their CPI numbers. Doesn't appear to be very sticky to me.
Yeah, and you were one of the first ones, actually, I remember 4 or 5 months ago, coming on to say about some of the deflationary prices that we saw. And I think at the time you were mentioning, like, LED screens.
Yeah.
I mean, could it be that inflation will come down as fast as it came up? Or is that wishful thinking?
So I think that the issue that we've had is, of course, we've had 3 very different inflation episodes, just bang, one after the other. The transitory inflation episode of durable goods, I mean, that's now in extreme disinflation or outright deflation, depending on which country you're in. The energy price supply shock, which has been the second wave, that's starting to slow down now. But the profit-led inflation is very culturally sensitive. So different countries have got different degrees of profit-led inflation.
Yeah.
Quite hard to see, say, in Switzerland, but a lot more common here in the United Kingdom. That speed of that decline will vary from country to country.
But so overall, are we in a much better place for the world economy? I was looking back actually at some of the forecasts that we had for the UK economy, and this is like the vanishing recession. We're not even expecting a recession anymore.
Yeah.
So will we be able worldwide to get away with a kind of mild slowdown?
So I think we do get a mild slowdown now. The negative forecasts that you're talking about were tending to come from the IMF, the OECD. They tend to be quite a long way behind the curve. So the market's long since discounted this sort of stuff. So it's not necessarily going to shift market expectations. But yes, we're getting, I think, a definite slowdown. But I have reasonable hopes that we will stabilise real incomes for consumers by bringing down inflation. And remember, we've just had 2 catastrophically bad years for real wage growth in every major economy. Now, if we can stabilise that relatively quickly by bringing down the inflation rate, that's going to stabilise consumer demand. We get a slowdown, absolutely, but it's not sort of the extreme negative scenarios that some people are worried about.
What do you do with China right now? So we had those PMI figures that is really dragging a lot of markets lower, and concerns about how much copper and iron ore they'll consume.
So I'm always inclined to take survey-based evidence with a big bucket of salt. Survey-based evidence is very problematic. You get partisanship, you get the media cycle influencing it, and so on and so forth. What I think we can say, looking actually at the Chinese data, but also at the Japanese data that came out today, is that there is very clearly this ongoing shift amongst global consumers in favour of spending on services rather than spending on goods. The fanatical desire to go on holiday seems to be still in place.
Yeah.
But
and here to stay?
And I think probably here to stay. I think there has been a shift. This was one of the psychological breaks coming from the pandemic. If you bought a new washing machine in 2021, you're not buying a new washing machine in 2023. If you're working from home, your company is scaling back the amount of office equipment that it's buying. So all of these things are leading to a rebalancing in favour of services and away from goods. And of course, for a goods-producing country like China, that's bound to show up in weaker manufacturing data, and also sentiment, though whether the sentiment actually reflects the underlying activity is a more moot point. We saw that also with the Japanese industrial production data, and within the detail, it is more the export side that we're getting this moderation coming through.
All right, Paul, thank you so much. Paul Donovan, Chief Economist at UBS Global Wealth Management, stays with us, and we'll talk about the U.S. debt ceiling. The deal does seem to be moving forward with a crucial House vote expected later today, so we'll look at how the markets are reacting next. And this is Bloomberg.
young person who might like to have a career like yours, what would you recommend? How can you prepare to be the national security advisor or to serve your government in some way?
The biggest piece of advice I try to give young people is to reject certitude. What I mean by that is that no matter how good you think your argument is, or your policy position, or your proposed course of action, it almost certainly has weaknesses or blind spots, and you should acknowledge those. I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position. Doesn't mean you should compromise your principles or your values, but the easy decisions do not rise to the White House. The hard decisions do. And those hard decisions have two sides that are not 100-0.
News breaks. No one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the debt limit deal struck by President Joe Biden and Speaker Kevin McCarthy heading towards a vote in the House. That's after it cleared a crucial procedural hurdle with just days remaining to avoid a default. Well, we're now joined by UBS Global Chief Economist Paul Donovan, rejoined. So thank you so much, Paul, for sticking around. Is it, I wouldn't call it plain sailing,
No.
but is it now a done deal?
I think so. I mean, you've got to believe that
That's
somewhere,
a very wary, I think
somewhere in Congress there is a tiny iota of common sense. I am weary. It's like reliving the Brexit trauma all over again. This thing just never goes away. But I think, yes, we're going to get lots of shrill voices from political extremists, but I think basically the moderates will get this through.
So what are you looking at for in the next couple of days? Is it, you know, if Kevin McCarthy keeps his job, is it kind of big moves in T-bills in case there's another hurdle, or how they will deal with the debt longer term, which is a whole other issue?
So I think the market will just not pay any attention to the longer-term debt issues because the market doesn't tend to think that far in advance. I suspect that what we're going to see is a little bit of angst around the vote and probably a little bit of a relief rally. But the market, as I said, I think the market essentially adjusted with the weekend agreement. Does McCarthy keep his job or not? I don't think the market cares that much, other than if we're embroiled in yet more infighting in the House Republican Party, then that just delays anything else happening, and any other legislation, you know, you just push even further. We've just wasted the last 2 months, you know, with this whole farce, and now potentially there's another issue that comes up. So that would be a little bit problematic for some aspects.
Paul, you're a very good long-term thinker, and so I don't know whether we spoke to Jamie Dimon, who says, look, he's not really seeing any decoupling from the U.S. and China, although things are much more complex. Does something like the debt ceiling, you know, go to the heart of the issue of what happens to dollar as a reserve currency, even if it takes 10, 15 years?
I don't think so, because at the moment there still is no alternative. We've got to remember the point of a reserve currency is it's where you want to keep your savings as a country or as an international organisation. And so you need liquidity, you need rule of law, you need political stability, you need absence of exchange controls. You also need, you know, large liquid markets. There really is not a viable alternative to this. And actually we're seeing this. You sometimes hear central banks saying, oh, we're going to start doing trade in this currency. But then they follow it up with, because we want to keep our reserves in dollars. So the dollar has still got that primacy as a reserve currency for now. And I don't see that changing in the next decade or so.
Paul, I mean, we're also about to, I mean, June is tomorrow, and that's Pride Month, and I know you do a lot of work at the crosshairs of, you know, economics and diversity and inequality, putting actually numbers onto this. Are we doing much worse in terms of LGBTQ?
We're doing better and worse. So there is, if we look in the States, this year alone, there's been almost 500 pieces of anti-LGBTQ plus legislation in state legislatures, which is absolutely horrendous. On the other hand, there's a strong fight back, and some, in fact, quite a number of these pieces of legislation have been overturned. I think that companies are increasingly recognizing that they want people to come to work and be the best person they can, the best employee they can. You want the right person in the right job at the right time, and that means a diverse and inclusive workforce. And I think this is part of the broader issue of impact economics. Economics is evolving. People now don't just want the latest smartphone, though they do want the latest smartphone. They also want, a sustainable planet, and they want diversity and inclusion. They want equality. They want themselves and their family members to be treated with respect. So all of that is coming together as a gradual evolution of where economics is going. So I think that there are reasons to be positive, but it doesn't mean that I think the LGBTQ+ community can give up the struggle, because struggle they must.
Do you look at it from region by region? I know you do also a lot of, work on labor, labor dynamics and female participation.
Yes, so here we are seeing some improvements post-pandemic, because of course in the pandemic, female participation in the workforce fell. Disproportionately, women were responsible for looking after children's education. They were perhaps in part-time employment where the jobs weren't being kept during the pandemic. Now what's happening, as we move more and more to flexible working, the whole issue of childcare becomes more flexible. So whoever is the principal child caregiver, whichever gender, now has more options available to them, because you can work close to the school at a job you're really good at. You're just doing it from home. You don't have the long commutes anymore. That sort of thing is actually really helping, and we are now starting to see female participation above 2019 levels, which is obviously to be very much welcomed.
Paul, what does this mean for, I guess, economic prosperity? Again, we have a very tight labor market, so the more people come back into work, presumably it takes the edge off for a lot of central bankers.
It takes the edge off some of the numbers. I mean, I would dispute whether we can describe labour markets as tight when we've just had so bad a period of real wage growth. So on some aspects it's tight, on other aspects it's not. But I think what you end up with is a more productive, a more efficient workforce, because you're putting the right person in place without paying any attention to irrelevant details like gender or sexuality or race and so on.
Paul Donovan, just brilliant on a lot of these key issues that we're trying to put the spotlight on. UBS Global Chief Economist there, Paul Donovan. Now, coming up, top officials from the EU and the US are meeting for a second day in Sweden for the Trade and Technology Council. We'll bring you what to look out for next. This is Bloomberg. So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance. Our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, top officials from the EU and the US are meeting in Sweden today for the Trade and Technology Council. They look to strengthen their cooperation on key issues from China to economic security. Now, let's get more from our Europe correspondent, Maria Tadeo in Brussels. Maria, so good morning. What's top of the agenda today?
Yes, and it's a busy agenda, Francine, because remember, this is a bilateral platform that was created between the United States and the European Union to deal with some of the pressing issues and trade, technology, of course, and the cooperation between the two sides. But today, one of the big focus, if I may say, will be China. For many diplomats, as you know, Francine, this is the defining question almost of the century, and just managing this relationship is the key question. Now, we've talked about a lot of de-risking, decoupling. What is the right balance? Yesterday, the U.S. Secretary of State, who is leading the American delegation, said they have a clear line and want to stick with it, and that is focus on de-risk, but do it seriously. Let's take a look.
The United States and Europe, I think, believe that, again, this relationship is an important one, one that we seek to sustain, but with our eyes wide open. And so both the United States and Europe are not in favor of decoupling, but we are in favor of de-risking. And you've heard that from the leadership on both sides of the Atlantic.
So no decouple, but yes to de-risking. Again, the problem is that is a term that everyone is using. You played that interview too with Jamie Dimon. Everyone is buzzing around this word, but when it comes to the actual substance, there's a lot of different opinions in terms of what de-risking means. And you see that play out in this meeting. Some Europeans believe that in a format like the TTC, you should not be calling out China aggressively. It's not the time, it's not the place. The United States wanted something similar to the G7 language, which again mentioned China 20 times and floated issues like economic coercion. It'll be interesting to see today whether there's any references to potential restrictions when it comes to outbound investment and trade from European and American companies going into China. That is seen as the next frontier. But again, this is a very lively debate. What de-risking means in details, that is still up for play.
Yeah, and it is indeed a very lively debate. Maria, thank you so much. Maria Tadeo there with the very latest from Brussels. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Elon Musk has told China's foreign minister in Beijing that the interests of China and the US are intertwined, echoing recent remarks from the bosses of Apple and Mercedes-Benz. The Tesla chief met Chen Gang on his first post-COVID visit to China. Musk is expected to tour Tesla's Shanghai factory later today. Now, North Korea has confirmed that an effort to launch a military spy satellite into orbit failed earlier today. The official news agency reported a rocket crashed into the Yellow Sea after losing steam in the second stage of the ascent. The launch initially prompted missile alerts in both Japan and South Korea. Pyongyang says it will attempt another launch soon. And Theranos founder Elizabeth Holmes has reported to prison to start her 11-year sentence for defrauding investors over the company's unreliable blood testing technology. A federal court convicted Holmes of wire fraud and conspiracy last year, with a final appeal failing last month. The 39-year-old is being held in a minimum security prison near Houston. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg Francine.
Leanne, thank you so much. And let's also have a look at NVIDIA that really had forecasts that blew everything out of the water. Yesterday it was gaining and became a $1 trillion company. Today, a little bit maybe of profit taking, but really it's not much given the general market context, down 1% in pre-market. Coming up, we'll be joined by Morris Reed, partner at global consulting firm Actim. We'll get his views on the debt ceiling and what's happening in the global economy. That's coming up next, and this is Bloomberg.
Like Soros Fund Management CIO Dawn Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman Sisters rather than Lehman Brothers, the world might well look a lot different today.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
China's manufacturing slump deepens in May, further denting the nation's recovery while global stocks and commodities sell off. French inflation slows more than expected in May on lower energy and food costs, a boost for dovish voices at the ECB. The first German state to report also shows a drop. Plus, the U.S. House plans to vote today on the debt ceiling bill after clearing a key procedural hurdle. JP Morgan Chief Executive Jamie Dimon tells Bloomberg he's hopeful it will pass. Be news if he didn't. Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, JP Morgan Chief Executive Jamie Dimon says he's optimistic that a debt ceiling bill will make it through Congress before the U.S. defaults. Well, he spoke exclusively to Stephen Engel a short time ago.
You know, America, the financial system of America, the economy of America, it's still the most prosperous and largest economy the world's ever seen, the most innovative, the most growing, and the rest of the world relies on it. You know, so I think we shouldn't create any instability there. So I wish one day we get rid of the whole debt ceiling thing, but I understand when, it's a democracy, people have different opinions about what we should be doing, and it's just one tool for one party to, get the other party to the table. So I'm quite optimistic there, and I really do applaud the fact that they all sat down and spoke, got something done.
What's your read on inflation, on whether the Fed will go beyond the pause and hike again?
My simple view is that, they're right to pause at this point. It's been a big increase, 500 basis points or so. Take a pause. But I do think it's possible they're going to have to raise a little bit more. That, inflation is kind of stickier. I think people are coming around to that, which means rates may have to go up a little more. People should be a little prepared for that. Just as a matter of manage your own business, be a little prepared for that. Whether you're a financial company or a real estate company, et cetera. I think the other thing I'd be a little prepared for is the volatility that might very well be created by quantitative tightening. We've never really had quantitative easing, which we've had now for the better part of 15 years, and now you're going to see quantitative tightening, and I think the effects may be a little harsher than people expect, but hopefully we'll get through all of that and I'll be okay.
Well, that was JP Morgan Chief Executive Officer Jamie Dimon speaking exclusively to Bloomberg's Stephen Engel in Shanghai. Now, the U.S., it seems, is heading towards a deal to raise the debt ceiling, with Congress weighing up a bill ahead of the vote. Now, while progress is being made, cracks continue to appear in the U.S. economy, with consumer confidence falling to a 6-month low. Well, we're now joined by Morris Reed, partner at global consulting firm Actum. In a previous life, was also in U.S. politics, so he knows the inner workings of Washington. Morris, thank you so much for joining us. Debt ceiling, are we going to get something in the nick of time? Is there any chance that we don't get a deal?
We'll get it, absolutely, because we have to have it. The entire world is dependent on it, and it would be too much pain and suffering, not just for the consumers, but the political class would suffer immensely. So we'll get it done. It'll probably get done Saturday night, Sunday, vote on Monday, but it'll be done by Tuesday.
So who's it a big win for?
It's Kevin McCarthy. He is, in my opinion, he stood shoulder to shoulder with the president and didn't blink. People are surprised that the way he came into office, the fact that he would be able to push this through his caucus, which the White House completely underestimated, which is why they waited so long. So I think that Kevin McCarthy, as you remember, it started at the Big Four, the Big Two, and then it was mano a mano, Speaker and the President. I think he did a great job, and he stood shoulder to shoulder and didn't blink.
But, Morris, at the same time, we're seeing lawmakers from the Republican side calling for him to resign. And I think he was asked about it yesterday, and he said a simple, nope, that's not going to happen.
Right.
Is he going to get internal pressure from having, so-called caved in?
No, I think what you'll see is the fringe elements, right? Both on the Republican side, the crazy right, as we call it, and then the Democratic side, the progressive or the crazy left. Both of them are unhappy, which is always a good sign when both are unhappy. But he has a solid block, and frankly, the Democrats need this to push through. Quietly, and now starting to be louder heard, is Democrats upset the way the White House has handled this, because they feel they've pushed them in a corner where they don't have much wiggle room.
Well, we've spoken to a lot of money managers, like, big private equity, also Science, saying they're always a little bit worried, especially the ones that are not based in the U.S. They're always worried in a U.S. election cycle because you don't exactly know where it ends up with. Is there going to be much more China bashing from both sides?
Absolutely. We're going to see much more China bashing through the election. Also, frankly, the Ukraine situation will go through the election, but that's because what Vladimir Putin people want. But there will be a lot of bashing. With the debt ceiling, this will very quickly move into the presidential election, right? Because Donald Trump will jump on this, and that process will move very quickly. Usually it waits until September. It'll move very quickly on Memorial Day now.
But if we have a debt ceiling agreement, and this is like, locked and loaded, signed before it becomes ugly, are we going to see both sides coming closer on key issues, or no?
Not at all, not at all.
This is just a one-off.
This is a one-off, but it also gives the Republican Party in the House the ability to be more aggressive. They push the president in a corner. You'll start to see them being much more aggressive on some of the border issues, much more aggressive on some of the Hunter Biden issues. They realize that they can block the president's legislative agenda, which is okay for the president because he'll pull back and start to run a Rose Garden strategy where he'll govern by executive orders. So both sides see victory here and some room to wiggle.
But, governing by executive order, is that a bad thing as you get into the presidential election?
No, frankly, it's a good thing when you use the bully pulpit, because as the President of the United States, no one has a larger bully pulpit. So this will work in Biden's favor, particularly if he has a candidate like Donald Trump, who will be extremely focused on the media.
Who's going to be the Republican nomination?
Well, if you looked at DeSantis' disastrous start, he's not ready.
What happened?
I think he just got bad advice. I think that he's a 44-year-old successful governor. In America, as you know, you run to lose to run to win. So he could be setting up the bank shot. But to me, it looks very clear that Donald Trump will be the nominee on the Republican side.
I mean, this is, quite unusual given a lot of the lawsuits against him. I mean, could he actually run? Is there a chance, first of all, that he goes to prison? And can he run from prison?
I don't think there's a chance he goes to prison, but unfortunately, he could be in prison and still run for president of the United States. But I don't think he'll go to prison, but I do think he'll be the nominee.
If there's a Trump versus Biden presidential election, who wins?
I think it's probably lean Biden. There's so many significant people, voting blocs, particularly women, voting blocs against Donald Trump. I think it would be difficult. Anyone else against Biden, maybe it's a toss-up.
Yeah, why is there still such a stronghold from Trump, given everything that we've seen in the last 36 months?
Money matters. Right? He has a strong base of support, and he can raise money at an unprecedented level. So when you can do those two things, you ultimately, in American politics, generally get to the front of the pack.
Morris, we also have Rishi Sunak actually going to Washington next week. He's looking for a U.S. trade deal. Will he get it?
Absolutely not. And they have mismanaged this from the very beginning. What they don't understand in the UK is that the world has changed. You don't go to Washington through the front door to get a trade deal. You look at where the trading partners are working. That means in the States, you build support from the ground up, and then you put pressure on the White House. This is a White House that's been reluctant to do trade deals, and they won't do a trade deal, particularly in a political season, if there's no political backing, no political will. And that's what's lacking. I think he'll go there. There'll be a lot of happy talk, but he certainly won't get a trade deal.
But is this because it's the UK, or is this because also it's a prime minister that's quite weakened?
No, this has been from the beginning. Three prime ministers ago, they mishandled this because they were still thinking that you do it the old traditional way instead of understanding how you really affect change in Washington, which is outside the Beltway, galvanize support, put political pressure, and have the White House to do something for their constituents as opposed to foreign government.
So aside from China bashing, what does President Biden focus on?
Ukraine. I think that this is going to be an overwhelming focus for him. Making sure
more money, more weapons.
Yeah, more money, making sure that he's managing his caucus on the Hill, making sure that the Republicans continue to be, some people are outliers, but most people understand the importance of Ukraine. He's also going to be looking at how this impacts Europe, because if you look at what, as you and I talked in the past, next year is US, UK, and EU. I think we're going to have major change in the UK. I think you're going to look at the EU. They're going to be really consumed by Ukraine because of the inflation, but they also have to worry about being the in between these big, China and America and how they play that just opposed to the relationship long term. So Biden's got a lot of things to worry about, but ultimately I think he has a clear path to victory if he's able to rally key constituencies and not fumble the ball.
But Morris, what about the economy? So if the Fed has to crush the economy to get to the inflation target,
Sure.
Does that scupper Biden's re-election chances?
I don't think it does, but it certainly is going to make it more difficult. No president wants to have inflation going into a re-election, but it has to be realistic about it. And we can't, in America, we don't manage the Fed. The Fed does his own thing. But the president needs to get ahead of this, and he needs to make sure. A perfect example is the fact that he's got this $1 trillion infrastructure project, and none of the money has hit the street.
Right.
So if he really wanted to have a way to fight this, he would push very hard to get money on the street, particularly in the next 18 months.
Yeah, and I guess, as long as jobs hold up.
If job holds up, but if you put $1 trillion to work, jobs will hold up.
Yeah, but then the inflation concern could be accentuated. Morris, thank you so much, as always. Morris Reed, their partner at global consulting firm Actum. Coming up, Britain, famous for its rain. Yes, it is. So why does the UK face a water crisis? We'll tell you why when we return, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Far, the jobs report has not been good news for the Fed.
3.4% unemployment.
That's not the picture Jake Powell thought he'd be looking at.
It really signals an employment market that's chugging along
miles from where the chairman of the Fed wants to be.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
It hasn't been a widespread job loss.
The tightening is yet to show up.
Fed's not going to quit until the labor market quits.
The May Jobs Report, Friday on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Bloomberg has learned that commodities giant Glencore is getting closer to increasing its offer for tech resources. In a move aimed at ending the battle for the Canadian miner, Glencore is seeking to force Teck to the negotiating table with an improvement to its $23 billion bid. Teck patriarch Norman Keevill's super voting shares gave him a veto on any big decisions. Keevill has so far strongly opposed the deal. Now, Nvidia's market valuation fleetly crossed the $1 trillion threshold after the chipmaker's AI prospects vaulted it into an elite club of just 5 American companies. Alphabet, Amazon, Apple, and Microsoft are the only others to have trillion-dollar valuations. Fewer than 10 companies globally have ever achieved the distinction. And Microsoft's fight with the UK over its takeover of Activision Blizzard has received a boost after a judge said the US software giant's appeal can start earlier. The UK antitrust regulator, which has blocked the $69 billion deal, had wanted to delay the hearing until later this year. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Leanne, thank you so much. Now, Britain, famous for its rain, but now the UK risks becoming a cautionary tale of how developed countries can squander one of its most important resources. Now, a fifth of Britain's water supply is lost through leaks. And now the situation is actually being made worse by climate change. So let's find out more. Bloomberg's Olivia Rutgard is here with the very latest. Olivia, good morning. Thanks so much for coming on. You wrote a beautiful piece on this, important piece that we're also pushing out on social media. We have a water crisis in a country that's long been associated with soggy weather and an abundance of water. So how did we get here?
Yeah, so probably the first thing to say is that Britain is a bit less soggy than people might imagine. So
it doesn't feel like that.
I know, it doesn't, does it? But certainly in the southeast, London, where we are now, you know, we get less rain than parts of the Middle East, parts of Africa. People might be really surprised to know that. So there's an existing issue there. And then in terms of the kind of ongoing issue, there are two ways you can think about it. There's the supply side, there's the demand side. So in terms of demand, people actually use more water in this country than they do in a lot of Europe. So it's about 150 litres a day, which is more than the European average of about 120.
Do you know why?
It's partly because I think people don't think about water as
Scarce.
A scarce resource, exactly. So I think that's part of it. I think probably some of it comes down to the weather. We do get cold winters, so maybe we're taking long hot showers in a way that, you know, say if you live in Spain or somewhere like that, you might not. But I think leaks also come into it as well. So as you said in your intro, about a fifth is lost through leakage. So that has a big impact on the demand levels as well.
So Olivia, what does it take to actually fix this broken system?
So I think it's fair to say priorities have changed. Some of the water industry regulators are sort of waking up to the issue a little bit more now. So there's a big program of investment coming through. We need more reservoirs. We need more water transfers from the west, which gets a bit more rain, over to the drier, more heavily populated east. And also, you know, some of those water-saving methods at home, so soakaways, so that we can flush our toilets with grey water and things like that, better building regulations, building standards, and easier planning for things like reservoirs, which have been blocked. So there's a big program of investment coming through. Unfortunately, bill payers will pay for it. The industry is privatized, so it's going to come through to the consumer, which is not great timing.
Yes, I was going to say, how much is it the responsibility of private companies, and how much is it the government? Like, who do you blame for this?
Yeah, so I think ultimately the private companies they're sort of contracted out, and they're regulated by the government to provide the services. So the way it works is the water companies sort of have to apply to their regulator Ofwat to say, can we charge our customers this much? And then we plan to put this much money into investment. And I think what's been happening over the past few years is the signals have just been wrong. The signals coming from government and from the regulator have been, let's keep bills low, the status quo is fine, and there hasn't been enough making things fit for the future and thinking about that big future risk from climate change.
And Olivia, is this a real template for other countries when you look at the UK and you think, I mean, maybe it's the wrong perception, but because the UK has plenty of water, also because it's an island, does it make other countries think twice about how they manage this gorgeous resource?
Yeah, I mean, I think Britain has been a little bit more, has thought about it a bit less closely than, say, somewhere like the Middle East. So if you look at something like desalination, there's a lot of that goes on in the Middle East. If you look at California, they're very aware of their water stress. So, I think in a way, like, Britain is kind of a victim of its weather patterns and the fact that it hasn't had this long history of water stress that other places have. So, it's probably a cautionary tale in that sense for maybe parts of Europe, because I do think that this is probably an undervalued issue in other parts of the world as well.
All right, Olivia, thank you so much for some great reporting. Olivia Woodgard there on water in the UK. Now, we'll be covering all things UK every week on Thursdays at 9:30 a.m. London time, also in our half-an-hour UK special. Coming up, we take a look at European inflation figures with CPI readings from France and German states. Also, Italy's due shortly. That's next, and this is Bloomberg.
For a young person who might like to have a career like yours, what would you recommend? How can you prepare to be the national security advisor or to serve your government in some way?
The biggest piece of advice I try to give young people is to reject certitude. What I mean by that is that no matter how good you think your argument is, or your policy position, or your proposed course of action, it almost certainly has weaknesses or blind spots, and you should acknowledge those. I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position. Doesn't mean you should compromise your principles or your values, but the easy decisions do not rise to the White House. The hard decisions do. And those hard decisions have two sides that are not 100-0.
critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, big day for European inflation data. We've had France and several German states give CPI readings this morning. Italy also reports their CPI data in about 10 minutes as the country's central bank governor delivers a speech today. Well, joining us now is Bloomberg's Oliver Crook in Berlin, Chiara Albanese in Rome. So let's start with you. Ollie, when you look at some of the important inflation data, they're all pointing to the same thing, is that there's actually a slowdown in inflation overall.
Correct, and that's what we've seen this morning out of many of the German states, namely North Rhine-Westphalia, which is the biggest state in Germany. It's about the size of the Swiss economy, so we're going to take a look at that, breaking it down a little bit to see kind of where the inflation came through. So the good, the bad, and the ugly. Well, let's start with the ugly first. Food and beverages still up 15%. That is down from 17%, however. So that is, we can call that improvement. But however, you look at alcohol, tobacco, you look at leisure costs. All this stuff is still being supported. So the services side of the economy, people are still spending money, still elevated at around 10%. However, for the good, you go to the energy sector, up only 0.8%, which is great. And then down from the transportation side, it actually is the only category that year on year has gone down. And that is because the German state has rolled out this month the 49 euro ticket, which has sort of has a disinflationary impact, which is a subsidy to all train travel. However, starting next month, you'll get the base effect from last year's 9 euro ticket, which was a massive subsidy. So you're going to see that bringing the inflation right back up in June.
So, Ollie, when you look at recessionary prospects for Germany, how's the job market holding up?
Yeah, so we've had some pretty bad data in a lot of the German economy. We've had PMI that's been in contraction since July of last year on manufacturing side. Industrial production is not great. GDP, as we know, last week we went into recession. However, the job market has held up. We just got jobless claims today that were stronger than we had anticipated, only 9,000. The unemployment rate has stayed at about 5.6%. So really the question is, will we be able to get a substantial kind of reduction in inflation while this labor market is still holding up? IFO, however, out with a survey yesterday saying that real estate firms and housing firms are considering job cuts. So they may not be coming in, but they're thinking about it. And they're also saying that in the services sector, which has upheld a lot of the economies throughout Europe, we're seeing that there is confidence diminishing there. So perhaps the labor market softening in there as well.
Ollie, thanks so much. Oliver Crook there in Berlin for us. Chiara is our Italian politics expert. So, Chiara Albanese, when you look at the inflation prospect in Italy, how different is it from other European countries?
Well, thanks, Francine. Clearly, inflation in Italy continues to be an issue, but at the same time, the economy is also doing quite well. We had the economic data today, which came through slightly better than expected, and that continues to be favorable to the government and to Giorgia Meloni. Again, today, the Bank of Italy governor, Ignazio Visco, he's outgoing out of his mandate. He's delivering his final annual speech, and clearly having a strong economy, even in spite of a quite high inflation, allows for some leeway in terms of the policies that are going to be taken, and also investors' confidence that the government continues to more or less keep the big mammoth debt that Italy has under control.
So, Chiara, first of all, who's likely to replace Ignazio Visco? And is this really going to be the most important appointment for Giorgia Meloni?
Well, Giorgia Meloni clearly has all eyes on her in making this choice. She still has a few months before she will decide. So a few names have been touted, but we're nearly not close enough to really have a short list of names. But the political debate is going to be furious around that topic. Now, that will be a defining appointment that Meloni will have to make, and she will definitely have to make sure that she's able to control the pressure from political parties and stakeholders in the choice.
All right, Chiara, thank you so much. Chiara Albanese there in Rome, of course, one of our star politics reporters. Now, let's also take a look at some of the things that the markets are watching out for today. As we've been discussing, we have a host of inflation data from across Europe, including a provisional reading of Italian CPI for May. That's at 10 a.m. UK time. At 1 p.m., we'll get a provisional reading for Germany CPI. 3 p.m., it's U.S. JOLTS, job opening releasing for April. And then at 7 p.m. UK time, the Fed publishes its latest beige book, giving insight into economic conditions across the U.S. Well, Bloomberg Surveillance Early Edition continues in the next hour with Kriti Gupta in New York, Anna Edwards here in London, and this is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. One step closer. The U.S. House plans to vote today on the debt ceiling bill after clearing a key procedural hurdle with just days remaining to avoid a default. China's economic recovery weakened in May, raising fresh fears about the growth outlook. Calls are rising for more central bank action to counter the downturn. Plus, an exclusive with Jamie Dimon. JP Morgan CEO talks China, the debt deal, and his long-term future beyond leading the banking giants. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. And Kriti, it seems that the weaker sentiment coming out of the Chinese data print weighing on investor thinking this morning here in Europe.
Yeah, now that you have the debt ceiling potentially out of the way, look, it's not a done deal just yet, but potentially out of the way, it feels like the market isn't necessarily diving into that relief rally that a lot of people expected for the exact reason, Anna, that you mentioned. Some of that sentiment that you're seeing in Europe perhaps folding over into the United States as well. We're not looking at S&P futures this morning. We're looking at NASDAQ futures, which I should say are rising at about the same margin as S&P futures. And that is important because breadth is an issue in this market. Futures, NASDAQ futures lower by about 0.2%. Well, again, it comes down to breadth because a little fun fact from our markets extraordinaire producer, Dan Curtis, Anna, get this, we are at the worst breadth when it comes to market gains for the S&P 500 on the month, going all the way back to 1989, which really speaks to that tech leadership. And that's why the NASDAQ futures contracts are, I would argue, a little bit more important than S&P futures simply because of that tech outperformance we've seen in the last few days and weeks. Blame AI, blame the defensive positioning. We'll dive into all that. But what you need to know is they are down about 0.2% as well. The 10-year yield down as well, only by 2 basis points, though. The bond market catching a little bit of a bid. So you are, again, seeing that defensive positioning show up in the bond market, again, based on those growth worries. And a similar trade is showing up in the dollar as well, stronger by about 0.4% on the Bloomberg Dollar Index. Again, if you're concerned about recession around the corner, Anna, you're going to see that show up in commodities. And NYMEX crude, again, trading below a 70 handle, 69.06 on that contract, down about 0.6%. But to your point, it really does all kind of come back to the Asian story. And that's really where this kind of low risk sentiment really kicked off overnight. You saw that not only in the Chinese markets, but in the Japanese markets as well. The Nikkei down about 1.4% overnight. The Hang Seng really taking a tumble down, just shy of 2% there. Remember, the Chinese stock markets have been on that cusp for a bear market for a while, really keeping an eye on that. But again, it's showing up in the currency market as well. This is a cross-asset global story, Anna. Dollar yuan, you are seeing the weakest levels on the offshore yuan that you have seen in about 12 months. So you're seeing 7.12 on that exchange rate. And again, some weakness in the Japanese yen as well, down about 0.1%. Interesting, Anna, to see Japan, China, and now U.S. futures all on the same page this morning.
Yeah, absolutely. And here in Europe, we've got negativity to report as well, Kriti. So this is the risk-off picture for European stocks. Off earlier lows, though, if I can add that slight element of positivity into the mix. But we're down by 0.1% or so in London, 2 or 0.3% to the downside over in Germany and in France. And we have weakness then across European equities. We are seeing selling of stocks and buying of bonds, buying of the dollar, those big themes dominating trade today. But not too much selling now on equities. I put in euro and the German 5-year yield as we've got some interesting rethinking going on around the inflation story in Europe and what that means the ECB will have to do. We're seeing traders pull back their expectations for just how much hiking we'll get from the ECB, and all of this on the back of data that's come out from various parts of Europe that has been better than expected. So that's lower than anticipated in terms of the inflation prints. That was the case in all of the German regions we've heard from. It was the case in France. It was the case yesterday in Spain. It was not the case in Italy, though. The Italian inflation rate just coming in at the top of this hour fell to 8.1% in May. The estimate was for a drop to 7.5%. So moving in the right direction, not as much as had been expected, though. Germany's Saxony, that regional number, though, keeping with the trend. Prices month on month falling by 0.3%, and the prices year on year rising by 6.5%. So once again, we're seeing there this trend of inflation prints coming in lower than had been expected. So that means the ECB maybe doesn't have to hike so much. Here's SBB. That's what we call it when we certainly can't attempt. Our Swedish is not quite up to managing to pronounce the entire name of this real estate business over in Sweden at the heart of the real estate issues that we're seeing there. And we've seen a parent business of this company, or a parent business of this company, has managed to miss one of its debt payments. It's not a default. This is a hybrid instrument, so this is flexibility they are able to have, but it didn't mean good things for the stock. And Brent crude down by 0.6% this morning on the back of a decent drop yesterday, 4% weaker on WTI in yesterday's session, Chrissy.
Certainly something we're keeping an eye on. I admire you for sticking with the SBB. I wouldn't even want to admit that I couldn't pronounce or even try to pronounce the Swedish real estate company. We thank you, as always, Anna, for that update. Let's talk a little bit about the macro story when it comes back to stateside, because, look, we're not over the hurdle yet, but we're almost there. The debt limit deal struck by President Biden and Speaker Kevin McCarthy is heading toward a vote today in the House. In a Bloomberg exclusive interview, JP Morgan CEO Jamie Dimon says he's hopeful it will pass.
So I wish that one day we get rid of the whole debt ceiling thing, but I understand when, it's a democracy, people have different opinions about what we should be doing, and it's just one tool for one party to, get the other party to the table. So I'm quite optimistic there, and I really do applaud the fact that they all sat down and spoke, got something done.
Joining us now, Bloomberg senior editor Bill Ferries, who formerly covered Washington for years. Bill, how confident are we that this is a done deal? For our international audience, talk to us a little bit about the developments from last night.
Well, everything's certainly headed in the right direction. I mean, you have the Speaker of the House, Republican Kevin McCarthy, and the top Democrat in the House, Hakeem Jeffries, basically scheduling the vote potentially as early as Wednesday evening. That signals confidence that they're going to get it through, even as they acknowledge that they're going to lose people who are essentially to the left of President Biden and to the right of Speaker McCarthy. They just don't believe that will be a critical mass able to stop passage. Then it goes to the Senate, and there each individual senator has a lot more influence over whether this passes or not. Everything looks like it will pass, but I think this could still very well go to the last minute. I mean, we're talking about a Monday deadline for the U.S. to hit the debt ceiling. It wouldn't surprise me if this bleeds into the weekend, if this perhaps final legislation goes to President Biden's desk on Sunday. But everything points to this heading towards the conclusion I think markets and most lawmakers would like to see.
Yeah, with cameras trained on Washington, then, Bill, there's still time for some lawmakers to want to make a noise, isn't there? In terms of what happens from here, is Speaker McCarthy's job now at risk, given the frustration that we've seen among some Conservative members of his party?
Yeah, there's definitely members on the right who are really frustrated at how this agreement was reached and what the terms are on some of the really difficult issues. Kevin McCarthy, it took 15 rounds of voting for him to become Speaker. But during those 15 rounds, there was really no other viable candidate. So the problem Republicans who are opposed to McCarthy have is that they would have to replace him with someone. There is no candidate for that job right now. So I think for right now, unless he makes other decisions in the coming months or over the next year or so that really frustrate a bigger group of conservatives, I think his job is likely safe for now.
Bloomberg's Bill Ferries keeping us up to date on the minute-by-minute developments of this debt deal. Again, we are almost there, but not quite. We thank you as always. And of course, in the absence of that finiteness, for lack of a better term, you are starting to see the market really pivot to the other major story, which is China. China's manufacturing activity contracted for a second straight month in May. It's more evidence that the post-COVID recovery has slowed in the world's second largest economy. For more, let's bring in Bloomberg economist David Chu. David, what's your reading on the latest data set here? Just how much trouble is not just China, but the global economy in right now?
Yeah, I think so. The data today showed us that the recovery is losing some steam, especially in the manufacturing side, as we have seen the manufacturing PMI in the contraction territory for 2 consecutive months. And that means that because the manufacturing sector has been the major engine for China's economy during the past 3 years in the pandemic period. But now it seems that it's losing steam. On the other hand, we have seen the servicing sector related to travel and the catering, and all the sectors related to the reopen the economy are still strong. But at the same time, the housing sector is sending some worsening signals, especially with the indicators, the sub-indicators in this sector is still in the contraction range.
Okay.
That tells us that the recovery is not balanced. So we still have a lot to do.
Okay, yes, so important data set then being released today on China. David, JP Morgan CEO Jamie Dimon spoke exclusively to Bloomberg earlier at the bank's Global China Summit in Shanghai. Let's just have a listen to what he had to say about the China-US relationship.
Over time, yeah, there'll be less trade. You know, it'll take years for these things to take place, but it won't be a decoupling. And the world will go on.
So not a decoupling, he says. The focus, of course, is on de-risking. That's the language that's being used now by the US administration time and time again. What do you think the Chinese government wants to do on this particular front then?
Yeah, definitely China benefited a lot from the globalization and the increase in global trade. So that definitely China wants to keep the door open for global trading. But on the other hand, you know, geopolitical things have become more and more tight than before. So I think it is a more realistic way for China to seek more support from the domestic market for the growth in the future. So I think China is the government is already doing something to boost the domestic consumption. But to be honest, it won't be easy because if you look at China's GDP, the domestic household consumption takes merely below 30% of the GDP, and the government side and the investment side takes more than 60%. So that it means that there must be some structural reason that weighing on the consumption. So it means that the government has a lot of things to do to release the power of the consumption.
David, thanks very much. David Chu, Bloomberg economist there in Hong Kong for us. And now let's pivot from the Chinese economic story to some macro data out from Europe today. It's a big day for European inflation data. France slowing more than expected on the inflation front. Italian inflation coming out higher than expected. Several German states give CPI readings this morning, and we've got most of those, and they've all come in slower in terms of inflation than had been expected. And we get the national reading later on today. Let's get now to Bloomberg's Maria Tadeo in Brussels. Maria, take us through some of the data here, because if we look at Spain yesterday, France and Germany, we get quite a clear picture.
Yes, and it may be pointing to a cooler summer of all things. When you look at the data that came out today from the French economy, you see again this deceleration in prices. The finance minister, by the way, saying and telling the French radio that prices are in fact coming down fast. The central banker also suggesting perhaps inflation now past peak in the French Republic. When you look at the Spanish numbers that came out yesterday, a lot of people focus on Spain as a forward-looking indicator, also significantly cooler for May. Germany, again, we don't have the full number, as you said at the start of the show, but the numbers that we see so far may point again to cooler inflation too in the biggest economy in the euro area. Italy, a little bit of an outlier as it is at times. Growth was better than expected. Inflation did cool, but not by as much as expected by economists. A lot of this, Anna, now provides a picture, or could provide a picture for the big euro area number that we're expecting tomorrow on Thursday. Now, if you put them all together, you could believe or suggest that, again, this cooler inflation will be reflected on the overall number, and tomorrow there could be some relief for the ECB if indeed that manifests in the broader euro area number.
Maria, what does that mean for the ECB, especially in light of the potential changing of the guard we might get over at the Bank of Italy? Put this into context for us.
Yes, and look, whether or not there's a new governor in the Bank of Italy, I doubt very much that it will change the impressions that we hear from Visco, who is the governor of Banca Italia at the moment, who has said, yes, of course, we need to hike rates. Inflation is an issue, but also not be too abrupt to strangle the economy. Now, beyond that, when you look at the European Central Bank, we know that they will continue to hike rates. They have said that clearly. When you listen to the words of Madame Lagarde, you know there's more to come. come, but it's also clear that they have entered the final stage. The question is by how much? When you see the numbers today, you see that reaction from the market already pared back that cumulative 50 basis points bet. And of course, there is a decision expected in 2 weeks' time from the ECB, the June meeting. I cannot believe we're in June, by the way, already this fast. But of course, the focus will be on the downshift to 25 basis points already done. What comes next?
Okay, not quite. The 31st of May. I think, Maria, but almost in June. Your point is well made.
Every day
Where did
counts.
that time go?
Every day counts.
Every day counts. I'm not saying goodbye to May that easily. Maria Tadeo, thank you very much with the latest on the inflation prints out of Europe there in Brussels. Now, coming up, we will speak to the economist Sarah Kewen of Standard Chartered and FX strategist Jane Foley of Rabobank. Lots to talk about the Chinese growth engine, about the inflation prints coming through in Europe. Lots to discuss, plus more from our exclusive interview with Jamie Dimon as he hints at life after JP Morgan.
I love my country, and maybe one day I'll serve my country in one capacity or another, but I love what I do. I think JP Morgan do a great job for helping Americans, for helping countries around the world, and this is my job.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Look, one of the big questions here is now that kind of this easy monetary policy era is in the rearview mirror, what does that mean for the credit markets? You have a little bit of tightening there, but yet you've had a lot of folks perhaps come to market, not just here in the States, but in Europe as well. For our radio audience, bear with me. We're looking at a chart here, a bar chart of total May issuance in billions of euros for the European bond market. Now, we've seen issuance really boom, the highest amount of deals going all the way back to 2020 when we did have that easy monetary value. I wonder what that means. Is that a signal that a lot of corporates, a lot of kind of funds are perhaps making that dash for cash before things get even tighter? Or is there something else to it? Let's bring in a true expert here. Donna El Baltaji, one of our markets editors, joins us with some clear context. Donna, what are we looking at here? What does this really mean?
So we're looking at two things. One, we're seeing issuers that are finally come to terms with the fact that you've got to sell when the market is ready for you to sell. So you can't wait for better pricing. What you really have to wait for is for that cash to be ready to be deployed by investors. And from the investors' point of view, what we're basically seeing is that they are understanding that with the risk of recession on its way, that these very high rates might not last forever. So if you can lock in those rates now, you're probably set for a few years.
So that's interesting. That's driving things on the investor perspective. Dana, good morning to you. But in terms of these corporates, you say that they've learned they've got to sell when they can, sell their debt when they can. But there's also perhaps a window here before we see a lot more T-bill issuance. Is that something that's going through these treasurers' minds when they think about when they raise money?
Oh, absolutely. I mean, we're basically expecting a flood of these T-bills, and what that will basically do is that will raise borrowing costs, not just in the U.S., but around the world. And when you have that, plus central banks that are also raising rates, the hit on borrowing costs can be significant. So for that reason, it's a good deal for the issuers, but it's also a good deal for the investors themselves. Bear in mind, though, the summer is on its way, and in the summer, everything slows down. So you got to sell when you can.
Okay, Dana, thank you very much. Dana El-Battaghi joining us there with the latest on credit markets. And for more market analysis, check out MLIV Go on your Bloomberg terminal. This is Bloomberg.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very carefully.
Nobody covers business like Bloomberg, your global business authority. The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. We're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Breaks. No one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength
on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. North Korea has confirmed that an effort to launch a military spy satellite into orbit failed earlier today. The official news agency reported a rocket crashed into the Yellow Sea after losing propulsion in the second stage of the ascent. The launch initially prompted missile alerts in both Japan and South Korea. Pyongyang says it will attempt another launch soon. Elon Musk has told China's foreign minister in Beijing that the interests of China and the U.S. are intertwined, echoing recent remarks from the bosses over at Apple and Mercedes-Benz. The Tesla chief met Qin Gang on his first post-COVID visit to China. Musk is expected to tour Tesla's Shanghai factory later today. Theranos founder Elizabeth Holmes has reported to prison to start her 11-year sentence for defrauding investors over the company's unreliable blood testing technology. A federal court convicted Holmes of wire fraud and conspiracy last year, with her final appeal failing last month. The 39-year-old is being held in a minimum security prison near Houston. Goldman Sachs is said to be considering another round of job cuts as the deal-making business remains slow. Sources say the third round of cuts will affect less than 250 people and will include the firm's more senior employees. Earlier this year, it had eliminated about 3,200 positions, embarking on one of its biggest rounds of job cuts ever. Anna, things are really heating up in terms of the cost efficiency story now on Wall Street. It felt like those rounds of job cuts that you saw among perhaps junior bankers, even mid-level managers, wasn't necessarily going to seep up to the higher levels. But Goldman Sachs, Lazard, even First Republic, although that was a more micro story, really feeling the pains across all ranks.
Yeah, absolutely. We've been seeing this within investment banking for some time, haven't we? From other banks and also from Goldman Sachs. And we heard at the beginning of the year a big round of cuts over at Goldman Sachs. This time, to your point, Kriti, things are going higher up the food chain. More senior, it seems, are the people who are going to be going this time, but fewer in number. So not the sort of thousands this time around, maybe 250 or so people. But of course, we'll continue to monitor these stories carefully for you. Coming up, we'll get back to the macro themes, though. Sarah Kewin, head of research for Europe and Americas at Standard Chartered, joins us. What is her thinking? What is her team's thinking around where the Fed heads next? What is in the driving seat? Is it the Fed? Is it the debt narrative still? We'll also talk about some of the data coming out of Europe today. Really interesting the way that the inflation prints have almost consistently come in below expectations. What does that mean for the ECB? This is Bloomberg.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live. And it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
A multi-trillion-dollar industry. There's a lot of ground to cover.
A record year of growth, hand over fist all year.
We're just getting started.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. One step closer, the U.S. House plans to vote today on the debt ceiling bill after clearing a key procedural hurdle with just days remaining to avoid a default. China's economic recovery weakened in May, raising fresh fears about the growth outlook. Calls are rising for more central bank action to counter the downturn. Plus, an exclusive with Jamie Dimon, JP Morgan CEO, talks China, the debt deal, and his long-term future beyond leading the banking giant. I'm Kriti Gupta in New York with Anna Edwards in London. Anna, a lot to digest here, but it very quickly feels like the narrative shifted from debt ceiling panic now to Chinese growth panic. What are you seeing in Europe?
Yeah, absolutely. We got the data from May, didn't we, for the Chinese economy, and that gives us substantial insight into the second quarter in China, the world's second largest economy, and things not looking as rosy as had been expected there. Certainly on the manufacturing side, although that is a bit of a global story, but certainly on the manufacturing side, that disappointed in China, and that weighs on sentiment here in Europe. We're off earlier lows, if I can add that little area of brightness, but still we're down by 0.2% on the Stocks Europe 600. Here in Europe then, Chrissy, we've had some really interesting inflation data coming out from Spain yesterday, to France today, to the German regional data. We get the national data from Germany later on. All of that adding up to a reassessment of just how much hiking we're going to get from the ECB, because all of the data suggested some work has already been done in bringing down inflation rates. Italy was a little bit different, but leaving Italy aside, we see that reassessment taking place, and the euro down at 106.70, down 0.6%, and we see those bond yields are falling 8 basis points or so on that 5-year bund, but certainly that is the direction of travel that we have here. Brent crude is interesting as well, thinking of deflationary forces. This is being weighed on by that sentiment out of China, then, Chrissy, down by 0.8% on the oil price, and that follows a big 4% retreat in WTI yesterday. A lot of concern about demand for these commodities.
Yeah, it's going to be, I think, a rising concern, Anna, as we talk again about those recessionary concerns. How quickly does that inflation story that we are still battling, by the way, on the monetary front turn into the R word? And I think a lot of that concern is coming out of Asia. To your point, Anna, something that's, to your point, again, driving the European story. Well, sentiment is kind of seeping into the NASDAQ futures as well, which is interesting because buying big tech has been the trade du jour over the last, I want to say, 7 to 10 days or so. NASDAQ futures right now, though, taking a little bit of a breather, down 0.2%. And I should say, even on the micro front, you're seeing that in, for example, NVIDIA shares, even in the pre-market, taking a little bit of a breather alongside all of the names that have really been catching a big bid in the last 10 days. The 10-year yield also dropping a little bit to the tune of about 3 to 4 basis points. Look, it's important to note that the bond market is catching a bid, despite the fact that the debt ceiling deal isn't 100% through. So really keep an eye on that kind of relationship between the stock market and the bond market, or I should say the lack thereof, Anna. The bond market, though, if you're seeing a defensive play there, is showing up in the FX market as well. The Bloomberg Dollar Index stronger by 0.3%. The positioning is going to be crucial here. We're going to talk about that with Jane Foley in just a few minutes. And of course, NYMEX crude, to your point about the commodities trade, we're coming full circle. 68 handle on that contract, Anna.
Yeah, 72 handle on Brent. Let's think about where we go on the global growth story. Sarah Hewin joins us, head of research for Europe and the Americas at Standard Chartered. And let's start then, Sarah, with the data we had out of China and what that has done to add to your understanding about the weakness in growth, in particular in manufacturing, and crucially, what can be done about it, or who you would look to try to do something about it.
Yes, it's very clear. Particularly the heavy industry manufacturing is doing worse than expected. The PMI data came in below expectations. On the non-manufacturing side, I think we saw some positive signs, particularly for hospitality. So consumption for services seems to be holding up pretty well. Perhaps a little bit more optimism on the construction front as well. But clearly, manufacturing is soft, and the export outlook as well seems pretty bleak. Overall, it's not a great picture, although we are seeing, as I say, some recovery in consumer spending on services, albeit potentially at the expense of spending on goods. What happens to policy from here? We're still somewhat cautious about expecting further policy easing. There is already a fiscal stimulus in place. I think that Beijing is anticipating that there will be more momentum going forward, but they will be watching very closely what's happening to consumer sentiment, which remains very sluggish in the face of still high unemployment, particularly amongst younger people in China.
Sarah, connect the dots here for us, because I think it's been a couple of years now where we've really seen the monetary policy story shift between, say, the PBOC and the Federal Reserve, and arguably the ECB somewhere in between there. That shift that you start to see between the two major economies in the world, or the two largest, I should say, do you start to see them kind of coming back together, the PBOC and the Federal Reserve perhaps joining together to become on a more stimulative page?
Well, certainly for the Fed, our view is that we're at the peak in rates in this cycle, and that the next move will be for rates to come lower, potentially later this year. So I think it's perhaps too early to talk about stimulus from the Fed just yet. We are still getting some pretty punchy inflation numbers. The jobs market is still very strong in the US, and that needs to shift before the Fed will be comfortable with, confirming that they're on hold, let alone before they start to cut rates. But we do think that we'll have a slowdown in the economy later this year, unemployment starting to rise in a meaningful way, and despite the latest core PCE deflator coming in above expectations, we think that inflation pressures broadly are on a downturn. We're watching very closely what's going to happen to average hourly earnings this Friday with the employment report. They obviously sort of picked up more than expected in April, but if we get a return to what we saw in the first quarter, then that sort of earnings growth is consistent with inflation moving back to target. So it does open the door, in our view, for the Fed to start to cut rates around the turn of the year, in which case you'd see accommodative policy from China, policy staying restrictive in the US, but moving towards a more accommodative stance over the course of the next couple of years.
And Sarah, so that's on the monetary side. Let's talk about the fiscal side specifically. We've kind of gone over a little bit of the details of the debt ceiling here, and essentially the cap on fiscal spending for the next 2 years, although I should mention defense spending is actually going to increase. Sarah, over the next 2 to 3 years per se, what is the bigger factor here? The debt agreement or the fiscal budget in the U.S., or perhaps the geopolitics and the domestic spending from the Biden administrations? What factors as a bigger role into U.S. GDP?
Quite honestly, all of the above. But if we take them each in turn, then agreeing the debt ceiling and agreeing that will be sustained through the next year or so and beyond the next election is going to be positive in terms of sentiment. We did have some hints that consumer sentiment had suffered as a result of the uncertainty over the debt ceiling. So an agreement, assuming that does go through Congress today and by the weekend, then that's positive for sentiment. There is a fiscal squeeze in place. Consumer spending, government spending, discretionary spending is going to drop back to 2022 levels. Now, bear in mind, of course, that as a share of GDP, that will still leave government spending higher than it was in 2019. We have had a big run-up in government spending through the pandemic, so not all of that is going to be going away. We may see later this year some further headwinds as a result of the agreement on restraining spending, and that may well coincide with a period when we have softer economic activity generally. Over the next couple of years, then I think that the sub geopolitics will probably be in focus.
And Sarah, a word on the ECB. Has your thinking been informed, shifted at all as a result of the inflation prints we've had over the last couple of days from Spain, from France, from the various German regions, all coming in below estimate?
Yes, it's moving in the right direction. To an extent, seems to be down to food inflation moderating. It's still high, but moderating more than expected. We would be cautious about reading too much into 1 month's figures, of course. Our own view on the ECB, though, is that we don't think they're going to be raising rates as much as markets expect from this point. There was a clear signal from Lagarde that they still have more to do, but we think that by the summer we will be getting further indications of moderating inflation. The real uncertainty is what's happening to wages, and we know that that's where policymakers, both in the US and in Europe, are concerned that we enter a wage price spiral. Maybe there's more concern still on that in Europe than there is in the US, which is why we think the ECB still has more work to do, whereas we think the Fed has probably done enough.
Okay, more hiking still to come then. Thank you very much, Sarah. Standard Chartered's Sarah Hewitt joining us there with the latest on various economies around the world. Coming up next, we'll talk to Jane Foley, Head of FX Strategy at Rabobank. We'll get a perspective on currencies next. This is Bloomberg.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
The This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Look, we're talking about growth all of a sudden, and the best way to look at where people are really thinking about this is in the FX market. There's really no place to hide in this particular asset class, which brings me to a positioning story I want to bring to your attention. Anna, we are looking at specifically just this bet into the dollar. Now, this kind of made sense as we were talking about the debt ceiling debate, the idea that in this kind of potential global catastrophic doom and gloom scenario of the U.S. defaulting, why not buy America as kind of this defensive trade, the irony, the paradox of that. Nevertheless, you are starting to see a lot of folks really be long dollar when you look at speculative positioning. But the question is, in a decelerating growth environment, is that still the trade? Let's get a little bit of expertise here. Joining us now is Jane Foley, head of FX strategy over at Rabobank. Jane, talk to us about this dollar positioning. If we're worried about Chinese growth momentum kind of declining and that really accelerating the recession that we've expected to be around the corner for the last few months, arguably years, is this dollar trade something that makes sense?
Oh, absolutely. In fact, there's pretty good inverted relationship between the dollar and high-risk assets, say emerging markets equities, for instance. And the reason being is that, if you really want to buy risk, well, you generally sell the dollar and vice versa. And of course, right now, we're facing quite a lot of headwinds. First of all, the Chinese growth story, clearly that's been a major disappointment this year. At the start of the year, there was so much optimism about the outlook for China, that rebound story from the COVID lockdowns. That is disappointing. On top of that, there's the risk of US recession. And of course, for the Eurozone, well, there's a likelihood that they're facing stagnation in the second half of this year. So you've got a pretty disappointing outlook for growth, not an environment where you really want to be piling in en masse into high-risk assets, and therefore the dollar is likely to do well in this sort of environment.
So a lot of headwinds, Jane. I'll pick up on the European one there. Stagnation in the second half of the year, you say, perhaps. We've seen, of course, recession in Germany, other parts of Europe perhaps managing to avoid that fate just yet. What are you expecting to see in terms of the euro then, and how it trades through that?
Well, the euro is approaching all of these headwinds with the market position really quite long. And, the euro had a really good run, say, from around October last year, right up until a month or so ago. And this was built around, the hawkish story from the ECB, which now is come to an end. We're seeing the market pricing out some of those last bit of tightening. But also the Chinese story plays into the European recovery story, or it did, because, China is Germany's largest export partner. And we've heard, China or Chinese consumer, they're buying less goods, a little bit more in services, but less goods. They buy a lot of German cars, a lot of German machinery, etc. So that feeds back into disappointing Eurozone story. And certainly last week, if we looked at those PMI data, the new orders for the manufacturing sector in Germany, they were really very disappointing. So we've got the market positioned long on the euro. And what have we got now? Well, the ECB, we're seeing weaker than expected CPI data, and the scenario where Germany did have a technical recession over the winter, and we've got stagnation. So I think for the euro, the market's probably reevaluating why it's holding those long euro positions right now.
Right, so the long euro position then in contrast to the news flow. So Jane, how many hikes do we get from the ECB from here?
Well, our official view is still that we will get two. I mean, okay, we've seen some good data insofar as it is coming off the boil in terms of inflation in the Eurozone, but it is only 1 month. And we've got to keep an eye on the core numbers too. And some commentators are expecting that core could remain sticky over the summer. Remember, in parts of Europe, that will be the tourism season. So we've got to keep an eye on it. But I think most people would agree is that we are coming towards the end of that cycle. And it is very unlikely that the market's going to start pricing in more ECB interest rate hikes. In fact, if you look back over the last few weeks, there's been plenty of hawkish commentary from the ECB in that period, but the market, or the euro, wasn't reacting to it. I think everyone is sort of understanding we're coming to the last part, to the last leg, if you like, of that tightening cycle for Europe.
Well, Jane, we've talked about the dollar, we've talked about the euro. To continue our kind of journey around the world, let's talk about the Asian currency specifically. We're seeing notable weakness in the offshore yuan this morning and the Japanese yen. Is this something, as geopolitics kind of re-enters the conversation and the macro trade, something that clients are asking about as kind of this weakness in Asian FX, perhaps incentivizing trade a little bit? How do you think about something like that?
I think these are very two distinct stories. I think for China, it is the weakness of the economy, the disappointment, if you like, from this bounce that we're seeing. And what's really happening as we see the disappointing growth data, the market's beginning to focus more on the flaws of the Chinese economy. You know, the fact that households are highly indebted, the fact that the regions or the local governments are highly indebted, the fact that they've got a bad demographic, as we do, of course, in Europe as well. So the market's focusing more on the flaws. It's getting very disappointing, disillusioned, if you like, about the pro-Chinese story that a lot of people were more excited about again at the start of the year. So the risk that they could have more loosening in policy as the market's thinking about potential for more tightening from the US over the summer is really what's weighing on the renminbi. But for Japan, it's something different. We did have yesterday that emergency three-party meeting between the Japanese authorities, and that put the risk again, or the talk of, are they ready to intervene? Are they just putting a shot across the bows with respect to intervention? That's there. And at the same time, the market is thinking, is July on the table with respect to a change of yield curve control? So there's different aspects, if you like, going on in Japan than there are in China.
Jane, thanks so much. Thanks for joining us from Rabobank. Jane Foley with her views on the FX markets. Coming up, we'll get back to our interview with Jamie Dimon. He expresses optimism on the US debt deal. We'll bring you more from our exclusive conversation with the JP Morgan CEO next. This is Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of pre-work before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. Now, with just days to avoid a US debt default, the debt limits agreement is headed to the House for a full vote today. JP Morgan CEO Jamie Dimon spoke exclusively with Bloomberg's Stephen Engel about the deal.
America, the financial system of America, and the economy of America. It's still the most prosperous and largest economy the world's ever seen, the most innovative, the most growing, and the rest of the world relies on it. So I think we shouldn't create any instability there. So I wish one day we'd get rid of the whole debt ceiling thing, but I understand when, it's a democracy, people have different opinions about what we should be doing, and it's just one tool for one party to, get the other party to the table. So I'm quite optimistic there, and I really do applaud the fact that they all sat down, spoke, got something done.
What's your read on inflation, on whether the Fed will go beyond the pause and hike again?
My simple view is that, they're right to pause at this point. It's been a big increase, 500 basis points or so. Take a pause. But I do think it's possible they're going to have to raise a little bit more. That, inflation is kind of stickier. I think people are coming around to that, which means rates may have to go up a little more. People should be a little prepared for that. Just as a matter of managing your own business, be a little prepared for that. Whether you're a financial company or a real estate company, et cetera. I think the other thing I'd be a little prepared for is the volatility that might very well be created by quantitative tightening. We've never really had quantitative easing, which we've had now for the better part of 15 years. And now you're going to see quantitative tightening. And I think the effects may be a little harsher than people expect. But hopefully we'll get through all of that and I'll be okay.
That was our exclusive interview with JP Morgan Chairman and CEO Jamie Dimon. A wide-ranging conversation. He talked about the debt ceiling. He also talked about his future. Worth looking up the rest of that conversation on the Bloomberg terminal. Now let's get a look at some of the things that are ahead for us today in the calendar. We will be getting the national report for German inflation at 8 a.m. Eastern Time. Key US data due today includes Chicago PMI and JOLTS data, job openings, of course, out of the US. And that, of course, comes ahead of the jobs report, which is due on Friday. We're going to be speaking to a host of Fed speakers, or hearing from them throughout the day, with Collins, Bowman, Harker and Jefferson all on deck. So lots of Fed speak. And all of that is leading up to the Beige Book. That'll be released at 2 p.m. Eastern Time. Critty?
Yeah, and of course, as we look at the macro, we're going to keep an eye on the micro as well. Some of the stocks we're watching in the pre-market already catching some of a bid, because even though on the macro front we do see a little bit of a pullback, a lot of that pullback is driven by the very stocks that took us to those highs in the first place. NVIDIA, AMD, of course, those high-flying chip maker stocks that have really caught a lot of attention in the last week or so off the AI bid, pulling back just a little bit. But look, NVIDIA shares still trading at about $3.95 a share, down about 1.3% for both NVIDIA and AMD, especially as AMD's Narode sells about $3 million of its shares. So really keep an eye on those insider moves. And of course, it all comes back to the AI story. And a C3 AI, we're going to call our small cap poster child. They are reporting results after the market close, but kind of in character, shares are up about 3% already in the pre-market. So we're going to talk to perhaps, or wait to hear from the CEO, perhaps in that earnings call, but whether this move is actually justified in the realm of AI. And speaking of earnings, HP Enterprise is one of the big movers we're watching, falling after their revenue disappoints. Remember, they're very exposed to that business investment, down about 8% in the pre-market, trading about $14 a share. But again, all eyes on the earnings story for Salesforce, the ticker there, CRM, higher by about 1% already in the pre-market. So a little bit of optimism baked in those companies reporting after the bell today.
Yeah, absolutely. Lots of earnings stories then to look ahead to. And on the software side of things, spending has been a little depressed perhaps, but how much can they pivot the conversation to, you guessed it, AI? That seems to be the driver of expectations these days. So we'll see whether that happens at Salesforce, of course, under pressure from a number of activist investors there. That is it for Early Edition. Surveillance is up ahead. They'll be building, of course, towards some of those earnings stories that we just talked about. They'll also be talking about the debt ceiling and everything US politics with Congressman Brian Steele, who'll be joining the team. That is a conversation coming up at 8 a.m. New York time. This is Bloomberg.
the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time? Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
From New York City.
In London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
The problem's going to be is when people realize, wait a minute, look at these inflation numbers, they're coming back up instead of going down.
Inflation's likely going to be higher than it was in the last cycle.
What you're hearing from Fed officials is very much in line with what the data are showing, which is they're starting to get a little frustrated.
We're still pricing the Fed cutting before anyone else, and that bit I don't understand.
If I were a forecaster still, I am pretty sure I will put in a small recession later this year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Closing out the month of May, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market just about negative on the S&P, negative 0.2%, but just monster outperformance year to date and over the last month on the NASDAQ 100 relative to pretty much everything else, Tom, including the equal weight S&P.
Still a story today, and I know it's led by NVIDIA, and we've all decided that we don't own NVIDIA, so that we had a lousy May. But the answer is, it is about a NASDAQ that's outperformed, but the backdrop is fascinating when you look at the economics. Maria Tadeo talking about inflation in France coming in lower, Spain coming in lower, and the news from China today, John, is underreported against that NASDAQ boom.
PMIs last night dropped from China, manufacturing PMI deeply below 50 now. Unsettling for those who are looking for a big rebound in the economy off the back of reopening and bank. The euro breaks lower. The euro now 106.76. Bramo, that's the one we've been watching, just this drip feed of negative information pushing back against this consensus view that this is where the growth would be. China, this is who would benefit. Europe, and things are starting to roll over.
And it's been so hard to understand the international impulse of some kind of China slowdown, given the fact that it's unclear how much was domestic and how much was internationally driven in terms of consumption. At this point, the big question for me, given the downside surprise after downside surprise in China, when do they start stimulus again? Do they?
Exactly.
And does it actually matter for global growth? Does that matter for international consumption, or does it continue to be a domestically driven game?
My reading of this, and Duncan Wrigley was absolutely fabulous with Ian Shepherdson at Pantheon on this morning, is, boy, Lisa, they got to act fast. This is not going to be something. I would look, John, frankly, Sunday evening, our time, 7 p.m., boom.
But this is why it's so hard to get conviction right now. And this is the reason why people are basically piling into a couple of AI names and continuing to stay defensive. I like what Mike Wilson said when he was on with you guys, saying basically this is a defensive market. Of course I did. What do you think I do?
Very cool.
Obviously. Everyone watches.
It's so sad. That is so sad, Brad.
Oh, thanks.
Isn't
Love
that
you
sad?
too. Glad to be back.
Isn't that sad?
What the?
Not just NVIDIA, though, by the way. Meta, AMD, Salesforce, Tesla. And just on Tesla, I read a fantastic piece yesterday.
Please.
Best thing I've read all year. It's all about Fidelity cutting the valuation of Twitter. But the last line of the story should have been the first line, because the last line of the story was this. Despite Twitter's issues, Musk's wealth is up more than $48 billion this year. So here we are throwing mud at Musk because he paid $44 billion for something that's worth nowhere near. And year to date, his wealth is up more than 50. Now, this is all like paper stuff. I get it. But it's so funny to me to see the last line of a story, which, Lisa, probably should have been the first line of the story.
It probably underscores the schadenfreude that people feel and the reason why everyone's rooting for things to, potentially go after him. Because if he were really getting kicked in the head, then perhaps people would be like, all right, maybe it's enough.
He's doing okay.
Exactly.
I think he's doing okay. Better than okay. Your equity market on the S&P 500, negative 0.2%, bit softer there. But this month, this year, I'll swear on the NASDAQ, we've been absolutely flying. In the bond market, yields come back down by 3 or 4 basis points, the 10-year 364. And there's the move in the euro, back down to a 106 handle. Tom, 106.72.
Oil, 68.19 on American oil, and it hasn't found a bottom yet. I mean, it's south. You're going to get a 67 print here at some point, and this is this global slowdown. I looked at London copper, the Bloomberg commodity indexes, all rose back to China, which has got to be the theme today.
Lisa, the PMI's coming in softer.
Yeah, and this is going to be a theme going forward in order to understand just how much disinflation really takes hold. We haven't mentioned the debt ceiling and the debt limit, which I'm very happy to hear about, frankly. It's probably part of the reason why I took time off. I figured nothing would get established. It has. The House is voting on that debt limit deal that they did strike. Very curious to see the breakdown and how much of a pushback there really is from the Freedom Caucus. Also, Ron DeSantis coming out really against this. How much does this really factor into the presidential election? Today, JOLTS data comes out at 10 a.m. I also came back for the Beige Book, which comes out at 2 p.m. Really curious to see job openings in particular. I want to know how much we continue to see some sort of deceleration there. And just in case you're worried, I also came back for the Fed Speak. It includes Boston Fed President Susan Collins, Fed Governor Michelle Bowman, Philly Fed President Patrick Harker, and Fed Governor Philip Jefferson. Very curious to see whether there's any cohesive. Yeah. God, just such kindness.
Waiting for that. Once that debt ceiling deal passes, Tom, you'll have tons of issues.
Yeah, Ira Jersey with a couple memos on this at Bloomberg Intelligence.
Hundreds of billions.
I didn't understand the memos, but there's a lot of money coming in short-term paper. And you see it at 3-month 10-year, Lisa. This is your world, the short paper versus the benchmark, 181 basis points, right down near that 191.
Who gets excited to come back for Fed Speak? Steve Chevron, head of US Multi-Asset Solutions at Federated Hermes, joins us right now. Steve, we talked about the outperformance of the NASDAQ, and good morning to you, sir. Any reason to believe that ends anytime soon?
No, I mean, I think you do have another sense of American exceptionalism that's taking hold. I think if there's been a surprise this year, I mean, AI, look, that was something that I can't say you necessarily knew it was coming in the way or as fast as it's come, but that's something that you can understand. But there's also been this flight to quality trade that's helped growth stocks. And we knew that happened in the pandemic because we were locked in our homes. And, I like to say it was so bad I even had to watch an episode of Bridgerton, which is the worst thing I've ever had to do.
Oh, but come on. I like Bridgerton.
Honestly, I'm with him. Probably one of the worst things he'd ever have to do. I agree.
I totally disagree. And we can talk about that in a little bit, but carry on.
He looks like the guy in Succession.
Well, which one, Tom?
Carry on, Steve.
So on the other side of it, though, you had this scenario where under bank stress, companies with these fortress balance sheets got a bid again. And that, I think, has been a little bit of a surprise this year that's driven at least high-quality tech to being that defensive trade again. We understood why in the pandemic. I'd say we were probably a little surprised that they reasserted themselves as a defensive trade in the wake of the bank stress, but they have. And here we are again with American exceptionalism in the equity markets.
So here's really the conundrum that I feel in the angst of some of the notes that I've been getting. Could you end up with basically a range-bound S&P, but the conservative trade, the defensive trade, getting upended with some of those names rallying as big tech perhaps loses some steam? Basically, a lot of churn underneath the hood, just slamming everybody out of their positions.
Yeah, Lisa, let me start here by saying if you have super high conviction right now, you're not paying attention. This has been a very slow moving economy and market. I think what we believe is that we are headed towards slower growth. I think you're seeing that In Europe now, you're seeing that in China. It's the collective impact of rate hikes. It's inverted yield curves. It's negative LEIs. It's all of that. The question is it a continuation of this rolling recession rocky landing that we've been on that keeps you in this kind of range-bound environment, or does it break into a classic recession? I think that's still very much the open question, and we don't know the answer. And so the answer to your question depends on that. If it's this kind of rolling recession, then yeah, you could see kind of growth continue to lead the way. You could see bond yields kind of range-bound. Spreads don't really widen. The Fed doesn't cut all that much or anytime soon, and you're getting your 5% in cash and your growth stocks, and those are the only games in town. If it breaks into a classic recession, now all of a sudden bond yields fall. You've got a bond trade, credit spreads widen, which open you up to a kind of positive credit trade down the road, and you're probably going to see more broader pressure on the equity market. That's why we're watching these small banks and small businesses, because however that breaks is going to tell you which direction you're going in.
What's the message from commodities right now?
Well, commodities are telling you that global growth is slowing, and that I think if you look at what the commodity market's telling you, it's either meaningful disinflation on the horizon or outright recession risk. And if you look at some of the numbers coming out of China and out of Europe, I think you're starting to see those economies break towards that more classic recession. In the U.S., it's taking longer, and the economy has been more resilient. The 30-year fixed rate helps. There was more excess savings. There was more excess stimulus in the U.S. And so we may be headed on that path. That's not clear yet, but it certainly isn't happening as quickly as it is in the rest of the world.
Steve, and beyond that, the stock market is not the economy. There's a key line that you used, the key phrase, and I've been trying to drill into this over the last week, so I'm pleased you went there on your own. American exceptionalism in the equity market. Steve, we had a decade of that. Europe, the Euro Stoxx 50 didn't have the FANG names, and right now Europe doesn't have NVIDIA. Now, Steve, I just wonder, are we setting up for the same thing again, or is it still far too premature to tell?
Well, I think you are, at least over the medium to long term. And John, if you really want to break down economic growth, it's two things in the long run. It's how many babies do you have or bring in, and how much can you innovate? And when you look at the U.S. demographically over the long run, you've got 10, 20, 30% working age population declines over the next 30, 40 years set for Europe and China and Japan. The U.S. doesn't have that. The U.S. has 9, 10% population growth projections in the working age cohort over the next 20, 30 years. And you're the center of innovation, right? Whether it's AI or robotics or the Internet of Things or blockchain, you name it. It's really starting with U.S. intellectual capital. So if you're taking a long-term bet on which economy is going to lead the world and which stock market is going to be rewarded for that, it's absolutely the United States. It is the only major economy that has the combination of robust working age population growth and that kind of transformative innovation. And I don't think that changes anytime soon.
Well, we're going back to the start of the conversation then. Equal weight S&P, market cap S&P, NASDAQ 100. Steve, if you had to own an index right now, what would it be?
Well, I think you're barbelling on the equity side. I think, one, you want to own those defensive dividend-paying stocks. I think the idea that the economy is not going to slow in the face of 525 basis points of rate hikes and probably, at least 25 basis points more to come at some point, I think that's a low probability bet. And those defensive dividend payers, the Dow Jones Select Dividend, if you will, I think is a good place to be. And then you got to pick some cyclical part. Markets rally on Fed pauses, even if a recession is to follow. Even if a recession is to follow. So then you ask yourself, well, what's that risk asset that you want to own? It's not cyclicals. It has been international for us. I'd like it to be growth going forward, but I'm not going to pay these multiples. So I think the story here is you buy growth on any meaningful pullback, you sell cyclicals on any meaningful rally, you don't chase.
Hey, Steve. Good to catch up. Steve Chevrone of Federated Hermes. Okay. Big line there, TK. You and I started that conversation last week. Is U.S. exceptionalism making a comeback?
Yeah.
With NVIDIA mounting higher?
Voya's leading the way on this, and there's others as well. This huge deal. I can't wait to see the mathematics of active versus passive June 30th.
Equities slightly negative. We're down 0.3% from New York. This is Bloomberg.
Keeping
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The debt limit deal heads to a House vote today after squeaking through House Rules Committee by a 7-6 margin. The nonpartisan Congressional Budget Office estimates the deal would cut deficits by $1.5 trillion over a decade. Meanwhile, U.S. House Speaker Kevin McCarthy has dismissed threats from Republican hardliners to remove him from his job. Foreign ministers of the North Atlantic Treaty Organization countries began a 2-day meeting in Oslo. Well, they discussed Ukraine's bid to join the military alliance, as well as how to boost defense spending. French President Emmanuel Macron will also speak. He's expected to emphasize the importance of NATO's role in Europe. The U.S. urged Serbia and Kosovo to immediately de-escalate tensions in northern Kosovo after clashes injured dozens of peacekeepers and protesters. U.S. Secretary of State Antony Blinken blamed Kosovo's Prime Minister Albin Kurti's government for, quote, unnecessarily inflaming ties with the minority Serb community. Blinken urged newly elected ethnic Albanian mayors to avoid working in predominantly Serb towns where violence erupted this week. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
DOJ or other authorities
could face bigger challenges.
Britain's next.
Fed was going to keep rating World Cup. This is a 3.
As the economic picture does.
To be okay is getting ready to make a decision.
People ask me all the time, what is the key to being a really good investor? I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. So far, the jobs report has not been good news for the Fed.
3.4% unemployment.
That's not the picture Jay Powell thought he'd be looking at.
It really signals an employment market that's chugging along
miles from where the chairman of the Fed wants to be.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
It hasn't been a widespread job loss.
The tightening is yet to show up.
Fed's not going to quit until the labor market quits.
The May Jobs Report, Friday on Bloomberg Television and Radio.
I'm not sure what in the bill people are concerned about. It is the largest savings of $2.1 trillion we've ever had. These are major victories. I understand people get upset about walking through a debt ceiling, but this is a House, a Senate, and a presidency.
We're going to make sure that the country does not default, but we also are going to make sure that Kevin McCarthy and my colleagues on the other side of the aisle, of course, uphold their end of the bargain, which is simply to produce a sufficient number of votes.
House Speaker Kevin McCarthy House Minority Leader Hakeem Jeffries speaking on Bloomberg's Balance of Power just yesterday. Wall Street hoping we can just move on. And hopefully we can. We could have a vote a little bit later in the House as, Tom, things pass a key procedural hurdle yesterday evening.
We got to mention what you brought up last time, and I'm not read in on it. I'm sorry, but there's going to be a balloon and T-bill issuance at some point. I mean,
Once this passes, yeah.
There is a ramification of this silliness in Washington to our world.
Which will be hundreds of billions of dollars of T-bills. There are some people who think that would be totally okay. There are some people who think it can exacerbate existing tensions, which are in the banking sector, competing for capital with banks, Bramo. I can imagine you're thinking about the other side of the trade just a little bit more. But we had someone from Columbia Threadneedle, Ed Al-Husseini, sit on the other side of the table with us yesterday, Bramo, who thinks that this will be okay. We'll get through it, no big deal.
Most people do, which is the reason why the distortions haven't gotten exacerbated in the T-bill market. But if you think about the banking stress, you already have seen some of the biggest capital flight from the deposit accounts in 50 years. What will this do to that?
Yeah, and am I right that this Friday maybe is when the report comes out, we may see further deposit flight? Why wouldn't we? You know, I just wonder the flows are in place. It may
it's
not
something
be as large.
we're watching. I'm not going to make the call. Loretta Mester in the FT, I think, is worth a read. Cleveland Fed president
What's she
talking
say?
about making another move next month. She doesn't see the conditions here for a pause, looking for a hike in June. Still got payrolls on Friday, CPI the day before the next Fed meeting. We'll see what we get. We talked about Andrew Hollenhorst recently of Citi, who set the bar incredibly low, I think, for another move at the Federal Reserve. 200K on payrolls. He says 0.4% core month on month. CPI gets it done for him. 25 still to come.
We'll give you the coverage on Friday. We go beneath the headline data at 8:30 in the morning. Right now, we speak expertise with Wendy Schiller, director of Taubman Center at Brown University, one of our most popular guests. We get huge response when Professor Schiller is on. Professor, there's that scene in the movie Lincoln, Daniel Day-Lewis and Sally Field, and Tommy Lee Jones steals it as Thaddeus Stevens. And there's all the drama of the Emancipation Proclamation and all that. Really, history repeats itself. It seems like that right now. Who's the Thaddeus Stevens right now in the Hill that's going to get this done?
Well, I mean, I think that the Democrats, essentially, Hakeem Jeffries, is going to have to deliver. And he keeps saying, oh, well, we need 150 Republican votes. We're going to hold off. But in the end of the day, the White House has a Democratic Party occupant. And you have to save the president, and you have to save the economy. So the Democrats, and basically led by Hakeem Jeffries, will have to step in if the revolt, quote unquote, that we're hearing about among Republicans grows much larger between now and the time of the vote today.
Mr. Manchin got a pipeline. He's over in the Senate. What are they going to give House liberals to get their vote?
Well, they're not going to need that many liberals. They're not going to need the most left wing of the caucus, progressive caucus. They may or may not sort of give them a pass and say, you know, you don't have to go down this road, because the most left wing will say, well, the most right wing is not voting for this bill. Why should we vote for the bill? So that's the defection concern, right? The snowball effect is if you give some people a pass not to vote for this bill, how many more people do you have to give a pass not to vote for this bill? And then does your majority collapse? I don't see that happening. I think there are enough confirmed Republicans, maybe not 150, but enough that Hakeem Jeffries will only have to get a certain percentage of his Democratic caucus. And those moderate Democrats, are not that many left, but the moderate Democrats are going to need to vote for this just to show that they're willing to do something to contain the federal deficit.
Wendy, what does a West Virginia natural gas pipeline and the accreditation of it have to do with fiscal responsibility?
Well, it's about the way that we do our budgeting. It's the fact that we have a Congress that is geographically apportioned and is bicameral, right? Think about that. You have very different incentives for senators versus House members, particularly smaller population, sort of larger geography states that have natural resources. I mean, this is the institutional structure that was created a long time ago. It doesn't quite fit. It doesn't really fit at all our major, huge federal budget and federal government, but we're stuck with it. And these are the kinds of trades you need to get things done. What I'm shocked at is as much policy is being made in the debt ceiling. I can go way back to Graham Rudman Hollings, or Graham Rudman, and that was attached to the debt ceiling, but that was budgetary policy, and it made sort of sense then in the 80s. These are all sorts of policies, social welfare, energy, climate policy attached to a debt ceiling bill is not the way you want to make policy for a government this large.
Which is the reason why Bloomberg Intelligence came out and basically said, yeah, it might reduce the deficit by a little bit of a rounding error, but longer term it will slow growth by even more, and it doesn't actually address some of the real pressing fiscal concerns with respect to certain programs that are going to be unsustainable. What's your view on that? I mean, basically, is this lipstick on a pig?
Well, Lisa, I don't know if I go that far, but I think what most people have to understand is that at least 2/3 of the federal budget, which is probably going to push over $7 trillion, you know, we're at 6.5 now, that is entitlements or built-in spending, defense spending, programs that you cannot touch that are facing some insolvency concerns, Social Security, Medicare. Those programs are just, nobody touches them. Congress won't go near them. I mean, they're doing a few things to sort of trim the work requirements, in other words, make it a little bit stiffer to get some social welfare programs, but the big ticket ones are not being touched. And until those are touched, you know, the federal budget will continue on this growth trajectory, which means we're going to be spending more than we take in every year, and the debt will just keep growing, particularly if you cut the IRS, the Internal Revenue Service, which collects revenue, which helps balance out our federal spending.
Professor Schiller, you mentioned Graham Rudman. Just simply, Civics 101, why can't we get a commission done that has some strength to get to a good resolution?
Because I think the Republican Party has sort of strategically decided that being anti-federal government across the board is winning them votes and keeping their base roiled up. And that's partly federal spending. You have some states now with Republican governors that are saying we're not going to take federal money. We don't want the strings attached. So going way beyond unfunded mandates, they're now saying we just don't want the money and we're not going to do provide the services that the money would help us provide. So you're seeing a larger trend, a deeper trend in the Republican Party that is rejecting federal authority. And this is part of it. And so if you can cut spending and that becomes a big ticket item, and you want credit for that, you want Congress to do that, you want to be in a room saying you have to cut spending because that gives them a talking point that's resonating quite well among their base at home.
Wendy, forgive me for asking for a time frame, but for how much longer do you think Speaker McCarthy is Speaker McCarthy?
Well, you know, Democrats have come out and said they're going to keep this guy afloat, right? They've already said if his own party rejects him, we will find the votes to keep him. Because, of course, the alternative could be significantly worse for the Democrats and for President Biden. So McCarthy looks like a guy, when push comes to shove, will get the most basic things done. And he seems to have grown into that role. And if he gets challenged, I see some Democrats, maybe those who are going to retire perhaps in 2024, but they're going to come to his rescue, which they've already said publicly.
Hardly a ringing endorsement for the modern Republican Party, is it? Kevin McCarthy needs the support of Democrats to remain Speaker McCarthy.
Well, that was the way Boehner was as well. Yeah.
Yeah, right. But John, this is also, but Democrats should beware, or independents should beware, because these splits in the Republican Party are what we also saw, as you just mentioned, about John Boehner and Paul Ryan. And yet Donald Trump won with a big, huge surge of Republicans in 2016. So I don't think it tells you anything about the potential for the Republicans to unify behind their candidate in 2024.
Oh, absolutely. That's not what I was implying at all, just to be very clear. Wendy Schiller at Brown University. Wendy, thank you. I meant for Kevin McCarthy. It's hardly a ringing endorsement from the modern Republican Party for him. The fact that he needs to rely on Democrats to remain Speaker McCarthy.
I can't state how Ronald Reagan invented you run on the outside and move to the middle through the election. And that method is dead. It's just gone.
I'm not sure if pride has been a big concern of his. He basically, how many votes did it take?
Was it 15?
15. I mean,
something
he's just
like
willing
that.
to
take it. That's not exactly, he's not looking for a ringing endorsement.
Bill Leah Milken, up next.
we had a long-standing presence here in Houston for the past, I would say, 20-some years, since the compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Equities on the S&P 500, just a little lighter, softer, negative on the S&P this morning. Here's a picture of things for you. Down we go by 0.3% on the Nasdaq 100 on a 3-day winning streak. Could break that today. We're down just a little bit, slightly negative, down 0.3% there as well. Month to date, though, the Nasdaq 100 up by more than 8% this month. Up more than 8% with the equal weight S&P 500 down 3% this month. That's 13 points of outperformance. Month to date. It's kind of crazy. Even with this in the bond market as well. So let's look at bonds together. 2s, 10s, 30s. 2 year before today on the month, higher by 44 basis points. Trimming some of that down a couple of basis points to 442. But remarkable, Tom, to see those gains in the equity market, in the Nasdaq, in big cap tech, with those moves in the bond market at the same time.
Quickly, curve inversion. We had negative 80 basis points yesterday, still negative 78, substantial, as you say, John, over the month. We've seen a steeper, a re-inversion, not out to highs. Real yield 142, 10-year real yield. Maybe not all that much newsmaking, but I'm going to go to the 3-month, 10-year, the T-bill as compared, high-yield T-bill as compared to the economic slowdown 10-year yield, 181 basis points. Is a wow statistic.
For a moment, this was boring, and then it got really, really interesting, particularly in the FX market. You had that lift in yields. You pushed that through foreign exchange. You got a stronger dollar. You got a weaker euro off the back of weaker China data. You got that again overnight. PMI's disappointing. Manufacturing a whole lot softer. Worldwide, actually, but led by what's developing in China relative to expectations for a big boom. The euro hasn't seen 108 for about a week now. Broke 107
see 105
in the last 24 hours. I'm with you, Tom. I'm with you. 106.75 right now.
What we're going to do is what we do best. We are committed to international economics. Remember the IMF coverage that we did here in the recent weeks, including speaking to the managing director. It was April 6th. Our Eric Martin was reporting on the bombshell 5-year view of 3% global growth. I'm still not used to that report from the IMF. Thank you, Eric, for that report. And then today, Duncan Wrigley at Pantheon, Ian Shepherdson's Pantheon. Wrigley has to root for Newcastle with all that. He comes out and just simply says China to export disinflation and deflation. I think we saw that banner when Alan Greenspan was running the show. William Lee joins us now, chief economist at Milken Institute. Billy, let's start with Greenspanian 101. Is China in their slowdown going to export disinflation and deflation?
Well, China can't export much of anything right now, but I hope what they do is disinflation for the rest of the world. Right now, China's recovery has really faltered. We can see that not only is manufacturing down, but it looks like the consumption is on its way to go down as well, with unemployment rates at 20% for youth unemployment. So China's not in good shape right now, and I think we are looking around and seeing what is going to pull China out of the doldrums.
What is the degrees of freedom an autocracy has Sunday afternoon, New York time, when they're supposed to provide stimulus?
It's pretty limited, right? Because not only is the federal debt out of control, the municipal level debt is out of control. So the general channels for fiscal policy have been through the municipal governments to try to hire more people, build more projects and stuff like that. Well, right now, they can't do that. So the amount of fiscal policy that we have is really limited. And monetary policy, I mean, you can lower rates, but people are just going to, stay there and not borrow because they're going to ask themselves, where am I going to spend the money in order to make money in the future if the demand is so slow? So China right now is snowballing into a fairly bad static plateau.
Static plateau that's been priced in or not, Bill?
I think one of the things that we have to look at is where is it being priced. One of the things we talked about at the Milken conference that just ended a month ago was that a lot of the investors going into China go into the private markets, and we really can't see a lot of that. But in order to get into the private markets, one thing that everyone made clear was they needed good Sherpas. They needed someone to guide them through to find good investment opportunities. And a lot of the investors claim they've got some good Sherpas there, and they're getting good bargains because the slowdown is affecting valuations both in public and private markets. But the real question to ask is, will you get the kind of returns you're hoping for? And there I have my doubts because the demographics are working against them. And on top of that, the possibility of technological change, which would be the one thing that boosts the Chinese economy, is also not going to be there because policy has been really anti-innovation, anti-technology, and it's hard to see that changing.
Which is, John, what you were pointing to when you were taking a look at the tech indexes over in China versus the tech indexes in the U.S. and that huge bifurcation between the two. Bill, that's maybe on a domestic level. What about internationally? Has this been priced in terms of the impulse that China had on Europe? We were talking about the euro and how much it's come off some of its earlier highs.
Well, the renminbi right now is weaker than it's been for God knows how long. And so in that sense, it's being priced in. But for me, the FX market is very short term. The real question is, are investors pricing in growth opportunities over the next 5 years? Are they putting the marginal dollar into China or are they putting it somewhere else? And I think more often than not, they're looking somewhere else.
Bill, you've got a great ability to move away from the Pacific Rim and the three cities we focus on all the time. What's the rest of China look like with the unemployment rates that are being reported?
That's a great question. Up until now, I would have said the prospects for any kind of innovation, any kind of employment growth are going to come out west because the Milken study for the greatest performing cities in China landed on Chengdu as a small innovation hub. And we still stand by those numbers. But unfortunately, these numbers are getting dated. And right now, I'm not sure if even out west, the innovation hubs will be able to give the kind of employment that they hope for.
We've been here before. And the answer is Beijing always blinks and moves away from a totalitarian mindset, the autocracy of President Xi, and they move to some form of liberality and capitalism. You're saying that's not going to happen this time? See, he's pointing on radio. You can't see that. Professor Lee is. I got to duck because the chalk's coming in.
Tom, President Xi's blinking is going to involve maybe a slightly different wrinkle. He's going to rely on nationalism, perhaps, some militarism, some expansion of hubris into the rest of Asia, because after all, he wants Asia to be the currency area for the China and for the renminbi. So I think these are the kind of places we should look for any kind of resuscitation of Chinese nationalism, which is they're going to try to instill pride in the Chinese people without giving them jobs. And that's going to be a cute trick.
Well, what does that mean in terms of international business? And I say this as JP Morgan has their conference and plays nice, albeit in a brilliantly diplomatic, pro-American, but also pro-China kind of speech by Jamie Dimon. How much can you really see a decoupling or a willingness to exacerbate that on the Chinese side in light of the economic challenges?
Well, Lisa, we have a love fest by U.S. CEOs going back to Tim Cook and now Elon Musk. And Jamie Dimon was very slick in being able to say, I'm a true American. I really am a patriot. So when you vote for me, remember that, even though I'm asking you to come to China and support my people. And I think going forward, we're going to see more of that because the question is, the people who are in China have to maintain their business and really contain what they've gained. But the marginal dollar, the investors sitting here in the West thinking of going to China, what are they going to see? And I think they're going to see a lot of opportunities in ASEAN, in Korea, and in the Quad countries surrounding China, because that's where a lot of the innovative industries are moving to.
I want to end the conversation where we began, where you're talking about sort of a stagnant plateau. What is that stagnant plateau in China? What is that rate of growth that's going to be the new normal and going to drive demand for the luxury goods that have gotten bid up, for commodities that have surprised a lot of people to the downside this year?
Well, Lisa, the official number is a 5 handle for growth going forward. And I think you're going to see more likely a 3 handle than 5. So I think that's the kind of order of magnitude you're thinking of, because with population stagnant, any kind of massive productivity growth can't get them above 3.
For obvious reasons, Bill, market participants are going to be very interested in the next move on stimulus to get the PMI back above 50. As you know, that's not what the leader of the Chinese Communist Party is going to be focused on. They're going to be taking a multi-decade view. Yeah. And Bill, I'm far more interested in the kind of fiscal moves that they make to stimulate more investment in certain parts of the economy that are going to be highly competitive with the United States and Europe, particularly as the US retrenches and refuses in some parts to do business with the Chinese government. Now, Bill, what are you focused on with regards to that?
Well, absolutely. In fact, if you look at where the Chinese are meeting and where they're not meeting with Defense Secretary Austin, so they don't want to talk military, because we know what they're going to do there. It is not very powerful for the U.S. But I think the place that they're meeting with is Gina Raimondo, as Commerce Secretary. They're hoping to leverage some action on the tariffs. They're hoping to leverage some action on cutting the semiconductor restrictions, and their information blackout is going to leverage what our investors actually see. They're going to shape the story for global investors to be so wonderful that that investors can't resist coming. But in order to do the due diligence, the required information to do the due diligence is something that's being restricted as we speak by the Chinese government. And going forward, I don't see that lifting.
That last point is so important, Bill. Clarity, transparency. Yeah. How do I know what the unemployment rate actually is in China? Measuring it is hard enough, but when we hear youth unemployment, something like 20%, just how bad is it, Bill?
It is that bad or worse, and if it wasn't worse, we would hear more about informal data, but instead we see companies like Wind being wound down by the government. We see due diligence companies like Bain being queried by the officials. So I think the Chinese are making it very clear, we're going to feed you the information you need, but it's from us.
Bill Lee of Milken. Hey, Bill, good to catch up, as always.
Thanks,
it has been a tough year for the equity market over in China. Take the Hang Seng China Enterprises Index, okay? That is down by more than 20% from the peak. So we are in a bear market for some parts of Chinese equities, in fact, many parts. And you compare that to the NASDAQ this year, that wasn't meant to be the way this played out in 2023, Tom. It was meant to be very, very different through the equity market.
Off the COVID boom, 6%, but to model down to 3%, and I go back again to April 6th and the IMF bombshell. And I don't think anybody believes the IMF bombshell, but nevertheless, a tendency towards 3% global growth affects China more than any other nation.
How do you create a valuation for some tech prowess if you're basically forcing tech companies to break up, to reduce certain aspects of their company? I mean, how do you innovate in that? If Alibaba has to spin off their cloud computing because of political reasons and then try to understand that, how do you invest in certain things? So to your point, John, how do you create consistency that allows for some of the investments to compete, and especially without stimulus?
There was a story that we put out in the last week or so that you could see some rate cuts, that you could see some fiscal stimulus, but targeted specifically at high-end manufacturing. And that's what I think I'm getting at here. When you see those headlines, if they do cross, that's not going to be about getting PMIs above 50 again. That's something much, much more strategic than that.
We'll talk about this. This is not going away. It's very important, the impact of this on America.
Angelo Zeno of CFRA on NVIDIA and the year-to-date boom for that hot stock. That's next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The debt limit deal heads to a House vote today after squeaking through the House Rules Committee by a 7-6 margin. Meanwhile, J.P. Morgan Chase Chief Executive Officer Jamie Dimon says he's optimistic about it.
So I wish that one day we get rid of the whole debt ceiling thing, but I understand when, it's a democracy, people have different opinions about what we should be doing, and it's just one tool for one party to, get the other party to the table. So I'm quite optimistic there, and I really do applaud the fact that they all sat down and spoke, got something done.
The nonpartisan Congressional Budget Office estimates the deal would cut deficits by $1.5 trillion over a decade. North Korea has confirmed that an effort to launch a military spy satellite into orbit failed earlier today. The official news agency reported a rocket crashed into the LOC after losing propulsion in the second stage of the ascent. Now, the launch initially prompted missile alerts in both Japan and South Korea. Pyongyang says it will attempt another launch soon. Goldman Sachs is said to be considering another round of job cuts as the deal-making business remains slow. Sources say the third round will affect less than 250 people and will include the firm's more senior employees. Earlier this year, it had eliminated about 3,200 positions, embarking on one of its biggest ever round of layoffs. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. We're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority. The top names at the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
How many times AI was mentioned during the earnings season, but it was some astronomical amount, and everyone is latching onto it. I think we need to be very cautious going forward. I just think there's so many unanswered questions. I don't think you put all your eggs in the AI basket, but you have to have exposure knowing that it's going to be part of the future.
When you get a briefing from PR right before a call as a CEO, you know what the briefing sounds like right now, don't you? Just say these two letters repeatedly and watch the stock in the pre-market or after hours just go higher. That's what it feels like with NVIDIA and other names. What makes me laugh, though, beyond NVIDIA, it's names that you wouldn't typically associate with this kind of stuff, Bramo, but it's just like, yeah, we've been doing this for ages. For ages, we've been embracing AI.
Doesn't this feel like what happened with cryptocurrencies and just in general what we saw with respect to blockchain? Basically, you had furniture operators mentioning blockchain and their stocks would surge. I mean, it's basically NVIDIA coming out after hours. We've got more AI, and everyone's like, yay, good job.
Long Island iced tea, wasn't it that? They put blockchain on the name or something like that. The challenge back then was to try and draw a distinction between the frenzy, the things that were going too far, and the real innovation, the stuff that would still be with us today.
I will just say this. Last night, the kids were studying, and what they all do is they run their essays, their tests through a ChatGPT paradigm to see what grade they would get. And a lot of teachers are doing this now too. And then they get a grade, and then they know whether they have to work more or not. I'm just telling you, this is being weaved into the sort of daily existence
So
of so many people.
Are grading them based on that too.
Well, that's what they're saying.
You're implying the teachers at home, this is how they're grading the work.
I have heard anecdotally this has happened. I mean, they are overworked, and if they've got a lot of students, they could just run it through ChatGPT and get a grade. They could write the essays with ChatGPT, grade the essays with ChatGPT, and we could all just
we ran
hit the park.
afterthoughts math scores through ChatGPT, and the computer started smoking.
What do we need them for? What do we need teachers for? Right?
No, but in all honesty, I asked them: is this a tool to substitute, or is this actually just to help, to actually make you better? All of them say to make you better. So I'm gonna remain ambitious.
I think
and optimistic.
Lisa, I think it's completely overwhelmed by how much education was lost through the pandemic, and we're still catching up across every decile of America. Here, futures -10. The VIX is solid for the last couple of days, 17.77. John, where's the euro? Are we at a 105 yet?
We're at 106.76. Well, that would have session 106.59.
If you're just waking up, there is a lot going on this morning. There's no question about that, including a complete breakdown in oil. There's no other way to put it. That's American oil, 67.69. We're going to get back to $2 a gallon gas. That'll keep Lisa's H2 in good stead. Right now, we're going to talk the talk of the moment, NVIDIA, with Angelo Zeno, senior equity analyst at CFRA, who in a brilliant note has the courage to write what everybody's thinking, which is the only way you can justify this is to extend your timeline. Angelo, you go right out to 2024, and you say, look, with a 25% growth pop, you're buying a 40 multiple stock. Why don't you extrapolate out to 2025?
Yeah, I mean, listen, I think you can. I think there's always danger with kind of extrapolating the numbers outright. But I will say this: we are believers in kind of the entire NVIDIA story, in kind of the AI story, the fact that kind of GPUs are going to increasingly represent a bigger percentage of CapEx dollars for these cloud companies. We do think over time, over the next 3 to 5 years, the compounded annual growth rate for GPUs, and specifically that of NVIDIA on the accelerator side of things in the cloud, can grow at an annualized pace of north of kind of 20 to 25%. And that can kind of get you to an EPS growth rate over time for NVIDIA, again, north of 20%. If you're a believer that, the top line for this company can continue to grow at a mid to high teens percentage pace.
Are there other NVIDIAs out there?
So we actually wrote a piece back in late March about kind of the biggest winners of kind of the generative AI boom within the semiconductor industry. And we kind of pointed to 4 names at that point in late March. And those 4 names were, one, of course, NVIDIA. AMD is another name, clearly a beneficiary in the GPU side of things over time as well. And then the other 2 names are more kind of network connectivity type names. And they were Marvell as well as Broadcom, a name that we think is highly underappreciated, a name that's going to report tomorrow night at the close.
I'm wondering what a tech company is right now, and which companies can actually take advantage of artificial intelligence and some of this technology. Very clear-cut AMD or NVIDIA, but what about Meta? What about, just on a broader sense, other companies that could potentially gain from the productivity of investments in artificial intelligence? How do you value which companies will gain and which actually won't at all and potentially could even lose?
Yeah, listen, I think that's probably the most important question we get from investors right now. It's from a monetization perspective, who are going to be the biggest winners kind of from this AI boom? And that's really it's a tough question to answer. I'd say, to your point, kind of the easy answer right now is on the semiconductor side of things. It is on the infrastructure side of things, and kind of playing that. And that's clearly where the action has been here in recent weeks. Now, when you kind of look more forward-looking in nature, when we think about some of the larger cap name stocks, I'd say Microsoft clearly at the top of the list in our view. I mean, with Copilot out there, with the potential to kind of see significant pricing power on that side of things, we think the line of sight is highly visible, and one where over the next decade should be a clear winner in our view. Now, other names like an Alphabet as well as Meta, we think are going to be a little bit tougher calls. And that's why you don't see kind of the multiple to the extent where you see that of the Microsofts of the world. And a big reason for that is, are they going to really get the ROI potential, or are they going to give advertisers out there the ROI from this AI boom. We think there is some kind of positives out there, but I don't think it's as clear as potentially a name like Microsoft out there.
So you can be a believer in this story, and I think that anyone who sees the way that people are using ChatGPT-like artificial intelligence has to be something of a believer, if not at least a very open recipient of this information. But you do have some naysayers out there about the valuation, basically saying that the rally that you have seen so far, 31% in big tech stocks so far this year, is at risk of petering out. This according to Citi analysts, basically saying that positioning is just such that it's rife for profit taking. I mean, do you sort of play into that? Do you just sort of look past that? Do you think that anything like that will just be a buying opportunity? How are you playing sort of the tactical ride up that we've seen in prices that can't really continue at this pace?
Yeah, I mean, listen, I mean, in terms of the performance here, there is, we think, going to be some sort of AI fatigue here, potentially in the coming weeks, some sort of digestion that's probably going to be needed. Now, that said, I mean, we remain very big believers that the valuation actually is not as extended, I think, as many people out there think, especially as you kind of look out to a calendar 2024 basis for names like an NVIDIA and others, where kind of they are within their 5 to 10 year historical ranges, especially when you start thinking about kind of the growth tied to a number of these names. I'd also point to, names like a Microsoft and others where, listen, at this point in time, I'd say kind of the risk to the downside on EPS estimates are probably very low, and there's probably upside potential to those estimates. So we kind of we want to be long on a lot of these names that are AI related. And I would say kind of you kind of want to have a basket of names. You don't want to put all your eggs in one basket, and you want to be buying kind of on any pullbacks. But listen, it's definitely gotten a bit hot to an extent, especially on the semi side of things. But the four names that we highlighted, we think continue to be the biggest winners and the names you want to buy on those pullbacks.
You want to be long. Some people feel like they have to be long. I was just going through the analyst recommendations. I love this. 49 buys, 8 holds, and one guy who couldn't care less about career risk with a sell. Now, Angelo, that's what I wanted to finish on. Do you sense the so-called career risk associated with this, given how quickly it's moving? Is there pressure that you have to be long?
I think that's a great point. I mean, listen, I think there's always risk of kind of, there's always risk on that side of things. But, we are fundamental by nature. And to us, the fundamentals are screaming buy right now. And for that reason, I think you continue to need to pound the table on these type of names. And I think, especially on a name like NVIDIA, when you kind of look at the multiples at about low 40s on a calendar 24 basis, and then you look at the growth tied to it 3 to 5 years from now, and you kind of look at how early we are, if you're a believer of kind of, let's say, autonomous vehicles and what have you, there is risk to potentially having a sell to be tactical in nature rather than kind of beating kind of the table on the longer term outlook on these areas. And I think that's what you need to do for investors out there right now.
Interesting. Angelo, always great to hear from you. Thank you. Angelo Zena there of CFRA. TK, the pressure if you've missed out on this so far yet today must be huge.
It's going to be huge, and I think you mentioned this yesterday. The pressure into end of year for people behind. Window dressing this year, record level, given the oddities.
Andrew Sliman of Morgan Stanley talking about that. Emily Rowland of John Hancock Investment coming up next.
News breaks. No one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority.
In New York City, a $100,000 salary feels like just $36,000. That's according to a new study that looks at 76 of the largest U.S. cities to see where $100,000 goes the furthest, after taxes and after accounting for the cost of living. For many, reaching a six-figure salary is a huge moment when you feel like you finally made it. But that feeling may not last long when you realize just how much taxes and the cost of living in an expensive city takes out of your paycheck. And that's especially true after 2 years of inflation. Hybrid and remote work have opened up so many more opportunities for people to choose where they live. So that forces the question, Should I stick it out in an expensive city or try to find somewhere more affordable? So where should you live if you want to maximize your salary? Consider Memphis, Tennessee. The home of the Blues topped the list with a take-home pay of about $86,000. Tennessee doesn't have an income tax, and the cost of living there is about 14% cheaper than the national average. So a dollar there takes you much further. Texas is another popular choice, and it's clear why. 7 of the top 10 cities where $100,000 goes the furthest are in Texas, a state known for low taxes. Of course, there are so many factors that influence where you choose to live. You may want to be at the center of things, or be near family, or be somewhere where there are a lot of career opportunities in your field. It's not always just about dollars and cents.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
The problem's going to be is when people realize, wait a minute, look at these inflation numbers. They're coming back up instead of going down.
Inflation's likely going to be higher than it was in the last cycle.
What you're hearing from Fed officials is very much in line with what the data are showing, which is they're starting to get a little frustrated.
We're still pricing the Fed cutting before anyone else, and that bit I don't understand.
If I were a forecaster still, I am pretty sure I will put in a small recession later this year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market slightly negative on the session. It is up big time on a month if you're looking at the NASDAQ. The S&P 500 doing okay as well. The equal weight. This has been the big distinction so far this month, so far year to date. Once you strip out the muscle of big tech, take away Nvidia, take away Meta. Tom, beneath the surface, there's a struggle there that you can't see. You can't see at the level of the NASDAQ 100 and elsewhere.
I would suggest like we've never seen before. I mean, the diversions here are amazing. Tomorrow we're going to have sell in May and go away statistics for you, June 1, but we're not going to do it today. But the answer is these are profound trends, and you listen to Mr. Zeno we just spoke to at CFRA. These are trends that he suggests endures out 1 year. 2 years, 3 years.
Most people listening to this program right now hoping we don't talk about the debt ceiling story. That deal could go for a vote a little bit later today, and then we can move on, we hope.
But we had a good vote yesterday, right?
Payrolls on Friday, then on to CPI next month on June 13th, then on to the Federal Reserve. And if you're looking for some Fed speak this morning, in the Financial Times, Cleveland Fed President Loretta Mester teeing us up for what, Bramo? One more hike.
Right. And basically, she has been on the more hawkish side. But her talking about one more hike coheres with what we're seeing in markets, where there is this feeling growing that they could afford to go one more time. There has been a resilience. Consumers keep spending. Here's my key question heading into June. Are we at an inflection point? And this is what Oxford Economics had to say. Yes, we are. That all of the drivers of the first half of the year, whether it was China, whether it was some of the resilience that we see in consumer spending, are all set to roll over. If that's true, what happens to the indexes? They say range bound. I mean, again, this is sort of the conundrum of the economy on one side and markets on the other.
Well, you can see it in the weakness in European equities, in luxury this morning. You can see it in the underperformance in Chinese equities all year for that matter. The reopening trade kind of really started in October and ended by the time we started 2023, just at the same time people were getting excited about it. But I'm with you. I think the breakdown in the European story is the one that's taken my attention in the last several weeks, Tom, in anticipation that maybe we'd have to push back against this idea that this is where you want to be, this is where the growth will be, this is where the equity market gains will be. More recently, that story has been challenged. And in the last hour, we heard from Steve Cheverone of Federated, and we heard that line that we've talked about a few times in the last couple of weeks. Are we going back to so-called US equity market exceptionalism? And the problem that a lot of people have listening to this is that they have a real struggle on their hands. In the US equity market right now, are we on the brink of a melt up or a meltdown? And if you ask people, they'll be split one way or the other. There is no conviction consensus out there on that.
The consensus has been some form of marginal move to international equities. Damien Sassauer was brilliant yesterday on where you find value in emerging market bonds. And time after time after time, you end up with some soup of resilient dollar, stronger dollar, diminished growth expectations off of what was looked at 6 months before. And that's right where we are right now. I'm going to go back to the IMF bombshell of April 6th. Are we framing out 3% global growth for 5 years? I don't think anybody is, including me.
Tom's on 105 watch on the euro.
Yeah, technically, you got to
For many people who have booked a vacation to Europe, based here in America, you're probably also on 105 watch.
And below.
106.80, like trying to get back to parity.
You know.
Just saying there might be some bills in euros that might need to be paid. And for those funded in dollars, this might be a welcome development over the last couple of weeks or so. The broader market story, equity futures on the S&P 500 shaping up as follows. We look a little something like this, negative by 0.2%. Yields coming in just a bit, Lisa, here. We're down 4 basis points. The 10-year, 364.
Today, perhaps we'll get jolted with some data and with some Fed speak. But before we get there, we're getting that House vote on the debt limit deal that we're not sure exactly when it's going to come out. It is expected to pass. Then the Senate has to take hold. Then it has to get through before the June 5th drop dead date. We're all watching closely every single iteration and just praying that it is over soon. Today, we also do get JOLTS data at 10 a.m. This will be really key to get a sense of job openings, the soft data around how quickly the labor market is softening. And at 2 p.m., the Fed releases the Beige Book, which Tom will read in detail. And today, if you are looking for Fed speak, Boston Fed President Susan Collins, Fed Governor Michelle Bowman, Philly Fed President Patrick Harker, and Fed Governor Philip Jefferson, curious to see whether there is a Loretta Mester vibe or whether she is truly an outlier, because right now she seems like more of an outlier than anything else. Yes, you have heard a bit more of a willingness to push back against the idea of rate cuts, but very few people outright are saying, you know what, yeah, it does look like we need another hike. And, oh, yeah, we do need to tighten more. There seems to be more of a reticence around the edges and a pushback from some of the members.
Well, there's some splintering over the last couple of weeks. If you want to identify some consensus, 2 places. One, you mentioned, pushing back against cuts. 2, they don't want to commit to a pause just yet. You get a real sense of that on the committee going into next month's decision.
Especially because we don't know which way things are going to break. And this has been sort of the surprise. So the disinflation story, for example, the China story. We get the disinflation story out of Italy. We get the disinflation story, not Italy, excuse me, out of France. We get the disinflation story out of Spain. And then Italy comes and surprises to the upside with respect to inflation. So how do you really get a handle on what exactly is going on?
German inflation a little bit later as well. If you're interested in the views of JP Morgan's Jamie Dimon, conducted an interview with him overnight in Asia with our colleague, good friend Stephen Engel. Going to play some of that for you through the hour, so look out for that. Jamie Dimon on the debt ceiling, on China, and on US interest rates as well. Before we get there, we've got to catch up with Emily Rowland, co-chief investment strategist at John Hancock Investments. Emily, credit where it's due. I've been speaking to you all year. You push back against that Europe euphoria. You remain committed to the growth equity story. The United States over the rest of the world, not the rest of the world over the United States. Emily, are you sticking with it?
Yeah, John, we are, absolutely. And it does feel like markets are sort of getting the memo right now in terms of the macroeconomic environment. You know, we're looking at decelerating growth, as you all have mentioned, disappointing data overnight in China. This morning, we saw Japan industrial production and retail sales both disappointing. And you've seen this big rotation into U.S. markets, and that's been exhibited by a lot of the cross-asset action, seeing a bid for treasuries finally over the last couple of days here. You're seeing the dollar get a bid. And of course, this massive rotation into U.S. quality growth stocks, which we've talked about for some time. So that's got some key implications for portfolios, especially if you think about, you know, some of these trend following strategies that have bought, you know, Japan, they've bought Europe based on positive price momentum. You might see that reverse and actually exacerbate some of the flows out of those areas of the market.
You're going to get me in trouble mentioning the trend following strategies. Emily, I'm glad you mentioned Japan. We haven't mentioned that this morning, and those were shocking numbers. Within this is sticky inflation. Everybody's doing real analysis, but we live in a nominal world. Are we going to be surprised by okay revenue growth that supports U.S. blue chips?
Well, I think it's a great point because inflation has definitely helped these companies that have a lot of pricing power, especially companies that have high operating leverage. And we've seen that be absolutely critical in terms of supporting margins. We think it's going to be hard to sustain that going forward. Of course, bottom line costs are elevated, whether it's the cost of capital, wage growth still fairly elevated, though there are signs that that's coming down. And then clearly demand is starting to slow. We're seeing that way back in the supply chain. If you look at things like the ISM index of new orders, which is our favorite leading indicator. No offense, I know everybody has a favorite leading indicator, but that's ours at John Hancock. And that's going to put pressure on margins. It's going to cause companies to need to defend their margins going forward. And that's ultimately going to result in the unemployment rate rising. We haven't seen that happen yet, but we think that that's something that comes in the next couple of quarters here.
There's been a growing theme in a lot of the notes that I've been reading about this inflection point that we seem to be coming up upon. Not that just that we've been halfway through the year, but also that some of the main factors driving the first half are shifting. Do you see that as well? And what are going to be the features of this inflection point?
Yeah, well, some of the main drivers that have been supporting the market, we've talked about it, was really China reopening back in the fourth quarter of last year and better weather in Europe, which caused this massive rotation into European equities. It caused the dollar to weaken, which really supported risk assets. There's been almost a perfect correlation with the dollar weakening and risk assets rallying and vice versa. And you're seeing some of those things shift now, again, as this rotation comes back to the U.S. The economic data, not great across the globe, but it's actually better in the U.S. right now, which is a big shift over the last couple of quarters. So stronger dollar, bid for treasuries. We think that's where some of the opportunities are from here. And I think that, again, the market action of the past couple of days to us makes a ton of sense, given the fact that we are in a decelerating growth environment and that recession is likely to unfold.
Emily, great call so far year today on the equity market together with the team. Thank you. Emily Rowland of John Hancock Investment Management. Just on the FX market, we tested some pretty extreme levels going back to late September across a whole range of currency pairs. Let's pick up on the obvious one. Euro dollar, the single currency, dropped to about 95. So right now, 106.77. I don't see anyone out there right now suggesting that we can go back to those kind of levels. But I think these kind of levels have surprised a lot of people too, because there were some calls about getting back out to 115 on the euro. This is where the growth story would be. Remember when I went to London a couple of months ago and every guest lined up to say ECB is going to hike more than the Federal Reserve this year? They may well do, by the way. That might still be the case, but the story in foreign exchange has changed over the last month.
You know, end of May, this is sort of on my mind. I mentioned it a couple times, and Emily Rowland mentions a slowdown in Japan. Obvious data in Tokyo, obvious data in China, obvious data in Europe, and this brings back within a terrible war this idea of the innovation, the buoyancy, the ferment of Europe. Is that belief still there, or will it be tested?
I would tie that also to China, right? I mean, how much of the enthusiasm and the upside surprise in Europe was a complete lack of understanding of the impulse of the reopening, where it would take effect, how much, and how quickly it would run out. And that maybe is where we are now.
This is important. That's a dominant German field, maybe with the Netherlands as well in their manufacturing, export, import dynamic with China. I would suggest Lagarde and the others of Europe are going to have to worry about the many domestic stories of Europe much more than China. It's going to be like, okay, what are we doing in Finland? What are we doing in Hungary?
Sure. Agreed. I think with regards to China, though, there was a misunderstanding around the reopening, wasn't there? Manufacturing wasn't shut down at that point. Re-engaging in services was where the boom was going to be, and that's perhaps what we should focus a little bit more on. Bob Michael at JP Morgan coming up in about 20 minutes. Looking forward to that from New York City this morning. Good morning.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. The European Central Bank is hitting the final stretch of its interest rate hiking. ECB Vice President Luis de Guindos spoke to Bloomberg.
The news that we have received from several countries are very good, are very positive. They go in the right direction. Headline is declining. I think that we have run a very important part of the journey, and we are entering into the final stretch.
The ECB released its financial stability report today. Jamie Dimon says JP Morgan Chase will be in China in both good times and bad times, remaining committed to doing business in the Communist Party-ruled nation as political tensions grow. The CEO of the biggest U.S. bank also says he doesn't foresee a decoupling between the West and China.
Number of young people. Less trade. It'll take years for these things to take place, but it won't be a decoupling. And the world will go on.
Dimon's remarks comes as China-U.S. relations are at their worst in decades. Photos obtained by Bloomberg show Elon Musk at a restaurant in Beijing. The Tesla CEO met more government officials on the second day of his trip to China, having opened his first visit since before the pandemic by emphasizing the importance of maintaining ties with the nation. Now, Musk is expected to tour Tesla's Shanghai factory later today. And a hacking group with suspected ties to an Asian government has broadened its targets to government agencies in countries including Indonesia and Thailand. And that's according to cybersecurity firm Group IB. It says the perpetrators, dubbed Dark Pink, infiltrated targets in 5 new nations using sophisticated malware and phishing emails. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
So far, the jobs report has not been good news for the Fed.
3.4% unemployment.
That's not the picture Jay Powell thought he'd be looking at.
It really signals an employment market that's chugging along
miles from where the chairman of the Fed wants to be.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
It hasn't been a widespread job loss.
The tightening is yet to show up.
Fed's not going to quit until the labor market quits.
The May Jobs Report, Friday on Bloomberg Television and Radio.
I'm not sure what in the bill people are concerned about. It is the largest savings of $2.1 trillion we've ever had. These are major victories. I understand people get upset about walking through a debt ceiling, but this is a House, a Senate, and a presidency.
We're going to make sure that the country does not default, but we also are going to make sure that Kevin McCarthy and my colleagues on the other side of the aisle, of course, uphold their end of the bargain, which is simply to produce a sufficient number of votes.
Classic effort to spin on Capitol Hill. Speaker McCarthy there with House Minority Leader Hakeem Jeffries. Hakeem Jeffries, by the way, catching up with our colleagues on Balance of Power, Anne-Marie and Joe Matthew down in Washington, D.C. It's about shaping the optics. House Democrats want to turn around and say, we're not going to default now because we're going to bail out our Republican colleagues who won't vote for the deal that Speaker McCarthy agreed to with the President of the United States. You can see how this is going to go, Bramo, down in Washington.
Painful. And yet, when you take a look at some of the substance of the bill, you can really see how the sausage is made, whether it's with respect to that West Virginia natural gas pipeline on one hand, whether the fact that a lot of Biden's initiatives were rolled back. They're still going to try to spin this as a victory. It's sort of this interesting moment of really cross-political wins.
Frustrating, Tom. That's the politics of the moment for you.
It's not Tuesday, it's Wednesday. It's a 4-day work week. It is Wednesday. Thank God that. That's Anne-Marie Horton did that. She dictated that we have 4-day work weeks from now to
as she should.
Year. Anne-Marie Horton with us, Bloomberg surveillance calendar correspondent here. She is exhausted like we all are by this battle. Anne-Marie, I want to go to the foolishness of this all. The Washington Post has Bishop of, I believe, the 8th Congressional District of North Carolina saying, quote, "This is a career-defining moment." This guy won with 69.9% of the vote in the last congressional election. Our dominant Republican congressman throwing moderate Republican congresspeople under the bus.
Well, there definitely is a little bit of a schism at the moment within the Republican Party on the House floor. But by and large, Republicans do expect 150 of them, around that number. And this is what Hakeem Jeffries, the Democratic minority leader, told us last night. That is what he is expecting Republicans to come and vote for this bill. There's obviously the House Freedom Caucus. They had a press conference yesterday. You had one of them, I believe it was Chip Roy, talking about a reckoning that he wants. And this is potentially why you hear swirling of this idea that there could be this motion to vacate for Speaker McCarthy because they wanted deeper spending cuts. But by and large, the majority of the Republicans say, we understand we only control the House. Democrats control the Senate. They control the White House. And in that environment, we were still able to get a deal, and they want to back McCarthy. But certainly, this is, a divide within their party. But that divide has been there for years.
I mean, I look at Marie again. I want to go back to these X number of Republicans that are, standing up. And I guess if the vote was the other way, it'd be the X number of progressives as well. I have no recollection in the past of people winning in their hugely dominant congressional districts, putting at risk their party, putting at risk their speaker. To me, to you with your study of this and you're expert at this, is this a modern occurrence that these basically Southern congresspeople are putting at risk their party?
Well, they're leaning into some of the rhetoric we've seen from the former president, which does have a huge hold still on the Republican Party, about 30%. Remember, it was the former president who at the moment is actually the one that's been silent on the debt deal. We've heard from some of his challengers like Ron DeSantis and Nikki Haley coming out and bashing it. He's been silent at the moment. We know that he has been in touch through reporting from Speaker McCarthy. But it's that rhetoric that he had said where if they don't get the deep spending cuts, you should just default. And it's that kind of tone that many of these on the far right are taking, and they're taking back to their district.
Lisa Ray Norman, South Carolina, over 60% of the vote in the last election. I mean, these are dominant winning Republicans. And I just wonder what they're doing to the moderate Republican group. To me, that's the story.
Which really feeds into the point, Anne-Marie, that you brought up with Ron DeSantis backing, or actually slamming this bill, not backing necessarily Kevin McCarthy. How much is the whole move to a middle not really the dominant theme when you take a look at the general election, when you take a look at the Republican and, frankly, the Democratic parties?
Well, that's how it goes, right? In the primaries, you go as hard as you can to your party's right or left. And then if you win it and you go to the general, you try to become a little bit more moderate as much as you can. I think one of the issues the governor is going to have as he kicks off this tour in Iowa, giving a number of speeches, attending a number of events, is when he bashes the debt ceiling bill. He was a member of Congress at one point not too long ago and voted to increase the debt ceiling without the deep, deep spending cuts that he's now talking about. So this could potentially also hurt them, but this also just makes sense, right? They're all trying to play to a base. The former president has 30% of the Republican Party, and anyone that's going up against him and trying to challenge him is trying to knock at that 30% and trying to be someone that they think the rest of the Republican Party can coalesce around.
Meanwhile, we are hearing about new entrants into the Republican primary, potentially with Chris Christie of New Jersey potentially getting in on the game. What does this tell you, not necessarily about Chris Christie potentially winning, but also just with respect to the field?
Yeah, I think Axios reporting today that he plans to announce as early as next week. There was reporting earlier that, there's a super PAC building behind him. I think it just shows that we are a long way off from the U.S. election. It is next year in November, and you're going to see more names start to come into the race. I also think it's potentially a question mark on Governor DeSantis, which many thought he was going to be, the heir apparent if it wasn't going to be Trump that could take on this race. Obviously, you've seen mega donors hit pause on him. There seems to be some concerns with whether or not it's taking on one of Florida's largest employers, Disney, whether or not his backtracking and how he feels about Russia's invasion of Ukraine. That definitely starts to irk and make, the hair on Republican hawks start to rise. Then potentially others are starting to say, maybe there is a path for me. And it's not just Governor Christie, former Governor Christie, who we all know what makes it complicated for him is that he actually was a huge Trump ally, and now he goes on and bashes him and definitely does not agree with the former president. But others, there's reporting that Glenn Youngkin, the Virginia governor, is also taking a second look at potentially getting in this race.
So, AMH, you've got this anyone but Trump in the coalition of that within the Republican Party, and they're all diluting each other. They're hardly being heard. At some point, don't they all have to get round a table and decide who is going to be the challenger?
Yeah, I think one of the most interesting things Governor Sununu told Joe Matthew and I was early on, he said, what is so important about 2024 is when do you get out? Sure, open the field as wide as possible, make the scope and breadth of this race as wide and fruitful as possible. Let's have a proper debate, but know when to get out so that everyone can coalesce around someone else that is not the former president. The issue, of course, they all have is the former president just sucks up the oxygen in the room. Look, DeSantis is in Iowa, and he's trying to make this push there.
Yeah.
The former president's going to Iowa today. He's having a town hall with Sean Hannity that's going to air tomorrow. Very difficult for anyone to try to break through.
When do we get the next poll that shows how foolish this discussion is? What is Chris Christie polling? 2%?
Narrow. What I'm seeing right now, and I'm pulling up Real Clear Politic, is a very, very narrow margin. Narrow market for him.
I yearn for London politics. I mean, it's just like...
Can be brutal, though, Tom.
Well, it's short. It's easier.
The best thing Anne-Marie said there is the election's a year and whatever away.
I know.
And we have, 14 Republican candidates?
It's more
Lisa,
time for
you
people
run?
to stand up.
You mean Lisa could run far
I'm
left
going
of
to
the
announce
Republican group.
right now that I am not going to run for office.
AMH, thank you. I know someone who might.
Yeah.
JP Morgan's Jamie Dimon. I love my country, and maybe one day I'll serve my country in one capacity or another.
Really not slamming down speculation of a run when a lot of people
It's
have
the
talked about
greatest
that.
trade in the world.
What?
You leave the bank, got all those shares, become the Treasury Secretary just for a heartbeat, and you make that trade. Oh, it's beautiful. Tax-free. Tax-free.
You think that's what's going to happen?
He's a patriot. That's not what this is about, okay? Be serious. It's
Okay,
war.
hold on a second.
you're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Equities closing out the month of May, just a bit softer. Year to date, though, much better than anyone anticipated. Month to date, pretty decent too. On the Nasdaq, at least. On the Nasdaq 100 this morning, down by 0.2%. On the month, up by more than 8%. What a run that's been. Left behind the equal weight S&P 500. The market cap weighted stuff just about negative this morning by 0.3%. And this has been developing, and we've talked about this a million times over the last several weeks. This move in the Nasdaq has been developing even with this move in the 2-year, in the bond market. Take a look at Treasuries this morning. Yields come back a little bit by a couple of basis points, but the fact we're at 442 and up on the month by something like 40 basis points, and still we've managed to grind out a gain of more than 8% on the Nasdaq 100. You can thank the likes of Nvidia and others for that one. Thank China for this one. A weaker euro. PMI's out overnight. As soon as they drop weaker, bang, euro weaker too. 106.83. Break of 107 in the last 24 hours. Haven't seen 108 for about a week now. Will we see it again anytime soon? Based on the incoming information we're getting from China at the moment, Lisa, which is weak growth, weak growth.
And how much is this really going to drive the narrative for the second half of the year? The first half of the year really was dollar weaker, China growth, then weaker China and dollar strength. Do we get sort of the opposite coming in? I'm looking at some specific names. We want to look at NVIDIA. It has soared 31% over the past 3 sessions. It's taking some profits right now. You can feel that kind of churn right now. That's not going to drive the market, and that's why perhaps you're seeing a bit of sogginess in the market. Hewlett-Packard Enterprise, I think, is interesting. Those shares lower by 8.3%. Those shares largely down on the year already. And what this shows to me, yes, they had second quarter revenue and current quarter forecasts that were below expectations, but still, to me, it's the have and the have-nots. It's not just a tech story. There are some pretty big losers underneath the tech story, even still. And Avis up after Deutsche Bank recommending that people buy simply on a valuation story. Those shares are lower on the year, even though people have been renting cars. Again, what I find interesting is the churn. These stories that people are just looking to pounce on maybe for a day, 2 days, for a valuation story, not necessarily because of a fundamental issue.
We call that a valuation trap, is what we call that.
Well, what this is called is a market that doesn't have a clear direction. And even if you have a clear view on the economy, it's not clear that the market will cohere with that based on some of the big drivers of the gain so far this year.
Car rentals are just a money pit, right? You notice that? You turn up, sticker price is never the price, particularly in Europe. I have this difficulty. Whenever we used to go as a family, it was always problematic. You go to Europe, not going to pick on a name, Hertz, Avis, whoever you want. You'd go over to Europe, it would always be a problem. It would never be the sticker price.
Of course not. You have all the fees. If you get sucked into the insurance, the extra added insurance based on your own insurance, if you're going to do that, that's another fee. If you have gas or not gas, all of these questions, you sort of no. And then if you crash the car, you're screwed.
You get into the parking lot, family of 5, Fiat 500. That's always the way. I can see my childhood. Slew of Fed speak today. Collins, Bowman, Harker, Jefferson on tap. Cleveland Fed President Loretta Mester speaking to the FT and saying, quote, "I don't really see a compelling reason to pause. I would see more of a compelling case for bringing rates up and then holding for a while until you get less uncertain about where the economy is going." Here's some good news. Bob Michael takes the other side of that, of JP Morgan Asset Management. saying that we are going to get a pause. We expect the Fed to pause hiking rates at the June FOMC meeting and believe we have seen the last rate hike for this cycle. And the good news for Bob Michael is it sounds like his boss agrees with him. Take a listen.
You know, my simple view is that, you know, they're right to pause at this point. It's been a big increase, you know, 500 basis points or so. Take a pause. But I do think it's possible they're going to have to raise a little bit more.
Take a pause. Sounds like a Fed official. Ready to go.
No, he looks like
Treasury Secretary.
Treasury.
Right, okay.
He looks Mellon-like.
Ready to serve the country.
Andrew Mellon, yeah.
Yeah.
Did you see Bob Michael as undersecretary?
I can see that happening.
I can see that. Joining us now, Robert Michael. Bob Michael, head of fixed income, J.P. Morgan Asset Management. And I want to go back to 1984. You're a youngling at Bankers Trust. Ian Rush is with Liverpool. They're doing better than good. This is way, way back. And the basic idea is we used to clip coupons. Would you be sitting with Mr. Diamond now saying that we can make coupon and total return now? Are we going to see price up, yield down in a basic bond portfolio?
I can't tell you how relieved I am not to hear him tell me that I should be preparing for 7%. So I'll take what I can from him, that we're due for a pause and that should relax the markets. No, 100%. This is the time where you clip coupons because yields have reset materially higher from where they were at the end of 2021. Actually, when you look at real yields in the bond market, they're the highest level going back 15, 17 years. We're going to get some capital appreciation on top of the coupon clipping. I'm looking for close to double-digit returns on the Bloomberg aggregate over the next year.
This is a key statement, and what's important about this is Mr. Diamondback to Bank One actually knows what an S&P Blue Book is. I mean, you have a Blue Book and you have bonds in it, and you go through and you try to buy bonds for price up, yield down. Which kind of bonds will give you the best pop there to get your double-digit return?
Well, we're certainly intermediate government bonds look good to us. So we're thinking the 5-year Treasury. We feel we've been given a gift in here with the backup in yields. Sure, we swung a little bit low in yields. The market got all excited. Now it's going the other way. We do think that we're going to see 3% across the coupon curve by the end of the summer, and the 5-year seems to be the sweet spot. So we like that. And then we like high-quality credit. So for sure, we're going into investment-grade corporates. We're actually starting to see a lot of overseas investors returning to the U.S. investment-grade corporate bond market. They're attracted by the yields there.
The yields here, John, and it falls right into the disinflation, deflationary Chinese impulse.
Let's unpack some of this.
Huge statement.
Just on the yield curve, for people who aren't familiar with what drives different parts of the yield curve, what is special about a 5-year maturity? Why is that the sweet spot for you?
Because it gives you a couple of things. One, it gives you a reasonably high level of yield. Sure, it's not cash. Cash is sitting out there at over 5%, but that's the cash trap at this part of the cycle. You put money there, and then a year from now, it's gone. Your cash run rate is probably below 4% a year from now. So you've lost all of that, and then the yield curve starts to adjust to a central bank that's cutting rates again. We still think we're going to be in recession by the end of the year. Everything that's happened so far this year continues to tell us end of the year recession and first Fed rate cut in September. And I know the recent data throws some of that into speculation. Not in our book. Things are playing out the way they should exactly.
So 5-year in the Treasury market, one, got it, okay. IG, tons of demand coming from abroad, got that okay. High yield, you've got within your call a rate cut call in September. Does it make sense to be buying high yield and taking more credit risk at a time where the Fed's going to be cutting rates because you anticipate the economy is going to weaken?
So I'm listening to the conversation at the start about the equity market and how we're isolating NVIDIA, and a couple things have driven this rally, but there are other things that are lagging. Now, I'm a bond guy, which makes me an equity market expert. But I see a lot of, I see a lot of, yeah, exactly. I see a lot of what's going on in the equity market and the high yield market, and we've parsed through all of this. And what you're looking at is the CCC universe is 1,000 basis points over. So it's already coming under pressure. And the double B universe is in the 300s over. So that differentiation is already occurring. This is very different than where we were back in August, September. Whenever we hit 600 basis points over, pretty much most of the market was about 600 basis points over. That was probably the time to take a shot over the near term. Now is not. Now the market is telling you there is differentiation beneath the surface. Investors are seeing cracks forming, and they're trying to get out of the way.
You said that things are playing out as they should, to get to a recession by the end of the year and to get a Fed to cut rates by September. Does that mean that we're in this sort of inflection point, that we're going to see a rapid deceleration in some of the economic data in a way that we just haven't yet with all the upside surprises?
Absolutely. And we've talked about this before. From the last Fed rate hike until recession, it's historically averaged about a 13-month period. So that long and variable takes time. We're now getting into a year and a quarter. We're going to start hitting the window when the 475 basis point rate hikes start to hit. And you're already hearing about the funding pressure to businesses and households at a higher rate level. It's causing them to rethink things. And then the higher cost of everything, that's causing them to rededicate where their spending goes to. So that catch-up is coming. In some of the inflation data we're looking at, Europe overnight or this morning came in soft. And I know Italy surprised a little bit to the upside, but everything seems to be slowing down. The one thing that seems to have gone under the radar, forget about what's going on in China, look at the Bloomberg Commodities Index. It was 140-ish about a year ago. It's below 100 now. And the trend is diving south at a rate that you only see headed into recession. So the weakness is there. The cumulative and lagged are catching up.
This is important. A lot of people push back against commodities being a real signal this time around. They say this time is different with a lot of different things, and I could see.
Right, you don't use them for anything.
But hold on a second. But here's the issue. People saying that because of China and the inability to get that right, because of Russia and their willingness to pump much more than their allotted amount to try to get money to fund the war, because of all of these issues, you're seeing distortions in the commodity market that do not comply with what you're seeing on the ground. How much are you using this as a key signal saying we're where we should be?
Well, you still have very low unemployment in the U.S. Everyone's talking about 3.5% unemployment. Everyone's talking about wages have gone up and that there's a stickiness to core inflation. Everyone's talking about consumers want to spend on travel and leisure, so that the demand is there. But if the demand is at a high enough level, you are going to see commodities prices pushed higher. People are spending on things and buying things. It's just not at a rate that sustains itself with the amount of supply we're now seeing. The bottlenecks have cleared.
Bob, this is awesome. We're going to talk more about this. Bob Michael at JP Morgan Asset Management is going to be sticking with us. This long-held view over the last several months, Tom, that I think has got your attention, my attention, Lisa's attention as well. It's the whole curve back down to 3%, and these cuts come in September.
A number of houses have this call, and with it, optimism, price up, yield down, but I would say it's an outlier call right now. I mean, I think people are just inured to these high yields that we see, and maybe they drift away with the debt ceiling getting this fixed, but we're going to come back and talk about this. It's important.
That conversation coming up shortly. Right now, your 2-year at about 4.42. Right now, your equity market near session lows, just off them. We're down by 0.4%. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The debt limit deal heads to a House vote today after squeaking through the House Rules Committee by a 7-6 margin. Meanwhile, JP Morgan Chase Chief Executive Officer Jamie Dimon says he's optimistic about it.
So I wish that one day we get rid of the whole debt ceiling thing, but I understand when, it's a democracy, people have different opinions about what we should be doing, and it's just one tool for one party to, get the other party to the table. So I'm quite optimistic there, and I really do applaud the fact that they all sat down and spoke, got something done.
The nonpartisan Congressional Budget Office estimates the deal would cut deficits by $1.5 trillion over a decade. The U.S. urged Serbia and Kosovo to immediately de-escalate tensions in northern Kosovo after clashes injured dozens of peacekeepers and protesters. U.S. Secretary of State Antony Blinken blamed Kosovo's Prime Minister Albin Kurti's government for, quote, unnecessarily inflaming ties with the minority Serb community. Now, Blinken urged newly elected ethnic Albanian mayors to avoid working in predominantly Serb towns where violence erupted this week. South Korea's spy agency says North Korean leader Kim Jong-un may be suffering from a sleep disorder. The National Intelligence Service says North Korean authorities are intensely collecting overseas medical information for top-ranking officials with insomnia, including details on medications used to treat it. Meanwhile, North Korea has confirmed that an effort to launch a military spy satellite into orbit failed. The official news agency reported a rocket crashed into the Yellow Sea after losing propulsion in the second stage of the ascent. The launch initially prompted missile alerts in both Japan and South Korea. Pyongyang says it will attempt another launch soon. I'm Lisa Mateo. This is Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of pre-work before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. You know, lots of testing, lots of thinking about what could go wrong, lots of research. You know, when I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority. A multi-trillion-dollar industry. There's a lot of ground to cover.
A record year of growth, hand over fist all year.
We're just getting started.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
When we do business in the country, and we do business in 100 countries around the world, we are there for the citizens of the country. And we're there, hopefully, through good times and bad times. We tend not to leave. If you have more uncertainty, some of it caused by the Chinese government, well, of course, it's going to not just change foreign direct investment, which has gone up a little surprisingly, and I don't think they should assume that's going to continue, but it's going to change the people here, their own confidence, their own ability to invest and do things. China's obviously going to do what they think is good for itself.
JP Morgan Chase CEO Jamie Dimon back in Shanghai. Not the only one this week, actually. Not just JP Morgan's Jamie Dimon, but also Tesla's Elon Musk over in China as well, talking to the government. We should go too?
We should go.
You'd like to make that happen?
Do the show on top of the Peace Hotel at the Bund in Shanghai.
Isn't it nighttime?
Yeah, but, sun setting, through the
romantic.
It's very romantic. I was looking at our Hong Kong building once, and I saw the rain coming in, and the lovely next to me informed me, Tom, that's not rain,
no idea.
That's smog. No, the rain was coming in, John.
I've
and
heard
it was
this story
smog.
before, yeah.
Yeah,
You told me that, yeah.
Okay.
Yeah. Like old jokes recycled.
Yeah.
Okay, let's.
We gotta move forward.
Granddad, we did this. You told me 5 minutes ago.
John, save me. John, save me. Euro 106.82.
Okay. What do you want me to say about it? Data out of China.
It's a big deal.
Data out of China weaker than expected overnight. And you can plot the chart, by the way. Just go intraday, look at the time where the China data dropped, which I think was like 9:30 Eastern time, and you can see straight afterwards, Euro, boom.
Oil 67.54. We continue with Bob Michael. What a pleasure to have him for the entire half hour ahead of fixed income. JP Morgan Asset Management. I want to recapitulate what you said in the previous section. You are looking in the vicinity of Labor Day for a 3% market. Nobody listening or watching believes you. That's massive price up, yield down, isn't it?
It is. And, you know, we talked a little bit during the break about 2008, and I want to go back to that because March to June 2008, while the world's property market was melting under our feet, the 5-year Treasury went from 220 to 3.75%. It rose 155 basis points. This time, 75 basis points, it's laughable. So you can have these counter-trend sell-offs in the market, but the broader trend is growth is coming down, inflation is coming down. The peak in inflation, the peak in bond yields was last year. We're going to have lower highs and lower lows.
And John, this folds right into that stunning headline a couple weeks ago from John Williams of the New York Fed, looking at an R-star, which is a lower rate regime.
Before we get there, I want to talk about what's happening in the property market. It's one of those things that we can all see in commercial real estate. We can all see it with our own eyes, what's developing in cities across this country and elsewhere. And then you speak to professionals in the market who know about CRE and this important stuff that I don't get. They tell me everything's okay. It's going to be all right. This isn't going to be a problem. There's no crisis here. What do you see?
I see an imbalance. I've traveled through the U.S. a lot this year. I've been to 9 cities. Suburban office space demand is very, very high. But when you go into central business districts, the offices are empty. And those used to be flagship properties before COVID hit. So I go back to 2019. I think about all the commercial mortgage-backed securitizations we bought. I think of the REITs that were put together. What you wanted to see in there was central business district office space. It was 99% leased. And what's going on now is there's nobody in these buildings, but the leasing rate has dropped from 99% to 85%. So the appraiser comes in and revalues it for that, not for the fact that as more leases come due, they're not going to roll over. So I do get very concerned about that. It again reminds me, and I don't want to keep going back to 2008, remember the subprime residential real estate market? It's so small. It's not the U.S. housing market. It doesn't mean anything. And I'm hearing the same garbage about central business district office space. It is significant. It was the flagship trophy properties, and these buildings are still largely empty in too many cities.
The big pushback that I hear from people when I raise this concern is this time is different because the leases are much longer. It will take time for them to roll over, so there's some capital that's been locked in. A lot of the revaluation has been happening already in a very controlled way, and there are bidders that are coming in. How do you push back in the sense that this might not be necessarily a slow rolling depreciation that can be controlled into something that will force the downturn to accelerate and the Fed to cut rates?
I think at some point in time, the cost of carry is too great. And I think about Houston property in the early 80s when everyone talked about, oh, you know, oil price collapse. If you could just afford to carry this property, you could make a ton of money. And guess what? You couldn't. People were going to the sale of their homes and writing checks for somebody to take their house. So yeah, Houston property came back in a big way, but at some point you just get tired of carrying the property. We're seeing some of that already where you see the property holders in some commercial mortgage-backed securitizations go, you know what? Here's the level of debt. Here's what I think the properties are worth. Here are the keys. Good luck to you.
So just to put a bow on this, there is this issue of whether you think that commercial property devaluation is what's going to trigger the Fed to be forced to come in and cut rates, a call that is out of consensus at a time when the Fed wants to push back against just that kind of idea.
Well, it's not just commercial property. I'm not sure how we wound up there, but there are a lot of other things going on, right? The regional banking system is still on life support. Many of the regional banks have their entire securities portfolios on repo to the Fed at par. And they're trading in the 90s, and they've got that cash at par sitting there to meet depositor outflows. Their loan portfolios put in place when SOFR was 1/8, not 5 1/8, those are underwater too. Those are now with the Federal Home Loan Bank, so they have cash to meet depositor outflows. We'll know in 2 months from now when we get bank earnings what's happened with depositor outflows. My impression is there's still outflows at the regional banks. We don't know how the regional banks will operate until the Fed, the FDIC, the Federal Home Loan Bank are out of the picture, and we're a long way from that. Commercial properties, the second. The third is just the cost of funding corporate America. As I said, you had an infinite pool of free money available for several years. SOFR was 1/8%. Sure, you're a below investment grade borrower, slap a 4 or 5% credit cost on it. There's your 4 or 5% borrowing rate. Now you're in the double digits, and more of that will be rolling through. I think those are the concerns out there. I do look at the commodity index. I do think inflation is going to fall off a cliff here. And I think the Fed's got this wrong.
You've got 60 seconds left. Huge amount of T-bill issuance is going to come very shortly. Just quickly, with everything you've just said, is that a problem?
It shouldn't be. I'm hoping that it gives banks and money market funds somewhere else to put their money other than overnight reverse repo with the Fed. So maybe that will give us another avenue to invest.
Bob, this was a clinic. Need to do this more often. Come into the studio again. More guests coming around the table for a couple of blocks.
It's fun.
You know, it's fun. It's good to see you.
They come to Midtown, they talk about the crisis in commercial real estate because it's all emptied out. I mean, that's sort of the issue.
We're the only people around.
Exactly.
So you just want to drop by and have a cup of tea and chat. It's lonely out there.
John,
lonely out there in Midtown Manhattan.
John, my anecdotal is it's at least the same, if not it's gotten worse. I don't know what the cheerleaders are saying right now. But it's stunning just to drive through Midtown.
Well, they like to look at what's happening with the subway and what the volume looks like there, and at the airports and that stuff. Look, I see the offices. We all see it. There's no one around.
Yeah. Not in the offices. They are, going out to eat. They are. I mean,
that's James Gorman's problem, wasn't it?
But that's exactly it. I mean, people are still going back to the cities in droves. It's just not the offices.
Oh, I see them out in the town on the weekend.
Oh,
sure. I mean, this was what James Gorman and Morgan Stanley said. The restaurants are still packed. Be very clear about that. The restaurants are still packed.
Yeah.
The offices are not. I'll say this, Bob, don't worry, we'll let you go. The banks, I love the banks who say that we've got to get back to work, get back to work. I saw a wonderful take on this. Get back to work, but then it comes to banking and they cut branches because you don't need to do banking in person anymore. But you do need to do banking in person within the bank. Just, you can do it remotely.
I'm biased with this. Yes, but I'm biased with this.
If you're the client, the customer, you don't need the branch anymore, I'm told. But if you work there, you've got to be there.
You hear some frustrated people. Is that what I'm saying?
Because the culture's important. The culture's important.
Boy.
Update for Bloomberg TV and radio from Tennis Channel. I'm Andrew Guy. Tuesday saw a huge upset in the men's draw as former U.S. Open champion Daniil Medvedev crashed out in the opening round against qualifier Thiago Seyboth-Wild. The Brazilian hit 69 winners in the victory, which was his first in the main draw at a major. And don't forget, you can watch all the action live on Tennis Channel. Our daily coverage starts at 5 a.m. Eastern. I'm Andrew Guy. We'll see you there.
I'm going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It's the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's It's a demonstration of democracy in action.
The moment news breaks, no one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compaq merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question its industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
The economy's in a bit of a weird spot, right?
I'd say that these markets are playing out as you would expect them to play out.
We're concerned about the equity market because it has had such a strong run.
The big shift has been equities and bonds becoming positively correlated.
The U.S. economy is in a very different place from the rest of the world.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. A China slowdown, a commodity slowdown. Bob Michael looking for 3% yields out to Labor Day. And John leading the way in that commodity slowdown. American oil, $67.53. Nothing else has to be said today.
Welcome news for some central bankers, I'd say, Tom, for price pressure. Germany just out with inflation, looking at inflation coming in below expectations and well south of the previous month as well. You put it all together, though, fact of the matter is we still have a 6 handle on CPI over in Germany, Tom, and the pressure will be on the ECB to hike once again on June 15th, I believe. The vector going the right way in France, in Spain, now in Germany, and Emily Rowland mentioning with John Hancock earlier, Japan out with a slower set of economic data today. That is the trend of the morning, again seen in oil and that weaker euro. Growth is going with it, and as anticipated, and front and center are those PMIs out of China overnight. Manufacturing well south of 50 now. That's the line in the sand between expansion and contraction, and clearly in contractionary territory, both in China and in Europe too. And that's why, Tom, we've got a euro that's back down to 106 and not north of 110. And what's fascinating here, Lisa, is the response. I guess, as we talk about the response from the Fed. You've got a whole bunch of Fed speakers today. The response from Europe, the response from Lagarde. How does Beijing respond to this, given the politics of the moment?
The question around stimulus and how much ammunition they actually have. We heard from Bill Lee that they don't necessarily want to increase their debt limit. Jamie Dimon was pretty positive, continuing to be diplomatic and be there. John, as you pointed out, they might be more targeted with respect to how they stimulate specific industries. The larger takeaway here is, yes, disinflation, but the flip side of that is, as you were talking about, slower growth. So are we on the tipping point? I keep going back to this tipping point of just sort of a moderation, an immaculate disinflation, or something that's a little bit more violent, akin to what Bob Michael was just talking about. We've still got a massive distinction between manufacturing data bad and services data pretty decent.
That's true in Europe. That's true in the United States, and in some way, shape, or form, true in China too.
Which perhaps is the reason why you saw Italy, for example, surprised to the upside with respect to how much inflation was coming down, because maybe there's more of a services side of the economy and less of the manufacturing side. And Germany is going to disappoint. The point here is, how do you put these together? Which is going to catch up with which at a time when people are still flying around at an incredible pace?
Still pandemic economics. Still, we had this massive pull forward of demand of certain things. Goods, we wanted to buy stuff. We had to push out demand for services, couldn't engage with the economy in quite the same way. Go to an airport at a city near to you and you'll see what we're talking about.
Yes.
Bramo, you lived it over the weekend. It's kind of crazy right now. So services are screaming, let's go hike. Manufacturing screaming, let's go cut. And to your point, how that settles out in the coming quarters is going to be the story, I think, ultimately for the year.
And just when you take a look at forward-looking, we didn't even mention this, American Air came out and basically increased its expectation for its earnings because of exactly that kind of trend. You take a look, though, at what's going on in the commodity space, and it does raise a red flag that's hard to ignore. And I think that's the reason why people keep gripping onto it.
Exclusive NVIDIA, under $1 trillion.
There we go. We're tracking that one closely. Where are we now, Tom?
394, we're down 1.7% off yesterday. But, it's amazing how 24 hours ago it was about AI and tech to the moon. And now we're looking at that global slowdown again back to April 6th and what IMF called for.
Well, I think it's part of the same story, isn't it?
Yes. I think that that's a really important concept of, frankly, technology substituting for so much more. And that's how you get to that manufacturing
We were all
slowdown.
searching for growth over the last 10 years, and we found it in equity stories. And that was basically the FANG story of much of the last decade, Tom, with low levels of growth, inflation, low rates, all of the above. What's been curious about this year is we came into this year, and I think we've kept going on about this, about how we've just eaten away at consensus views, just hammered away at them. Year to date, tech, not going to do well. Last year was ugly. Guess what? Tech, ripping. NVIDIA, fantastic. Consensus view, China reopening. That's where you want to be.
That worked out.
China, equity market, bear market. The dollar, get short the dollar, get long the euro.
That worked out.
The euro back down to 107. Take your pick. Just kind of beating up on consensus positions across the board.
Can I just apologize to whoever's watching this and just throwing things at the screen? Like, why? Why are you having to pick on me? But it's so many people.
We're coming up tomorrow. We're going to have our sell in May and go away summary here. And I'm sorry, that's what the data is. And John, you see it in DXY 104.42. Give us a little bit of data here.
It's sell in May. NASDAQ 100 up 8% for the month and some. Pulls back a bit. We're down about 0.4% on NASDAQ futures this morning. On the S&P 500, similar move on the S&P, and we pull back on yields. Down by 4 basis points, Tom, 364.
Alex Chaloff to provide clarity here. CIO Bernstein Private Wealth Management is way. You got to write a mid-year review, Alex. What do you do here? How do you change from 12/31 after the surprises of the first 5 months of the year?
Yeah, Tom, actually, I'm going to have ChatGPT write the first paragraph of my mid-year review, and then I'll write the second one, and I'll just throw it back to our Bernstein clients to tell me which one they think does a better job. But look, we're clearly in a transition period. We're going to have an earnings recession in the back half of the year, and I know people in the financial services industry always talk about the back half of the year. It's never now. It's always, in the back half, this X, Y, or Z will happen. But it's clear that earnings have to come down from where they are. Market's pricing in 2024 more than it is 23, looking past potential pause, potential hike, one more priced in, looking past the debt ceiling morass, which we would agree you should look past. But this is all about next year at this point. I think that's part of the reason why the market's behaving the way that it is. Investors are looking to next year.
What are people getting wrong right now? And I say this with great humility because everyone seemed to get everything wrong heading into this year, including us, including myself. I'm just wondering from your vantage point, where potentially the framework could be off.
Well, I think that there's a broad narrative that the market, air quotation mark, is up. And it's true. The S&P obviously is up nicely this year, but it's probably the thinnest rally that we've seen forever. Just a couple minutes ago, I was on my Bloomberg, and I put in SPW Index GP Go, and that's I should have said that to do that earlier, but that's the equal weighted. If you look at that index, it's negative for the year through last night. So S&P, the market cap is up 9.5. but the equal weighted is basically zero. That's a 10% spread. So I think what people are missing, oh, there you go. Oh, that's the futures, never mind. What people are missing is the fact that it's not the market that's up, it's just a handful of companies. And so there are attractive opportunities outside of things that have really moved. And I would argue it's maybe a little bit early, but time to fight the momentum trade and look at other areas that should benefit over the next 12 months.
Are you going more into bonds? And I'm piggybacking off of what Bob Michael of JP Morgan was just talking about, this idea that we could end up at a 3% level for the entire yield curve with people piling into bonds, the Fed cutting rates by September, and a full-blown recession underway by the end of the year. Do you take that view as well?
Full-blown recession is probably a little bit overstated. But your original question, are you going back into bonds? We never left bonds. We have weathered the storm in bonds, particularly in munis, and have enjoyed the rally really since last fall. I think that's the secret that not a lot of investors have appreciated, that munis have been really quite strong over the last 7 months. If you look at what's going on in the bond market today, you're definitely, the yields are much juicier than they were a year, 2 years ago. The credit issues, I would say municipals have come off the board. You've got to be very picky in corporates, be very selective around credit. But there isn't the risk of, in our view, a deep recession. We will be in recession. Our view for U.S. GDP this year has a negative on it. It's negative 0.1, but it's basically a zero. And to get a zero for the full year means the back half is a recession. But our view is that the strength in the labor markets is much stronger than any of the other negative forces, and we muddle through and we get through to the other side.
It's amazing to see 3.4% unemployment in America still. Alex, we've got to leave it there. Alex Sholoff there of Bernstein Private Wealth Management. Just on that distinction, that difference between the outperformance on, say, market cap, S&P. Take the NASDAQ 100 this month. If you're just tuning in, I'll go over those numbers again. It's up more than 8% this month. Equal weight S&P is down 3% month to date. That's 11 points of outperformance, Tom, in a single month.
And by no means am I saying buy, hold, sell. Everybody knows I'm very comfortable in triple leveraged all cash. I looked at Procter & Gamble. I looked at Walmart. These are stocks, John, trading at 20 multiples. Huge multiples given their revenue growth, the stolid nature of what they've got. Take a troubled company. We all know 3M is troubled. They're down 62% from their 2018 high. They're down 47% since the beginning of last year. And let me tell you, there's no bid on the stock right now, pricing back to 2013. You can enjoy 3M this morning at under a 10 multiple.
Wow.
I mean, it's trading like Ford Motor Company. But is that how you describe a value trap? And again, I don't want to go into buy, hold, sell here. I'm just saying within security selection, what's really the value of a 12 multiple now or a 9 multiple? You got to be careful out there.
Or on certain stocks where multiples just don't seem to matter at all. Like Nvidia, which is just absolutely flying. That's the equity story on bond markets. We'll catch up with Jean Bavin of BlackRock in the next hour on Bloomberg TV. Got a very, very interesting call. Fixed income is back. Hear that a lot. Fixed income is back. The income part of fixed income is back, yes. But do you get, or will you get, the inverse correlation to risk assets to diversify the portfolio? Now, what Jean Bavin's got to say on the bond market is yes for income, front end okay. What he's saying further down the curve, because he thinks inflation is going to be sticky and the Federal Reserve won't bail people out with rate cuts, he's saying that the 10-year won't give you that performance in quite the same way. I find that interesting.
I find that fascinating. It goes against what Bob Michael is talking about, but it's this fear that the 60-40 won't work. And a lot of people are sticking with that belief and looking for diversification in other ways.
That's tricky. Right now, equity futures just a little bit negative on the S&P 500, going into the opening bell to close out the month of May with another big month of gains for tech stocks.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. The debt limit deal heads to a House vote today after squeaking through the House Rules Committee by a 7-6 margin. The nonpartisan Congressional Budget Office estimates the deal would cut deficits by $1.5 trillion over a decade. Meanwhile, U.S. House Speaker Kevin McCarthy has dismissed threats from Republican hardliners to remove him from his job. The U.S. and European allies urged caution on whether Ukraine should have the right to strike inside Russia. Countries supporting Ukraine are taking varying stances on how it should beat back Moscow's invasion, as Russian territory is increasingly targeted. The U.S. has publicly leaned against the strategy of attacks within Russia. Foreign ministers of the North Atlantic Treaty Organization countries began a two-day meeting in Oslo. Well, they'll discuss Ukraine's bid to join the military alliance, as well as how to boost defense spending. The U.S. urged Serbia and Kosovo to immediately de-escalate tensions in northern Kosovo after clashes injured dozens of peacekeepers and protesters. U.S. Secretary of State Antony Blinken blamed Kosovo's Prime Minister Albin Kurti's government for, quote, unnecessarily inflaming ties with the minority Serb community. Blinken urged newly elected ethnic Albanian mayors to avoid working in predominantly Serb towns where violence erupted this week. Biden administration officials are divided over how aggressively new artificial intelligence tools should be regulated. Some White House and Commerce Department officials support the strong measures proposed by the European Union for AI products. Meanwhile, U.S. national security officials and some in the State Department say aggressive regulation will put the U.S. at a competitive disadvantage to China. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
DOJ or other authorities
Could face bigger challenges. Britain's next.
Fed was going to keep reading World Cup. This is a 3.
As the economic picture does.
To be okay is getting ready to make a decision.
I wish that one day we get rid of the whole debt ceiling thing, but I understand when, it's a democracy, people have different opinions about what we should be doing, and it's just one tool for one party to, get the other party to the table. So I'm quite optimistic there, and I really do applaud the fact that they all sat down and spoke, got something done. I think it's going to happen. If I thought it wasn't going to happen, I probably wouldn't be here right now.
It goes to a vote in the House, and Jamie Dimon at JP Morgan thinks that vote will pass, as do many other people. The fact of the matter is he's in China and he is not in the United States. And I think most CEOs share this view right now, Tom, that this thing will pass.
Yeah, I think after the vote yesterday, Anne-Marie Hordern said that was very important. I believe it was 7-6. I mean, 7-6 is the same as 10 to whatever. I mean, the fact is it passed.
It's tight, though. Tight. Yeah, I'm with you. It's just funny.
To be tight.
I think Jamie Dimon alluded to this, that ultimately this has become the mechanism to actually have a negotiation about the budget in America, because we don't often do that, Tom, do we? The White House comes with a budget and everyone's like, budget, nah, whatever.
I agree, and there's a cardinal rule: fiscal policy doesn't matter in elections. That's tattooed to everybody's brain, both sides of the aisle. First Tuesday in November, debt, deficit, budgets, it's not up the chain of issues.
I'd say the other way around.
Anne-Marie Hordern taught me that.
It doesn't seem to matter when you're in power. It seems to matter more when you're out of power. Have you noticed that's a trend?
Nobody wants to come out and say, we're going to cut your Social Security checks. That is basically political kryptonite. But there is this issue, and we're going to hear this more, and we did hear this from Ron DeSantis. How much is this going to be a talking point this time around?
We're going to go to the congressman from in between the Cubs and the Brewers, Janesville, Wisconsin. Brian Stile joins us now, Republican from Wisconsin, with all that heritage of former Speaker Paul Ryan. Congressman, I'm going to go back to the election of 2018. You won with 51, maybe 52% of the vote. You've done better in recent elections, doing better, like 60% or whatever. I want you to comment on the vociferous conservative Republicans and what they're doing to Republicans who are more middle of the road. What is the damage being done by the strident Republicans to those more in the middle of the road?
This vote is going to be a little bit of a vote of strange bedfellows. I think what you're going to see is at the end of the day, there's some members that are going to allow perfection to be the enemy of the good. All of us, I think, would like to see us get our true fiscal house in order in the United States. This bill is only a step in the right direction, but it's a step in the right direction. It's the largest spending cuts that we're going to ever see in the United States of America. It has work requirements. It helps workers get back to work, and it does all this without raising taxes. Right. And so at the end of the day, there's some people that would like to see a perfect bill, but I think if we have a good bill, you got to vote for it.
Congressman, Jim Garrity in the Washington Post had a brilliant half paragraph yesterday which said, look, the Republicans have a narrow majority in the House. Can you expand that power in Washington with President Trump after this budget debate? Can you get there with Donald Trump in November of 2024 to move beyond a narrow majority in the House?
I think what we're going to see now to the election in 2024 is a lot of voices coming to the table. And I think the one that's going to be successful is the candidate that's going to talk about the future of the United States of America, about how we're going to grow the economy and address the fiscal situation that we're in. We're going to have a number of voices at the table. I don't think that's a bad thing, because I think we need to dramatically change course in Washington, in particular following 2 years of dramatic increases of spending.
A lot of people talk about the real discussion being entitlements and whether Social Security checks are going to have to be reduced, whether Medicare and Medicaid are going to have to receive less funding. Are you putting those things on the table in your discussion about further fiscal restraint?
In this bill, we're only really dealing with 11% of the federal budget, and dealing with 11%, we got $1.5 trillion of savings for the American people. But you're right, at the end of the day, it's the entitlement programs that are driving costs higher. This is going to be an opportunity here to bring Democrats and Republicans to the table to address those programs and truly protect, in particular, Social Security and Medicare for generations to come. But that's going to require a bipartisan approach of folks coming to the table, encourage of candidates who are running for president in 2024 to talk about the reforms that are ultimately going to be needed.
There's a large question around whether that will actually happen, and we've been having it with a lot of cynicism. I'm sure you have your own with insight from inside the Beltway. Wendy Schiller of Brown University was on the show earlier, and she said Kevin McCarthy will remain Speaker of the House simply because the Democrats will back him if the Republicans won't, because at least it will be some sort of cohesive voice that is better than the alternative. Does that concern you, that Kevin McCarthy will remain Speaker, but perhaps only at the behest of Democrats who are concerned about the alternative?
I actually disagree with the analysis. I think Kevin McCarthy will remain Speaker with Republican votes. I actually don't even think you'll see a motion to vacate. We had a robust family conversation last night into the late hours of the evening talking about this legislation. And while it's true, there are some Republicans that would like to see a better bill. They think that they could get a perfect bill. At the end of the day, I think everybody in the room recognizes that this bill is a step in the right direction, and they're appreciative of the Republican negotiating team that moved the ball forward. You got to remember, we started with the president saying that he was going to refuse to negotiate. He put his head in the sand. He went to Delaware, went off to Japan rather than negotiating. And at the end of the day, we came back with $1.5 trillion in savings.
You sound like Paul Ryan on an off day. Come on, Congressman, come on. What I'm hearing in the zeitgeist right now from Anne Marie Horton is the Democrats are taking a victory lap because they pretty much got what they wanted. Moderate Republicans like you are saying, okay, let's get this done and move on. And you got a bunch of people trying to block this and shut down the government. I got to go back to the fact you lived Paul Ryan's decline as Speaker of the House. I want to go from Boehner to Ryan to McCarthy. What does the Speaker have to do now not to be Paul Ryan, not to be John Boehner?
I think actually the Republicans are quite unified in the House right now, and I think that shows when we passed the Limit, Save, Grow Act. Many people across the United States underestimated the ability of Republicans to come together and unify and pass a bill. In fact, President Biden didn't think we could do it either. That was part of his negotiating tactics. And at the end of the day, we came together. I think the Republican conference in the House is quite unified to address the spending challenges that we face.
But, you know, the speaker, okay, I'll go with that. But the answer is, John, the speakership here is under real threat, and it comes up suddenly. Did it come up suddenly, Congressman, for Paul Ryan? Was everything fine, and then boom, you're his aide in office, and all of a sudden, boom, he's under threat by these Republicans?
I was working in the private sector for quite some time, so I wasn't on Capitol Hill for about 20 years before I ran for office. But I think what you see is at the end of the day that these things can rise on occasion. But if you talk to Republican members, we're unified in the House of Representatives. Okay. I think everyone recognizes that this is a good bill. There's just some conservative and Republican members that would like to have a better bill. That's not the bill that's on the table.
Congressman, I'm just a spectator and watching this play out for a long time, both within the United States and abroad as well. And every single time we get into this debacle, we just raise the debt ceiling again and again and again and again. Whether that's a Republican president or a Democratic president, it's the same outcome. We raise the debt ceiling. Brian, you heard JP Morgan's Jamie Dimon come in from the break there saying, I wish one day they'd get rid of the whole debt ceiling thing. Why do we still have it? And isn't it somewhat embarrassing for the president, whether Republican or Democrat, to go abroad to places like Japan, for the G7, to try and lead the global effort on a whole bunch of issues, to then be looking back and have this EM-type debacle playing out at home?
In a period of time of divided government, there's actually few opportunities to negotiate the spending reforms that are needed, in particular a period of time when executive authority has grown so dramatically. In this bill, we actually address the fact that the president tried to dramatically alter student loan payments. That never went through Congress in the first place. Unfortunately, based on executive overreach, what we have is so few opportunities to get spending under control, where the executives, both parties are absolutely right, continue to spend money through executive action. And this negotiation allows us to actually bring the president to the table and have a conversation about how we're going to get spending under control. And I think, again, at the end of the day, this is overall a good bill moving us in the right direction.
Yeah, the one bill aside, Congressman, don't you see where this is going, though, that ultimately, and we're out of time, so if you want to continue this conversation, by all means, come back another time. It just feels like we're in the process now of deliberately manufacturing crises to do exactly what you just explained, and at some point that's going to erode the confidence in this country and potentially the US debt market too. So we've got to leave it there. Congressman, if you want to continue, happy to do that another time. Congressman Brian Steele there. Wisconsin, Tom. These are big issues, and they're not going away anytime soon. Let's be clear about that, no matter who wins the next election.
I'm trying to get a measure of Speaker McCarthy's risk as we move forward here. He had a good day yesterday.
Hornback and Morgan Stanley up in the next hour. Jill Carey Hall of Bank of America, Jean Bavin of BlackRock, all of that coming up in about 30 minutes.
top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
Bloomberg Surveillance, Lisa Bramwitz and Tom Keene, Mr. Farrow, in preparation for the next hour. In the next hour, Lisa, you may see, I'm getting it up here, West Texas Intermediate, are you going to see a 66 handle in the next hour? $67.12. $66 a barrel, Lisa. I mean, that's where you got to go long oil again. I mean, a couple barrels in the living room.
How many people have come on the show and said, it's just a technical trade. This isn't actually something driven by fundamentals and a lack of demand.
And tell that to Riyadh this morning.
But that's really the issue. And all of a sudden now you have the likes of Bob Michael and many others coming out and saying the declines that you've seen in the broader commodity sector is telling us something. It is screaming about a slowdown that is coming.
Yeah, Bob Michael featuring the Bloomberg Commodity Index, which is the old UBS index. Legit math, to say the least. Right now, before we get to Blarina Urici with T. Rowe Price, Michael McKee's going to give us a brief here without 8:30 data. And I got to go something, John. Michael, you lectured me on years ago, which is pay attention to JOLT survey. Are we finally seeing the labor market crack?
Well, we hope so. We saw a decline in the number of job openings last month. When we say last month, it's 2 months ago. So this is somewhat old data, but we are expecting another decline this time. And that would be good news for the Fed, which is thinking that the high level of job openings is one reason that we're still seeing a lot of pay increases for workers, because it's hard to find them. But if it continues to go down, that should take a little pressure off. Still a long ways to go till we get to the pre-pandemic level of around 6-7 million.
We've been talking this morning about Loretta Mester's comments in the Financial Times about going raising rates one more time before pausing or taking a breather. Is that becoming more of a consensus now that there hasn't been a fuller shakeout in the smaller bank sector?
It does seem to be more of a consensus, although the voters, the Fed voters who have spoken, are about evenly divided. I think what you're going to see is Friday and then the CPI report, Friday's jobs, of course, and the CPI report on the 13th are going to be dispositive. So I wouldn't go to the bank with what's in the WIRP Fed Funds Futures argument that there's a 65% chance or so of a rate increase, because that could change depending on the data. But it does look like most people at the Fed leaning in that direction now.
Before we let you go, I do want to get your view on the debt ceiling debate, not necessarily the politics of it, but with respect to the economic ramifications. And one thing that we haven't talked about that much is the student loan repayments that have been flagged will have to start in a couple of months' time as a result of this deal. People are saying this will eat into disposable income, eat into disposable spending in a way that hasn't been accounted for in the economy. How much are you hearing that from economists?
Oh, you're hearing that a lot. It's probably the biggest thing in this debt ceiling package that would affect the economy, because the overall numbers are pretty small, but we could see a compressed period of declining domestic spending if people who are spending that average $369 a month payment on something else right now have to start sending it back to the government lenders. But it's also been pointed out that when they ended the supplemental food stamp program and when they ended the supplemental child care tax credit, we thought that would happen and the effects were much smaller. So it is certainly possible that it doesn't have a major impact on the economy right now. And of course, it'll be a little hard to tease out in terms of other things that have been going on, the Fed raising rates, et cetera. But it will be something to watch.
Michael McKee, thank you so much. The JOLT survey out, I believe, in the 10 o'clock hour. Bluerina Urici joins us right now, U.S. economist T. Rowe Price, here on the shifting tides of the American economy. Just as a basic idea, do you have any handle on second quarter GDP yet? I mean, everybody's waiting on recession, but what's a T. Rowe Price call on where we are in growth right now?
So right now it feels like we're going to get another quarter of positive growth, at least the components that I take more signal from, which is consumer spending and personal consumption expenditure component. We have had a lot of volatility in the inventory data and net trade, but overall, when you look at consumer spending in the U.S. economy, that has been holding up. And actually, a lot of people expected this shift in spending from goods to services, but we actually are continuing to see in the economy that both components remain strong and the U.S. consumer goes out to spend.
One of our themes is a return to American exceptionalism. Country by country, they seem to be slowing down, widely anticipated by IMF and frankly by you. At T. Rowe Price, is America the place to be because of economic growth?
Well, I think we saw that last year, and I think that theme continues, that the Fed was able to increase interest rates faster and sooner here than other central banks because of the resilience of the economy. The U.S. consumer has been strong. I do think, however, that the direction of travel for the second half of the year is one where a ton of headwinds are gathering momentum. So the U.S. economy is going to slow as well, and we're already seeing signs that the labor market is starting to cool down. All those things, I think, are going to play out such that the U.S. will not be as strong in the second half of the year as it was in the first half.
Earlier this morning, Wells Fargo CEO Charlie Scharf was speaking at a conference, and he talked about credit card spending being up 10% so far this year. Debit card spending is about flat, but people are still out there spending in a significant way. He also went on to say that credit quality remains strong and that the demand and the use of some of these instruments is much stronger than expected at this point in the cycle. What are you looking at, Bluerina, that points to something that is softer, that is perhaps an inflection point to a lower growth rate?
So I think a lot of what was happening last year was the labor market was adding jobs and aggregate hours and aggregate income was growing very fast, even faster than inflation. I know when you look at average hourly earnings, that was being surpassed by the rate of inflation, but the payroll proxy that I looked at was not. Now that payroll proxy has been declining because of the pace of job growth is down, but more importantly, hours worked are declining faster than employment growth. So I think this is important. It's an important factor to watch. The other one has been the excess savings story. Remember that we were talking a lot about it at the just as the pandemic ended, whether that was a wealth effect or it was going to be spent by consumers. Turned out last year that consumers continue to spend that excess savings buffer, and I think that's going to run out at the end of this year. And both of those, then you add the fiscal impulse, which is only slightly negative, but it's adding to this momentum that is dragging the economy down. All those factors make me less optimistic about the U.S. consumer later in the year.
Less optimistic isn't exactly the gloom and doom that we're hearing from some people. And I am wondering whether you think that the momentum that we currently have, based on all these indicators, is enough to avoid recession and makes a recession improbable just simply because there still is this savings. There's
no situation. Labor market is key. We'll get the JOLTS data, as you mentioned, later today. One scenario could be that we get the softening in the labor market that we need purely through closing of vacancies, which is something that Governor Waller has been discussing since last summer. And I do think that what we've seen so far seems more consistent with a soft landing in the labor market.
Bluerina, we're talking about lower yields. We heard this from Bob Michael of JP Morgan earlier. Price up, yield down, and there's a raging debate about this. You're in an interesting seat at T. Rowe Price, managing gazillions of dollars here. Is the overarching theme linking your economics with your portfolio managers, price up, yield down in bonds?
So I think lots of factors have been affecting yields in recent days, but zooming out, looking at the 2-year, for instance, from September to date, it's been in this range of 4 to 4.5. I think for most of the time. What is this telling us? I think the markets, in a way, is buying the story that yields will be higher for longer, but probably we are quite close to the peak in interest rates. And so from here, I don't think there is that much upside for yields.
I mean, Lisa, I think this is just a profound idea, and that Bullard and others are talking about higher rate regimes we've got to get to here, and others. I mean, the calendar's moving forward. What Ed Hyman says, or Bob Michael says, or what we hear from Lorena, is something in January or late last year. They're now saying we're going to compress this into 4 or 5 months. I find that extraordinary.
And how much does this have to do also with the China reopening? And Lorena, I do want to just end there really quickly to get your thoughts on how much suddenly the disinflationary push that people are talking about accelerating stems from a China, which the reopening really doesn't seem to be as powerful as many people expected it to be.
I think the China economic growth story looks very different than it did 10 years ago. I don't think they're going to drive economic growth through investment as they did, and I think this has repercussions for global inflation and global demand on commodities, and I think we're seeing that play out.
Lorena, thank you so much. Berlina Arucci with us with T. Rowe Price here on the American economy and the raging debate forward. Maybe a softer tone that we heard from Bob Michael. Are we lucky on this day of China data? I mean, we say we're lucky, but you know it's our team doing it. You and I are taking the surveillance nap, and the team is working 24/7. Bill Lee with us earlier with all of his IMF cred. And then having Leland Miller come up is just exceptionally fortunate today.
To understand the on-the-ground reality behind the pretty disappointing PMIs that came out, how much is this just manufacturing not keeping up and services continuing to chug along? How much, and this is really the key question, you kept bringing it up, and I think it's a good one, is there really an inability or a complete reluctance by the Chinese government to offer up some stimulus in some capacity?
I'm in the camp here. They don't have a choice because of the mandate of the kind of regime, the kind of politics they are. They've got to keep people employed. Someday I'll be wrong on that, but they got to keep people employed.
From a global perspective, how much that bleeds out into the global economy, though, is as opaque as the reopening has been and as the entire pandemic economy. And this is one of the reasons that's sort of feeding into the uncertainty that you get with a lot of economic views.
And the economic views is, again, and I think of Ed Hyman way out front here on calling for a lower rate regime. Let's remind ourselves the 10-year yield, 3.67%. Where's it going to be Labor Day, Bob Michael? Where's it going to be end of the year, Ed Hyman? And on you go to price up and yield down as well. Coming up, the conversation of the day on China. We had William Lee with us of Milken earlier. Leland Miller of China Beige Book. Must listen, must watch for Global Wall Street. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Jamie Dimon says JP Morgan Chase will be in China in both good and bad times, remaining committed to doing business in the Communist Party-ruled nation. CEO of the biggest U.S. bank also says he doesn't foresee a decoupling between the West and China.
Over time, there'll be less trade. You know, it'll take years for these things to take place, but it won't be a decoupling. And the world will go on.
Dimon's remarks come as China-U.S. relations are at their worst in decades. Photos obtained by Bloomberg show Elon Musk at a restaurant in Beijing. The Tesla CEO met with China's Minister for Industry and Information Technology. Now, Musk is expected to tour Tesla's Shanghai factory later today. South Korea's spy agency says North Korean leader Kim Jong-un may be suffering from a sleep disorder. The National Intelligence Service says North Korean authorities are intensely collecting overseas medical information for top-ranking officials with insomnia, including details on medications used to treat it. North Korea has also confirmed that an effort to launch a military spy satellite into orbit failed. The official news agency reported a rocket crashed into the Yellow Sea after losing propulsion in the second stage of the ascent. The launch initially prompted missile alerts in both Japan and South Korea. Pyongyang says it will attempt another launch soon. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means, for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg. Top experts. Great questions.
When we do business in the country, and we do business in 100 countries around the world, we are there for the citizens of the country. And we're there, hopefully, through good times and bad times. We tend not to leave. If you have more uncertainty, some of it caused by the Chinese government, well, of course, it's going to not just change foreign direct investment, which has gone up a little surprisingly, and I don't think they should assume that's continue, but it's going to change the people here, their own confidence, their own ability to invest and do things. China's obviously going to do what they think is good for itself.
Jamie Dimon in Shanghai with our Steve Engel. Great interview there on the optimism of banking forward on the Pacific Rim with the head of JP Morgan. A lot of conflicting trends today. Lisa, Neil Dutta, who has been very optimistic and correct on a non-recession America, looks at what Bob Michael said, and Michael says rates are coming down, inflation will come down, and what that means is the income we make will be more valuable. Inflation-adjusted incomes will expand. That's been a core optimistic foundation for Mr. Dutt of Renaissance Capital.
Yeah, return of the bond boom, and this is really the key question. I mean, we talked about Jean Bovin going over of BlackRock with John in the next hour. He takes the opposite view, saying that longer-term bond yields are not going to go down as much, and this really goes down to, do you believe that inflation is sticky or not? And that is one of the biggest debates right now, where there really is not a consensus.
If you're part of Global Wall Street, and particularly if you're part of everything that has to do with investing in America, here is your Chinese conversation of the day. William Lee was with us earlier with some real caution off of difficult Chinese data this morning. Leland Miller flat out disagrees. He is the co-founder, chief executive officer of a China beige book with prodigious data analytics of China. Leland, you're more optimistic. What is the data you see in China that leads you to Pacific Rim optimism?
Yeah, optimism is a strong word, but I think people have gotten too gloomy. And I say this because, there was a ebullience earlier in the year that there was going to be this explosive Chinese recovery. It was going to happen fast. It was going to happen a lot like America's. That was never in the cards. China had to get over COVID. So, January, February, even March was mostly taken off. So we're starting to see, April and May, whether there's going to be much of a recovery. Now, some of the latest data have been bad. Some of the stuff that we're seeing has been better than what the government's been putting out. So we're not seeing the worrying falls that have perpetuated this gloom. Stock market falling and economic data being weaker than expected has created a sense of gloom in markets, and we're just not there.
Dr. Lee talks about a dearth of innovation, which comes from a more strident autocracy in Beijing. No question about that. Given the changes that you see off the party Congress, is this a Chinese leadership that can still use traditional monetary and fiscal stimulus to goose the economy?
Well, the economic model still relies on that in part. They're just a lot more restrained and, constrained from being able to do it in the way they did before. So, yeah, I think that there are elements that, as things get worse, they're going to be under more pressure to stimulate. And look, I think the mistake right now is people think they're not stimulating. We've seen a lot of policy support already this year. We're seeing rates sliding. We're seeing loan rejections falling, which means the government has been more permissive in credit provision. So it's not nothing. It's just that they haven't resorted to the big infrastructure build out. They haven't been building in order to stimulate growth. I think they want to stay away from that, but they are being supportive on the monetary side. So policy support is there. It's just not what it was in the old days.
Leland, you said that people have been too gloomy on China. Where specifically are people underestimating how much strength there really is?
I think there's two places. The first is, everyone's shaking over this latest manufacturing PMI. When we look at our manufacturing data, we're not seeing gloom in terms of orders. Domestic orders are okay. Foreign orders are okay. They're weaker to the U.S. and Europe, but they're stronger to Asia. And then when we look at this consumption recovery that everyone's been expecting but hasn't seen, we're starting to see elements of that. The problem before it's been uneven, and you've seen sort of travel and hospitality go up, and then they go down and something else goes up. We're seeing better data in May than we saw in April, which was better than March. So, we're seeing not the recovery that so many people unrealistically expected earlier this year, but we're seeing a recovery that's there and defies a lot of this total pessimism in markets over China's economy.
How much of that recovery is in domestic spending and not international spending? On basically an economy that is contained within China and doesn't necessarily percolate out in the same way that traditionally Chinese economic activity did?
Well, I think that's exactly the positive story, that most of this is coming from, domestic demand. You look at our inflation gauges. We're seeing strengthening prices. We're seeing strengthening jumps in all our inflation gauges across the board, which are showing more domestic demand. Our domestic orders are up. Look, it's a relatively weak international, global economic environment. Manufacturing in China has been going like gangbusters for years, so we're not expecting manufacturing to lead. But manufacturing is doing okay, and we are seeing retail and services do better each and every month. So as long as you calibrate your expectations, this is not the massive disappointment that everyone's making it out to be, at least yet. We need to see the data through June, and then we're going to be able to make a better call on this.
How does that affect your longer-term view of slowing growth? We were talking with Bill Lee of the Milken Institute, formerly of the IMF, and he was saying he sees potentially below 5% this year, but then going down to a 3% kind of level on an annual growth perspective. Do you kind of take the same kind of view?
Absolutely. I'm glad you pivoted to that because, look, this is a cyclical bounce back. You're seeing there's a lot of reasons why 2023 growth will be better than 2022. COVID zero's off. You've got a better base of comparison to work off of, but it doesn't change the long-term story. And the long-term story is of a significant structural slowdown. Right. So, we've been talking about these numbers, 2 to 3% for years and years and years, and they've been scoffed at, but now people are taking them seriously.
Leon, when we see the unemployment discussions, millennials, 20%, whatever, take us away from the Pacific Rim. Take us away from a quarter of a mile away from the Mandarin Hotel in Hong Kong or whatever fancy place I'm going to stay. What is the people's reaction in China to unemployment?
Well, look, I think the major issue is that with slowing growth, you're going to need to be transitioning jobs from the traditional ones to new ones. And there doesn't seem to be a great long-term plan for doing so. So, the question is, what does the Chinese government care most about? You're exactly right. They care about jobs. They care about employment. They care about stability.
Yeah.
So they're going to have to be providing for this. You have to create an economic growth to be able to do this. If you're just battening down the hatches and saying, focus on semis, it won't do it.
So at the margin, are they competing with Vietnam or a more prosperous Korea? I mean, on a labor economics basis, what's the shortest path to success for Beijing to create marginal jobs?
Well, they think they're competing with Korea and Japan. They're still competing a bit with Vietnam. The model is in transition right now. So the question is, are you able to make that transition without social strife hitting along the way? And look, this is a very dicey proposition. This is a very hard thing to do. So if you no longer have high levels of growth and you're no longer relying on property build-outs and infrastructure build-outs to drive growth, you're trying to transition to a sort of a higher level, economy. It's not at all clear they can do this without problems along the way. So this is why I think people are worried about China in the medium term and long term, and certainly we are.
Leland Miller, thank you so much. Just fabulous here. Great to have you on China Beige Books. Leland Miller, and of course that dovetail with William Lee of the Milken Institute makes for good China analysis. Today we say thank you to Stephen Engel in Hong Kong, his conversation in Shanghai with Jamie Dimon of J.P. Morgan. Lisa, I'm watching here, and it makes for good TV theater, and I've gone down in flames. I need a $66 print on West Texas Intermediate. I didn't get it. I got the 67.06. But I don't even know how to go OPEC plus here on this. I mean, I don't know what the supply microeconomics is for Riyadh here to boost the price.
You know who does know? ChatGPT.
Really?
There was an article that just came out.
Did we hire them?
Yeah, we did hire them. Evidently, hedge funds are increasingly hiring ChatGPT to handle all the grunt work, which I think is pretty much on brand. I mean, that's what I'm hearing from people who are in school.
Can I go mathy here?
Please.
For 30 seconds? Take the longest series I have, which is Saudi Light. It's a Arabian Saudi Light series back to the 1950s, pre-Nixon and all that. And I looked at the collapse of 1986 on a log chart, and you compare that move to now, and it equates out to $40 to $41 a barrel. So we're basically halfway there to a 1986 kind of feel and a plunge in oil. We're nowhere near that agony yet, but there it is.
Big question, how does Riyadh handle Russia? How does Riyadh handle Moscow, which is pumping a lot of oil, perhaps above the quotas and the agreed upon discussions?
We're going to let Will Kennedy and our world-class team on hydrocarbons discuss this. It's certainly a theme here into June. Tomorrow on the program, sell in May and go away. The Bramo Report. We'll have that for you completely. Stay with us through the day. This is Bloomberg Surveillance.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live. And it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Whatever happened to the month of May, closing out the month with some big equity market gains on the NASDAQ. From the month, for the session, we're down about 0.5%. A bit of a weakness, counting it down to the opening bell. The countdown starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, the debt limit deal heading for a vote in the House. One more Fed official pushing for one more rate hike as China confronts a deeper manufacturing slump. From New York, we begin with the big issue, a spat Wall Street is hoping it can forget about.
I'm not sure what in the bill people are concerned about.
I haven't seen the text. You know I'm not a big fan of in principle or frameworks.
Not one Republican should vote for this deal. Not one.
It's our expectation that House Republicans will keep their promise and deliver at least 150 votes.
It is a bad deal.
We should have taken care of this months ago.
Everybody has an opportunity for their own opinion.
No matter what happens, there's going to be a reckoning about what just occurred unless we stop this bill.
This agreement is the responsible, prudent, and very necessary way forward.
Yes, I'm confident we'll pass the bill.
The debt limit deal struck by the President and Speaker McCarthy heading for a vote in the House after clearing a key procedural hurdle. Investors now hoping we avoid any needless political drama, refocusing minds ahead of next month's central bank decision. Cleveland Fed President Loretta Mester pushing for another hike, telling the Financial Times, "I don't really see a compelling reason to pause. I would see more of a compelling case for bringing rates up." Bank of America's Mike Gapen calling it a close call. Even if the Fed skips June, it will keep July in play. He says the data so far supports further tightening. The Fed, of course, contends it is data dependent, whatever that means. The calendar for that data looks a little something like this over the next 2 weeks. And Citi's Andrew Hollenhorst is setting the bar for another move, saying, quote, 200,000 new jobs in data out this week. Another 0.4% month-on-month core CPI reading on June 13th would further cement a June hike. JP Morgan's Jamie Dimon saying they can go further.
My simple view is that, they're right to pause at this point. It's been a big increase, 500 basis points or so. Take a pause, but I do think it's possible they're going to have to raise a little bit more.
Let's get to the Bloomberg team. AMH down in Washington, D.C., alongside Katie Lyons. AMH, I said at the start, this is something Wall Street wants to forget. Do you think we can achieve that a little bit later?
Yeah, Wall Street certainly wants to forget it. To be honest, Jonathan, since the Treasury Secretary came out with her first letter about using extraordinary members since January, I think all of us want to forget and put the debt ceiling debate behind us. It does look like the path is clearing for this to move through the House. You're really going to want to pay attention to the numbers, though. Speaker McCarthy really wants to get a majority of his Republicans over the finish line on this. What we're hearing is about 150. A lot of this will also show with how strong his speakership is. And then, of course, it has to go to the Senate. Now, everyone thinks it will pass the Senate, but it doesn't mean it's going to be an easy process. You're potentially going to have a number of senators come up. They're going to want to make amendments. Lindsey Graham, we know, he is one that wants to see higher defense spending because he's worried about the impact of inflation. You have others like Mike Lee of Utah saying it's not enough cuts. But by and large, it looks like this is going to be able to get passed before, or at least signed by June 5th, when the Treasury Secretary says that's the hard deadline for the debt ceiling.
Katie, get through the House, then onto the Senate. Any problems that you foresee?
Well, as Anne-Marie was just suggesting, you could see any one senator hold things up, whether that be Senator Mike Lee or potentially Rand Paul, who wants to force a vote on his alternative plan. So the procedural hurdles are very large because it does require unanimous consent to actually accelerate the process, which does risk bumping up or maybe going over that June 5th deadline. So default isn't entirely off the table, even if we have the House passage today. Now, on that note, of course, if we saw a default happen, something that has never happened before, that very likely would change what the Fed does in 2 weeks' time. If we don't, though, and this deal goes through, what we hear from economists by and large is that it doesn't have a massive impact on the macroeconomic outlook. You may see at the lower end of the income spectrum, because of the restart of student loan payments and some of the stricter work requirements for entitlements, impact there. But overall, we're talking just a 1/10 or 2% knocked off of GDP in fiscal year 2024. So unlikely to really change the growth picture for the economy. And then, in theory, for the Fed. The one thing we do have to consider here, though, John, something we've talked about at length as we've gotten closer to the actual debt ceiling being raised, is the liquidity implications, the stresses that may cause in a banking system that already isn't the most stable at the moment.
It's a big question. Katie, thank you. Alongside Anne-Marie, ahead of that vote a little bit later down in Washington, D.C., going into the opening bell about 25 minutes away. Equity softer here, negative by 0.5%. Joining us is BlackRock's Jean Bavin, Morgan Stanley's Matthew Hornbeck joins us too. John, I want to start with you and go to that quote from Andrew Hollenhorst, the City, who says 200,000 on payrolls Friday. CPI, June 13th, month-over-month core 0.4. We get those two things. He says hike is on June 14th. Do you agree?
Well, I'll just start by saying it's pretty remarkable that the last meeting was about engineering this pause that was widely expected. You know, and I think we're seeing the playbook that we've seen in Canada and we've seen in Australia, which is like an attempt to pause, but quickly gets derailed with the need for further tightening. That becomes obvious. So I don't have a strong view. I think the most important thing is that they're not cutting anytime soon. That was the biggest disconnect. That disconnect is disappearing now. Much more important than whether they hike. But yeah, I think the odds of hiking now are reasonable.
President Mester has a strong view. I don't really see a compelling reason to pause, to the Financial Times. Matt Hornbeck, do you see a compelling reason to pause?
John, yeah, we do. Our chief U.S. economist, Ellen Zentner, does not think the Fed is going to deliver a hike in June or July for that matter. But yeah, I mean, I do think that there is a compelling reason to pause. And that reason has already been articulated by both the chair, Governor Jefferson, which is the idea that monetary policy operates with lags. This is something that is not always immediately obvious in the sense that you don't get this immediate transmission from a rate hike into the real economy in real time. It takes a period of months or quarters and sometimes more than a year. And so I do think that there is a very real reason for the Fed to pause here and see how the economy evolves.
Matt, they seem to hate that word, though, pause, because they seem to believe, and I think perhaps some of us agree, that it implies cut is just around the corner. Matt, how do you think they're going to manage that?
Well, I mean, they've already tried to better define the word pause by entering the word skip into our lexicon. I mean, like when I think about the word pause, I think about watching a movie and I push pause to go get some popcorn. I don't come back to the movie and then rewind it. You know, I just push play again. So I think the word pause is plenty descriptive. But yeah, the history of the Fed suggests that when they stop hiking, for any length of time, the next move is a rate cut.
John, one key feature of your outlook for the whole of this year, you've pushed back against these cuts big time. And when it comes to the equity market and risk assets, you do not think the Fed's going to bail us out this time around. Is that, Jean, because you still believe that this inflation backdrop is going to be stickier for longer?
Yeah, I mean, I think we're going to end up eventually getting close to target on inflation. I don't have a strong view on when. I don't think it's going to be in 2023, and it won't probably be in 2024 either. But we're going to head towards that. But what is fundamentally different from what we've seen for the past 40 years, is that we're in a world where we're going to see ongoing inflation pressure underneath that will require essentially a tightening bias to be a structural tightening bias to be at play, which is the opposite of what we've been saying for the last 40 years, where there was like a structural easing bias. So I think that's the fundamental difference. And as a result, I think that the biggest part of the playbook, usual playbook that doesn't apply this time around, is that they won't come to the rescue easily if the economy tanks. The economy slowing, contracting is part of the recipe. And that's the part, we've been pushing pretty hard throughout the year. I think the market has moved now closer to what we think is in line with what's going to happen. But no rescue, I think, is the starting point.
John, tell me what that means for portfolio construction, and help me understand what that means for my allocation of fixed income. Now, you and I have talked about this a lot over the last few months. Fixed income, for now, for once, compared to the last 10 years, now offers me some income. What I'm trying to work out, and it's something that you've tried to answer, is whether it will offer me that inverse correlation to risk, that diversification within the portfolio. Have you got your doubts about that further out along the curve?
Yeah, so just to start on the income piece, right? So I think the fact that we don't see a rate cuts or an easing cycle coming, I think bolstered this case of income is real. Short duration fixed income is very attractive, continues to be. I think we're going to be able to clip some of these income for the foreseeable future. Now, the Fed not coming to the rescue, to our mind, has been the key catalyst for how bonds and duration has played a balanced role it has played since 2000. It was because of this Fed central banks coming to the rescue whenever needed, taking the downside, which in our view is, as I said, is not happening. And that calls into question how much faith you should have in duration and long-term bonds playing their balanced role. So we're skeptical. We think there still is a pretty entrenched playbook in people's mind, markets participant, and when they hear recession, there's a bit of movement in yields lower. So I think that can play as a trading kind of tactics or a very short horizon kind of tactics that can continue to play. But in terms of portfolio construction, longer term, I think the ballast properties have been weakened in this environment considerably.
Matt, do you share that skepticism?
I guess I'm less sure, John, myself. I don't think we've had a long enough bout of high inflation to say that the next 20 years we're going to see inflation persistently above target, and therefore the Fed is going to have to act with a bit more caution in terms of their reaction function. I just don't think we've seen enough data to clearly say that at this point. So I would say I'm reserving judgment on that one at this point.
Bob Michael at JP Morgan Asset Management out this morning looking for 3% right across the curve through this summer, looking for cuts in September. That's pretty bullish on treasuries. The 10-year right now, 360-ish. The 2-year at the moment, 440. We'll keep building on this. Jean Bavin, Matt Hornback are going to stick with us, luckily, fortunately. Going into the open in about 20 minutes away or so. Equities near session lows, negative 0.5%, with some movers going into the open. Here's Abby.
Hey, John. Well, we are looking at the S&P 500 heading toward its first down day in 4 sessions, potentially. So we're looking at lots of laggards. First, though, let's take a look at American Airlines, up nearly 3%. This after the airline did boost their second quarter EPS outlook, their capacity. They held that view. One measure of revenue is a little better on strong demand. To the downside, though, NVIDIA, after its best 3-day rally since 2002, up more than 30% over that time period on that monster outlook raise, down today, down 1.7%. But clearly the big plunger here, John, advanced auto parts heading to a possibly record decline, down 29.4%. They cut their full year profit view by about 40%. They slashed their dividend by 80%. It's going to be interesting as the day progresses to find out more of what's behind that big revision, frankly.
Abby, thank you. Coming up on this program, Jamie Dimon at JP Morgan weighing in on China.
China's obviously going to do what they think is good for itself. and business might be a positive attribute, but national security will trump all other issues.
The latest data disappointing once again. That conversation up next.
The hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
This is Bloomberg.
If you have more uncertainty, some of it caused by the Chinese government, well, of course, it's going to not just change foreign direct investment, which has gone up a little surprisingly, and I don't think they should assume that's going to continue, but it's going to change the people here, their own confidence, their own ability to invest and do things. China's obviously going to do what they think is good for itself, and business might be a positive attribute, but national security will trump all other issues.
Jamie Dimon at JP Morgan speaking exclusively with Bloomberg on China and other issues as well. This was a consensus call for the year ahead. It was get overweight all things connected to this story in China, the reopening, better economic growth, and then this happened. PMIs overnight, manufacturing 48.8, the estimate 49.5. Services holding in, but manufacturing disappointing. And as this dropped at about 9:30 Eastern time yesterday, this dropped too. The euro dollar breaking down to about 106.85 on the screen right now, negative by 0.5%. And some measures, some Chinese indexes, equity markets, showing the equity market in China in a bear market. Mike McKee, that's not the way this year was meant to go.
It is not the way this year was meant to go, and there's a lot of things going on. Jamie Dimon maybe underscored it when he talked about uncertainty, because there is the international diplomatic effort by the United States to sort of isolate China technologically, and there is also the Chinese effort to clamp down on its own economy and to become more centrally planned. And you can see what's happened. John was just talking about with those PMIs, especially manufacturing, falling far short. Now, the hope was that a lot of people would spend money coming out of the pandemic in China, and we did see an initial pop in services, but those have rolled over as well. And overall, what you're seeing is a decline in what they think is going to happen. The country put out a very conservative 5% growth rate. Economists still think they're going to get 5.5 for 2023, but the 2021 GDP came up 8.4%. And in the years before the pandemic, they were regularly in the high 6s. So China definitely slowing down. That's having an impact on the world now. We are seeing demand fall for imports into China, particularly for commodities, which could have a big impact in the United States and Europe in terms of inflation. You can see there what's happening with the metals for copper and for iron ore. Breaking down through some key levels as Chinese demand drops. And so we are looking, John, at a situation that is going to have different impacts on the global economy, maybe bring down inflation, but also maybe bring down growth a little bit.
Mike McKee, thank you, sir. Pleased you brought up commodities, 68 on WTI. Thank you, Mike. We're down by about 1.6% this morning. Brent crude in the low 70s at 72. We're negative 1.4% there. Jean Bavin, Matt Hornback back with us. Matt, this wasn't the way this story was meant to go this year. We had the reopening of China. Global growth was meant to get a boost. What do you make of the incoming information so far, Matt?
Well, John, it certainly hasn't been supportive of these consensus views. I mean, our economists have also been quite bullish on China, vocally so. But, I think ultimately what they're counting on at this point is policymakers in China to take a more serious approach towards easing conditions to encourage growth to rebound as we make our way through the second half of the year. So that remains the view, but certainly the data have been surprising to the downside.
And Matt, this market's just been beating up consensus views coming into 2023. Don't touch tech, it's ugly. Had a bad year last year and then tech ripped. Similar story with the US dollar. The US dollar gets short, the rest of the world's looking better than the last month or so happened. Matt, where are you in the team now in the US dollar?
John, well, so we came into the year not liking the US dollar, in part based on the idea that China's economic recovery would be real. But, what we did a couple months back is we pivoted to a long dollar stance, and we maintain that today, John. Positioning at the initiation of our long dollar view was very bearish, the US dollar. That positioning has changed a bit over the course of the past month or so, but we remain convicted that the US dollar has further to run higher, and certainly China disappointing has been helpful to that view.
What am I going to see first, Sean? 110 on euro dollar or back to parity again?
I think good question. I don't have a strong view on the direction of the euro dollar. I think maybe there's a bit more weakness that can come through. But to your point on the China story, I'm just back from 2 weeks touring the region, and I think we used to say that the farther away you are from China, the more bearish you are. And I think one thing that is unusual this time is I think it's the opposite. The closer you are, the more bearish you are. I think there's an animal spirit kind of issue really playing out. This is the wobbling we've seen over the last couple of weeks in the data, and that's the risk aversion from Chinese consumer is very material. So we are still constructive on China in the region because of the very different backdrop in terms of policy that you can see there. So there's an ability to respond. They're reluctant to deploy it, but there's the possibility to do it. So there's a floor. But yeah, I think that broad thesis is more questioned over the last 2 weeks than you would have expected at the beginning of the year, as you said.
The outperformance in the US tech on the equity market versus China tech has been phenomenal. I was looking at the numbers this morning. The NASDAQ Golden Dragon Index is down 10% year to date, well off the highs, deep into a bear market. The NASDAQ 100 is up 31% over the same time period. I've been having this conversation repeatedly about US equity market exceptionalism maybe making a comeback, Sean. Where are you and the team on that at the moment?
Yeah, I think the tech story. I mean, it's a different tech story from last year, right? So you said these consensus have been shattered this year. This consensus beyond tech being not the place to be. I don't think that's the same tech story we've seen last year. It's a big AI, a really exuberant story happening. I think there's something real there. It's very difficult, though, to know who's going to be the winners of that. So I think the thematic is pretty real, how it's going to play out, who's going to win, who's going to lose. And very difficult to see such a massive story, if you believe it, which is behind the rally we've seen. If you really believe that, very difficult to believe that, and at the same time not expect massive losers from that, which hasn't been reflected yet either. So I think these thematics are real. We believe them, but I think a bit less clear about exactly where to play it out, and not convinced that the current players will necessarily be the sole winner. So something to get exposure to, but think hard about the valuations.
You're not alone. Jean Bavin there, alongside Matt Hornback. To the two of you, thank you. That's the moment we're in right now. Are we on the edge, the brink of a melt up or a meltdown? We've had that conversation a million times. Look at the equal weight S&P 500. Strip out the muscle of big tech. Month to date, we're down on the month by 3% on the equal weight S&P. Month to date on the NASDAQ, up more than 8%. We're talking about 11 points of outperformance on the NASDAQ 100, driven by some big names like NVIDIA, Meta, and it's not just those names. AMD, Salesforce, Tesla having monster years so far after difficult times through much of last year for some of those names. Going into the opening bow to close out the month of May, we're down by 0.4%. Coming up next, the morning calls, and later, Bank of America's Jill Carey-Hall joining us at the opening bow, weighing in on weakening breadth concerns. That conversation still ahead.
So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance. Our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Five minutes away from the opening bow, softer here, negative by 0.5% on the S&P 500. Likewise on the NASDAQ, down about 0.5% or so. That's the price action. Let's get to some morning calls. JP Morgan upgrading Chevron to neutral. 170 price target, saying the company is well positioned for a potential downturn. We're down 1% there. Deutsche Bank upgrading Ava's budget to buy, pointing to the stock's attractive valuation and overly negative sentiment. That stock is up by more than 4%. And finally, Credit Suisse raising its Microsoft price target to a street high 420, highlighting the company's rapid growth in AI-related products. There's another one. Microsoft 331, almost 332 in early trading, positive there by a little more than 0.1%. Coming up, stocks closing out another monthly advance despite the weakest breadth on records going back to 1990. That conversation up next with Bank of America's Jill Carey-Hall.
top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg.
.24 seconds away from the opening bound this morning. Good morning to you. Negative by 0.5% on the S&P 500. On the Nasdaq, down by a similar amount. No real drama here going into the opening bound as we close out the month of May and a stellar month of gains for the big cap names in big tech. There's your opening bound. Switch at the board and get to the bond market. Yields look like this on a 10-year, down a single basis point, 367.32. More Fed speak from Loretta Mester in the Financial Times, signaling she wants to hike again in the month of June. Others will follow. Let's see what the Fed speak looks like going into the quiet period, which kicks off on Saturday. Bit of dollar strength out there, euro weakness. That euro weakness pronounced. Much more so following that economic data out of China. Disappointing. The euro 106.86. Haven't seen 108 for about a week. Euro dollar negative by 0.5%. And crude breaking lower. We're talking about multi-year lows now, potentially, on WTI in the 60s, 68 on WTI, down about 0.8% this morning. One stock to watch at the open, HP, shares under pressure after reporting lower than expected 2Q revenue. The CEO saying this: the macro situation is obviously impacting demand across industries. However, we think the second half will be stronger than the first. Abby has more. Hey, Abby.
Hey, John. It's interesting because analysts seem to agree with the CEO of HP that the second half demand will recover. But in terms of the second quarter, it was disappointing. Sales came in light of what was expected. They declined 22% to $12.9 billion. The personal system segment fell 29% to $8.2 billion. That was short of the average analyst estimate of $8.4 billion. On the year, John, we do have analysts, though, echoing, again, what the CEO said, that the second half could see some sort of return to normalcy for PC demand. Morgan Stanley saying that this is the bottom. Lots of mixed messages here. On the year, this stock up about 15% right now, having its worst day since it actually might be a little bit more. I can kind of look while we're on air here. But when I last looked, the worst day since February of this year. And I think it's going to be a greater decline, which suggests that traders are weighing these results despite the fact that there could be some kind of recovery. Yes, we're looking at the worst day since August of last year, that traders are really weighing these results and not paying as much attention to the possibility of that second half recovery. We'll have to stay tuned.
Down 6%, Abby. The hope things get better. That's always the hope. Right now on the S&P 500, negative by 0.3%. NASDAQ just a touch lighter. We're down there by 0.2%. Want to stick with earnings. Shares of Advanced Auto Parts getting hammered after missing on Q1 estimates, cutting its full-year guidance and reducing its quarterly dividend. The CEO writing, quote, "We expect the competitive dynamics we faced in the first quarter to continue, resulting in a shortfall to our 2023 expectations." Katie Greifeld has more. Hey, Katie.
Hey, John. Well, as analysts from Truist phrased it, everything that could go wrong, whatever could go wrong,
did go wrong when it comes to this report. Nearly every metric was disappointing, John. Like you said, the auto parts retailer cut its earnings and sales guidance for the full year. It did reduce that quarterly dividend from $1.50 to just 25 cents. And that's all after, of course, it missed estimates for the first quarter. Like you said, CEO Tom Greco saying that the competitive dynamics that we saw in the first quarter will continue to hound Advanced Auto for the year to come. To get a little bit more specific, the company now sees full year EPS between $6 to $6.50. The previous forecast was between $10.20 to $11.20. So a big cut there. And as you would expect, the market reaction has been swift and it's been brutal. Right now, shares are off by almost 29%. As such, right now, that is the worst day ever for Advanced Auto.
Wow, Katie, thank you. A third of the market cap gone. Just like that. Let's stick with the auto sector. Tesla's Elon Musk meeting more government officials on the second day of his trip to China. Wedbush's Dan Ives saying the visit comes at a key time, writing this: playing nice in the sandbox in Beijing is something the street is laser focused on to make sure there's no disruptions to Tesla's expansion. David Welch of Bloomberg joins us right now. David, are we playing nice?
Really, Elon has to play nice in China. He's got an expansion going on, big plant in Shanghai, and he sells a lot of cars there. I think if you look at it, really, Mary Barra at General Motors has to do the same thing. So do the German car makers. They all have a big presence there. They have joint venture partners. And if you really want to grow your electric vehicle business and you want to get global scale for battery, electric motors, all of that expensive stuff, you need to be able to participate in China. And the domestic players there are coming on strong, and BYD now being the #1 seller of electric vehicles in the world. So if politics cuts Tesla, General Motors, German car makers out of that market in any way, or even just diminishes their ability to sell vehicles there, that's a big problem for all of them in terms of global competition.
And David, this stock's had quite a year, up 61%. What's behind the monster gains this year relative to the difficulties we had in the previous year?
I think investors are getting used to the idea that Tesla's been cutting its prices. There seems to be a bit of stability there. I think they see Tesla having an ability to use their margin advantage to really hold off competition from the other car companies. I think last year, one of the things that hurt the shares was the fact that we had new EVs coming on from Hyundai, Kia, General Motors, Ford. And if Tesla can use a pricing advantage to still make decent profits while maintaining market share or even growing it, investors are going to like that.
David, the stock is a little bit lower this morning, down by 1%, but much, much higher on the year. David Welch there, thank you. From Tesla to Twitter, you might have seen this story yesterday that according to Fidelity, Twitter is now worth just 1/3 of the $44 billion that Elon Musk paid for the social media platform. But I think what a lot of people missed is this. Despite those issues, and because of the gains in Tesla, Elon Musk's wealth is up more than $48 billion this year. So never mind the $44 billion he paid for it last year. His wealth this year is up something like $50 billion US. Tesla is up 61% year to date, down about 1% on the session. Let's go from that to the financials. Goldman considering another wave of layoffs in what would be its third round of cuts in under a year. A representative for Goldman declined to comment. Kelly Lyons has more. Hey, Kaylee.
Yeah, John, when this news first crossed yesterday, we didn't see too much of a share price reaction. It ended the day lower by just a few tenths of 1%, but the losses are steeper this morning with the stock now down about 1.75%. So one of the laggards in the financial index on this Wednesday. Now, as you said, this would be the third round of cuts in less than a year. Of course, they eliminated several hundred jobs back in September of 2022. Then in January began their biggest round of layoffs ever, eliminating 3,200 positions. And now another round, we understand, according to people familiar, though it should be smaller, affecting less than 250 people. But they are expected to be more senior members of the firm. Of course, all of this happening as Goldman and banks across Wall Street are contending with a slump in deal making. That recovery has been very hard to find. It is a slump that likely will continue throughout the remainder of this year, and it has led to a reevaluation of costs. Goldman, if you recall, back in February said it does plan to reduce expenses by $1 billion, and potentially now more layoffs are going to be part of that story. Again, John, the stock down about 1.7% here in the first few minutes of trading.
Kelly, thank you. About 7 minutes into this session, more broadly on the S&P 500, we pulled back just a touch, down by 0.5%. Some relative outperformance in the Nasdaq, but still lower by 0.3%. Stocks closing in on another monthly advance thanks to the rally in big tech. The S&P 500 eyeing a third month of gains despite only 28%
of the index trading higher this month. That's the worst breadth for a monthly gain on records going back to 1990. Morgan Stanley's Andrew Sliman weighing in on those bad breath concerns.
There's no conclusive proof that actually bad breath doesn't lead to always a sell-off. Many times it leads to broadening breadth in the market rally. I think that will happen. I'm just not sure, other than short term on a debt deal, I'm not sure that will happen until we get past Labor Day.
And joining us now is Bank of America's Jill Carey-Hall. Jill, wonderful to catch up with you. It's a conversation I've had with your colleague Savita, others too. I'd love your input on this subject too. Does narrow breadth matter?
Thanks for having me. You know, we've found similar to what was just mentioned in that, you know, narrow breadth and bad breadth in the market doesn't necessarily mean, you know, negative returns. You know, the better market returns have often followed periods of bad breadth. So we haven't necessarily seen that as a signal. That said, you know, the market has been led by a lot of these big mega cap tech or growth stocks. And, you know, we have a relatively benign outlook on the S&P 500 for the remainder of the year. We did get incrementally more bullish. We raised our target recently to 4,300 from 4,000. But, you know, we're more bullish on some of the areas like energy and what we'd call the old economy cyclicals rather than some of the newer growth areas. You know, we saw a sort of surprise bout of QE in the first part of the year, and that's an environment when growth stocks usually do well. But we expect more quantitative tightening rather than quantitative easing going forward. And, you know, we're equal weight tech. We would prefer tech to communication services. I think a lot of the AI spending and broader CapEx spending will benefit tech more, and it's a less crowded area. But there's still risks to tech as a cyclical sector, and you saw a lot of, you know, demand pull forward. So we're market weight the tech sector and would see leadership from some of the other cyclical areas.
Jill, let's deal with the index. As you know, year to date and month to date, we've seen massive outperformance for things like the NASDAQ versus the equal weight. The equal weight S&P 500 this month, and we've talked about this repeatedly this morning, is down by 3%. The NASDAQ is flying by more than 8%. That's 11 points of outperformance. This is kind of like historic stuff here, Jill. And if you don't have the muscle of big tech in the portfolio right now, the AI themes that you touched on, you're really not having a great year. Jill, why is this the time? And just to go back to your research, why is this the time to prefer the equal-weighted S&P 500 to the cap-weighted index?
Well, I think the equal-weighted index is, you know, much more attractively valued at this point, given the divergence that we've seen. A lot of you know, the cap-weighted index is much more expensive. It's, you know, more crowded in some of those areas. So, you know, better value, and you know, we do think, as I mentioned, that, you know, some of the new leadership in the market could be areas like energy, like parts of materials. You know, we could see a resilient CapEx cycle, you know, this year, even amidst a recession. So I think, you know, these are areas that could be the new leadership. The market has been hit by, you know, obviously everything going on with credit and the regional banks. Small caps have underperformed. The equal weighted index has underperformed given the rally in tech that we've seen. But at this point, we would prefer the equal weighted over the cap weighted index.
You head up the strategy for small caps as well over at BofA, Jill, so perhaps we can finish there. You turned cautious back in March, I remember, off the back of some of the financial difficulties. Given the weightings towards financials in the Russell, makes perfect sense. Jill, where are you in the team now on that particular topic?
Yeah, we've still been tactically cautious on small caps. We've obviously been watching the credit backdrop and the regional banking backdrop. The small caps do obviously have more exposure to regional banks as well as to credit conditions. We have seen further tightening, obviously nothing too detrimental. Our credit stress indicators that our firm tracks are still elevated, but we're not critical. So we're watching all of these. I also think, ahead of the debt ceilings, as we've seen market volatility, small caps tend to be more negatively sensitive to volatile markets. So, near term we have stayed cautious, but I think if we can see, a stabilization in continued stabilization in banks and credit, and we just get this sort of mild economic recession that our economists are looking for, then, I do think small caps are pricing in the mild economic recession more adequately. And, if you have a longer time horizon, this could be a good entry point for small caps. We've still been bullish over the long term on small caps, relative valuations versus larger near decade lows. And, they're going to benefit from a lot of the multi-year themes like globalization peaking, reshoring. They're bigger beneficiaries of CapEx spending. They're more domestic. So I do think for a longer time horizon, we would see better return potential there.
Hey, Jill, always appreciate your input. Jill Carey-Hill there of Bank of America. They lifted their price target recently over at BofA to 4,300, incremental, as Jill said herself. Marginal upside there on the index, on the S&P 500. The enthusiasm over at BofA on the equal weight S&P, stripping out the muscle of some of the big gainers this year, which have been the likes of Nvidia and Meta, but that's where the gains have been. Is that where the gains will be in the second half of this year as well? About 13 minutes into the session, we pulled back by 0.3% on the S&P. On the NASDAQ, we're almost unchanged on the session. Coming up, the Fed in focus as more U.S. economic data hits the wires.
My simple view is that, they're right to pause at this point. It's been a big increase, 500 basis points or so. Take a pause, but I do think it's possible they're going to have to raise a little bit more.
It's the final 2-week stretch going into the Fed's June 14th rate decision.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What about cryptocurrencies? Are you a believer in cryptocurrencies?
No, I'm not a believer in cryptocurrencies. And I would say that cryptocurrencies are a bubble. And I would describe cryptocurrencies as a limited supply of nothing. So to the extent there's more demand than the limited supply, the price would go up. But to the extent the demand falls, then the price would go down. There's no intrinsic value to any of the cryptocurrencies, except that there's a limited amount.
Well, based on what you've just said, why would you not put a big short of some type on cryptocurrencies? Or maybe you have, but do you think that's a good short?
Well, when we look for the subprime, the reason why we shorted the subprime in size because it was asymmetrical. You're shorting a bond at par that has a limited duration that trades at a 1% spread of treasury. So you can't lose more than the spread in the duration. Yet if it defaults, you can make the par amount. In crypto, there's unlimited downside. So even though I could be right over the long term, in the short term, as the case of Bitcoin, went from 5,000 to 45,000, I would be wiped out on the short side. So it's just too volatile to short.
News breaks. No one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength
on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority.
You know, my simple view is that, you know, they're right to pause at this point. It's been a big increase, you know, 500 basis points or so. Take a pause, but I do think it's possible they're going to have to raise a little bit more.
Sometimes economic data is so bad, it's good for treasuries. Yield to lower at the front end by 7 basis points on a 2-year. Mike McKee has the why. Hey, Mike.
Well, John, it's the Chicago PMI, which comes in very, very weak at 40.4, down from 48.6. The forecast was for just a small change. So that is considered bad news, but it is a tertiary indicator, and we have had some discrepancies among the regional PMIs. The real question is, what happens on a national basis? And because of the calendar, we got a very compressed week. Almost everything happening tomorrow and Friday. JOLTS comes out today, top of the hour. You'll want to stay tuned for that. That could have an impact on the market if job openings stay high. But then ISM tomorrow, we have a forecast for a very small change, but that could go down after we saw what happened with Chicago. And we'll want to see what happens in the employment index as far as ISM, but also ADP tomorrow and initial claims tomorrow. And they're all supposed to show some changes in the markets, but initial claims, we don't know the way it's been going. We do have, because of the shortened week, not much time for people to change their forecasts for payrolls. But Friday, John, we're expecting 195. We've been over the expectation for something like 8 months now. And unemployment rate, 3.5%. That would only be a tick up. And it would probably turn the conversation and the markets back to higher rates.
And Mike McKee, 3.5% unemployment does not scream recession. The data in services right now does not scream recession. But then you've got manufacturing, Mike. What is happening with manufacturing versus everything else?
Well, that's an interesting question, because usually if manufacturing is slumping, it's because people don't want to buy stuff. And maybe it's partly because they don't want to buy stuff because they're spending all their money on services. But it's a little hard to square the two things. And we won't get the ISM services number until next week, unfortunately. So we won't have that as an ingredient into jobs. But jobs and then CPI, those are going to be the big numbers that will set the Fed's course.
June 2nd, Friday, payrolls. June 13th, CPI. Mike, thank you, sir. From the data to the Fed speak, a host of Fed officials on the calendar throughout today, going into the quiet period this weekend, getting their final word in before that begins, and ahead of that June 14th rate decision. Ed Harrison joins us now. Ed, let's talk about it. Mester's talking about another hike maybe in June. Just how splintered is this committee becoming?
Yeah, I think we're at the maximum point of splintering, because you hear people like Chicago Fed President Austin Goolsbee, who wants to pause immediately. And then you hear others like Jim Bullard from St. Louis who are saying, look, we can continue going. Even Mester herself said that she would probably go for a hike. I think that Powell, he's able to get everyone on side. And I think the easiest way to get everyone on side at this particular juncture is to potentially pause as soon as possible, maybe as soon as June, and then to hold for a longer period of time. And they look like they're moving the market in that direction.
What kind of data points do you think we need to see between now and then for that to happen? Andrew Hollenhorst, the City, Ed, I think set the bar pretty low. He said 200K payrolls, 0.4% on core CPI month on month, and he said they're going to go again in June. How low or how high do you think the bar is right now?
Yeah, I think that the biggest thing probably is the labor market, as you were pointing out, payrolls. We're going to get the JOLTS data. That's going to tell us, whether or not the demand for labor is coming down. And then we're going to get as well the payrolls data. If it's over 200K, let's say 250, I think that's a really high number. We're already at about 60% chance of a 25 basis point rate hike on markets. I think you'd start to get closer to 80% at that juncture, and then the Fed would go ahead and probably hike again in June.
And maybe we'll get some dissent along the way for once. Ed, great to catch up with you, buddy. Let's catch up before we get that Fed decision. 2 weeks today, looking ahead to JOLTS. Ed talked about it, Mike talked about it. Alex Steele's going to break that down for you on Bloomberg TV in about 8 minutes' time. Your estimates at the moment, the previous number close to 9.6 million. Looking forward to that to come down to about 9.4 based on our estimates. That's the median estimate in our survey so far. So looking for that to come from 9.6 down to 9.4. You'll get the actual figure in about 7 or 8 minutes. Let's get you some sector price action. We can do that now with Abby.
We're looking at pretty bearish sector composition, John. Most sectors are lower, and we in fact have 4 sectors that are down. At the same time, we have 3 sectors that are up slightly: tech, real estate, utilities. To the downside, though, we're being led by energy, financials, materials, and industrials. Let's take a closer look at energy because we, of course, as you've been talking about, have oil below $70 a barrel. Those China PPIs, not so great, and actually that Chicago information, not great either. But near year-to-date lows, down 13% on the year, John. Right now headed to its worst year since the pandemic year. Let's see whether or not those are recouped or if oil and copper are sending signals about the economy.
Abby, thank you. Right now down by 0.4% on the broader S&P 500. Saw this market turn off the back of that Chicago PMI data, more specifically in a more pronounced way into the bond market at the very front of the yield curve on a 2-year. Now down by 7 basis points, just pulling back and retracing some of that move higher we've seen over the previous 11, 12 days. Last week, the week before that, the 2-year up big time. Month to date before today, the 2-year was up something like 44 basis points. So just chipping away at that as we go into June. We're down another 7 to about 437. Up next, your trading diary.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
26 minutes in, stocks lower. Let's get to the trading diary. Coming up very, very shortly in about 5 minutes' time, we'll get you some economic data at the top of the hour. We'll get you the JOLTS report. Fed Speak picks up this afternoon with Collins, Harker and Jefferson. ISM manufacturing numbers and another round of claims coming up on Thursday. Plus earnings from Macy's. That's still to come. But on Friday, it's the main event, the May payrolls report. Looking back and looking for a number that could come in close to about 200K. The estimate so far, about 195. From New York, that does it for me. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could